this morning. US futures flat to positive. Of course, it's Thanksgiving, no trading stateside today. Let's get a Bloomberg Business Flash for you. Some of the top corporate stories that we're covering here at Bloomberg. Repsol is outlining plans for a greener future. The Spanish oil company says it will wind down the search for crude and plans to expand its renewables capacity fivefold over the next decade. Cash from its oil business will be funneled into the growth of cleaner energy. A year ago, Repsol was the first oil major to set a net zero emissions target. Liberty Steel's talks for a potential purchase of ThyssenKrupp's steel business are said to be poised to advance to due diligence. It could access the books of the German industrial group's unit in the coming weeks. Sources tell Bloomberg questions remain about the deal and rivals are still interested. No official comment yet. Amazon's cloud computing division suffered an outage yesterday, hitting several customers, including Roku and Adobe. The fault also made it harder to post updates to a closely watched status page. Amazon Web Services is the largest provider of rented computing power, and its data centers are the foundation of much of the internet. That is your Bloomberg Business Flash. Joining us now for a look at the markets as we close out this hour on Bloomberg TV is Ven Ram, Bloomberg's Markets Live currency and rates strategist. Ven, lots to talk about this morning, but I'll go first to the Riksbank because that's the sort of most recent information. A decent-sized move in the Swedish krona as a result of this. A surprise, was it, the QE news?
Yes, definitely it was on the QE news, Anna. The expansion by 200 billion krona is almost twice the amount the market was expecting, and is perhaps causing the markets to ask themselves the question, hang on, does the Riksbank think that the economy is worse than we thought? Of course, the pandemic has kind of worsened in the past few weeks in Sweden, as you know, Anna. But so the market is legitimately asking the question, is the economy worse than we thought? However, from a longer-term perspective, the Riksbank is getting ahead of the curve, and that is definitely a welcome move rather than taking rates below zero again. Anna?
Yeah, so the krona falling on that QE news flow. Let me ask you about the ECB, Ven. I know you've been thinking about this on the Markets Live blog and within the team today. When will the euro see ECB pushback? We have seen some strength in the euro. The story this morning is the euro a touch stronger. 119 is the handle, 119.25. There's been concern at the ECB about what the strong currency does to its inflation targets and its ability to reach those in the past, and of course to European exporters. When do you expect any pushback?
I think the ECB is likely to start jawboning the currency around 120 handle. If you remember, we had the ECB Philip Lane and other speakers pushing back on the euro strength earlier this year when the euro approached those levels. So it would be safe to assume that they would get very, very jittery around 120 again, and definitely very antsy if it goes above 122. At current levels of the euro, though, the markets seem to be telling the ECB, well, you can hold down bond yields at extremely low levels, but in return, you need to allow for strength in the euro, and you can't really have it both ways. So all this sets up for a very nice ECB next month on December 10th, Anna.
Ven Ram, thank you very much. Bloomberg's Markets Live currency and rate strategist. Thank you very much for joining us. That is it for the European Market Open. Stay with Bloomberg Television. Surveillance is up next. They will take you through this special Thanksgiving programming for the next few hours. This is Bloomberg.
뭐야? 아, 잠시만요. 난 경유에서 쇼핑만 했을 뿐이라고요.
쇼핑한다고 돈이 나와? 응?
샵백 경유에서 쇼핑하고 캐시백 받자. 똑똑한 쇼핑 습관 샵백.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Tightening curbs, Chancellor Merkel extends Germany's partial lockdown for at least 3 weeks as the country struggles to contain the coronavirus. Brexit breakdown, France accuses the UK of dragging its feet on a trade deal with the EU. And drop the dead, an Italian government official tells Bloomberg the ECB should consider cancelling bonds bought during the crisis. Well, good morning, everyone, and happy Thanksgiving to all of our American friends watching from near and far. I know it's a little bit of a different one this year, but we, of course, hope that you have a joyous holiday. Let's quickly look at the markets. The market's really focused on a couple of things. Partly it's the vaccine, partly it's what we're seeing across some of the concerns. I want to show Bitcoin in a second, but actually the global stock rally pushes on despite the holiday in the U.S., and Bitcoin tumbled as much as 8.7%. Now, I'm looking at Asian shares. They saw modest gains. The European stocks actually fluctuating at the open, but we did see gains by tech and healthcare firms, offsetting some of the drops in cyclical companies, including energy and autos. So Treasury futures edging higher as the cash market, a reminder, is closed with traders off for Thanksgiving holiday in the U.S. But yesterday we did have a deluge of data bringing the first back-to-back rise in weekly U.S. jobless claims since July. We also yesterday saw an uptake in durable goods orders and a widening trade deficit. Now let's get straight to the Bloomberg First Word News. In London with me is Leanne Gerrans. Hi, Leanne.
Good morning, Francine. President Donald Trump has pardoned his first national security advisor, Michael Flynn. Flynn pleaded guilty to lying to the FBI about conversations he had with the Russian ambassador before trying to switch his plea. The president portrayed the prosecution as evidence of a broader conspiracy against the White House. Democrats have hit out at the move. Now, France is accusing the UK of dragging its feet over Brexit. The nation's foreign minister says the outcome of talks remain highly uncertain and the two sides are still extremely far apart on some key issues. EU Commission President Ursula von der Leyen says the coming days will be decisive. Now, UK Chancellor Rishi Sunak is facing a backlash for his decision to cut the UK's foreign aid budget. It's a signal to some that the government plans to prioritise the domestic economy, but many are criticising the decision, including and battled addiction for many years. Argentina has 3 days of national mourning. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. The internet really came together with the death of Maradona. So many people had so many memories. I know also that the French president actually gave a very long letter describing what he brought to the world. And then I had forgotten, but I went back, Leanne, and read so much on monetary theory and the fact that Lord Mervyn King at the time had looked at his goals and tried to, put parallels, the Maradona monetary theory, looking at parallels between monetary policy and Diego Maradona. Now, let's focus on banking. And the European Central Bank is warning that lenders will have to set aside more money to soak up losses when government pandemic support ends and the economy tackles massive debt. Meanwhile, regulators are set to decide in the coming weeks whether banks can restart paying dividends. Well, joining us now for an exclusive conversation is Jean Lemierre. He's a chairman at BNP Paribas. Mr. Lemierre, as always, thank you so much for giving us a little bit of your time. When you look at the banking industry and some of the challenges that you're facing, it's, pressure on dividends, bonuses, retaining staff, working from home, and of course, a low growth environment. What concerns you the most for banks going forward?
Well, good morning first. My first priority is to serve the clients, to support the economy, to use as much as possible the balance sheet we have, the strength we have to support the corporate sector and the business. Of course, we have the challenges you have mentioned, but let's be clear, we are totally focused on supporting the economy. We have done so at springtime, at a time when markets were shut down. We have offered ample liquidity to the corporate sector to continue to do their job and pay their suppliers and employees. And of course, we need to continue to do it. So my first concern, my first priority is not about the dividend, not about the bonus, but about working with clients and supporting them. That's absolutely crucial. And I think the banking sector has done all over Europe quite well during the crisis and continues to do it. It's an element which has had a lot to the support given by the ECB and by governments. Of course, there are the challenges you have mentioned. And among them, we need to continue to be strong, to have a strong capital, and to manage the potential difficulties we may see over 2021 and 2022. But once more, my priority, if this is your question, is serving clients. Then we see.
What's your second priority?
Well, my second priority, yes, I've said this, to continue to be strong, to continue to raise funding for financing the economy. And having this in mind, we have a few challenges. One, of course, is the operational challenge. The staff of banks have done very well over 2020, and their protection, their capacity to engage with clients is key. So that's really my second priority, is to make sure that the bank is safe, we can operate, and we can members of the staff are safe and can do the job. It has a lot to do with remote working, masks, protection, but we need to maintain a high level of capacity to engage with clients, whoever they are. This is the mission we have. Once I've said this, of course, there are questions like the one you have mentioned, like dividend, which is very... Yes, please.
I was going to ask you about dividends. We're expecting the ECB, the industry is waiting for the ECB to make a decision on dividends. Yes. Is it time that you're able to pay back a dividend? How difficult has it been in the relationship with shareholders not to be able to pay a dividend?
Well, of course, shareholders do wish to have a dividend. This is normal. They allocate capital to the bank. We use the capital they put in the bank, and they want to be rewarded if it is possible. I think the decision made, the recommendation given by the ECB has been broadly well understood at springtime. There was a high level of uncertainty. Nobody knew exactly what was going to happen. And even if it came as a big negative surprise, it was part of the negative news out of the COVID crisis. But to a large extent, investors, of course, are not positive, not happy, but I think most of them have understood. You see what I mean? The question is the decision which is going to be made by the ECB, the recommendation they will give in December. I think today we are still in difficulties. Let's be clear, there is a second wave of contagion everywhere in Europe and in the world. There are difficulties, lockdown is still there, and the reopening of the business is moving forward, but there are still many difficulties. So I think there's still a level of difficulties, but I think there's more certainty. I think we understand better what's going to happen. We understand better the risk ahead. We understand better the challenges we have. And in the dialogue with the supervisor is about these questions. So I hope that this understanding will help the decision-making by the ECB about the recommendation they will give in December. They are better informed. They have more elements. And once more, I hope it will help them to take the right decision. But maybe,
do you think the right decision is now to be able to resume dividends?
Well, we don't know. They will make a decision in December. Of course, the current recommendation is to retain dividend, but they have announced a decision in December. They will make a decision in December on the information I've mentioned, which are better. I hope it will help. But of course, whatever the recommendation is, we shall respect the recommendation of the ECB. We need to respect recommendations of supervisors. But once more, I hope that all of us together, we have a better understanding of what may happen in 2021 and 2022, and that the supervisors will be made more comfortable making that decision.
Monsieur Lemierre, are you expecting cross-border consolidation in 2021 in Europe?
No. I've made my position very clear. What is the key question of the banking industry today is low income, low interest rates, difficulties to face that situation. What is the action of the banks? All of them, all of us, we do the same, to reduce costs. And one way of reducing costs is to create cost synergies. But you create cost synergies within the domestic market. If you are already part of the domestic market, then you can create synergies. This is what we see in Spain. And Spain does a lot of national domestic consolidation, and they continue to do it because there are synergies, and they are right to do so. This is what we see now in Italy. When I see the project of Crédit Agricole, it's about growing Italian domestic synergies. So this is what we are going to see more and more, because there is a push for consolidation, domestic consolidation. On the other hand, cross-border consolidations, in the meaning you have, more difficult. They don't bring the same impact. Now, we may see limited operations. There will be, of course there will be. We should never say never, There will be some limited operations, but I do not foresee any large operations for the reason I've mentioned. On the other hand, what we see, not in retail, but mainly in corporate and market banking, we see consolidation of market shares. Cross-border.
Monsieur Lemierre, thank you so much. Jean Lemierre. Sorry, finish? We're having a bit of a delay, so we're just going to take a quick break and then we'll get back to Jean Lemierre from BNP Paribas. Of course, he stays with us for a wonderful conversation. So, Monsieur Lemierre, thank you so much. Don't go anywhere. Coming up, we'll talk more about the challenges and opportunities for the banking industry. BNP Paribas has done extremely well, especially in getting market share to some of their competitors in the U.S. So we'll ask whether the U.S. banks are now back. We'll talk about the outlook for 2021, given the lockdowns, given the vaccine, with Mr. Lemierre. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, there's a lot going on in the markets. Of course, today is also Thanksgiving. So, again, I'll say it a lot. Happy Thanksgiving to our American friends. The market is, going ahead in terms of the rally in the rest of the world. But, of course, for example, cash treasuries are closed for the day. Now, still with us, Jean Lemierre from BNP Paribas. Monsieur Lemierre, thank you for staying with us. We were having a great conversation about some of the opportunities and challenges for banks in general. Now, when you look at some of the corporate space, BNP Paribas has really done extremely well during the crisis. Do you now think that your rivals in the US are back? Can you continue getting market share, or will it just be a bit more difficult?
Well, thank you first for insisting on the fact that we have done well, at least during the crisis, the beginning of the year. We have tried to use the balance sheet of the bank to support clients, and we have done it. The same way as American banks. American banks have done the same. They were, like us, busy with their core clients, which is normal, and we need to understand this and accept this. We are still in a situation in which we need to be highly focused on these clients. Crisis is not over. There are still difficulties. Many sectors are in difficulty and will continue to suffer, and they deserve support. But of course, competition will come back in a normal way, which is fair. This is the way it should be. So we know well that we are competing with excellent colleagues. They know well their job and they have resources. But we have resources, we have knowledge, we know the clients. And I hope that what has happened during the crisis, which is the capacity to deliver and to be with the client, will be in the near future, and probably more than the near future, a key element in the competition. I think companies, corporate sector, will not forget who has done what at a time they were in massive uncertainty. So yes, there will be competition, which is good. There must be competition, but the competition will take into account what has been done in 2020 by the banking sector, which is normal and fair. We need to have banks which are consistent, committed over time, over the cycle, and across difficulties. And that's a key element. This has always been at the core of BNP Paribas view, BNP Paribas strategy.
Yeah.
I would say, unfortunately, we have had to show it, but we have done it. And I think that will be a key element in the competition ahead.
You've also done very well in fixed income trading. How will that translate into bonuses, Mr. Lumière?
Oh, that we shall see. This is not a decision for now. These are decisions which will be taken beginning of next year when we know what is the year. You know, don't sell the skin of the bear before killing the bear. You know, you have to be very careful on these matters. Moreover, I think we need to take a fair approach with the people who have done the job in an excellent way in difficult circumstances. But we need also to understand that a degree of moderation and wise attitude is needed. But these decisions will be taken, I think, bank by bank later, beginning of next year.
Yeah. Would your caution also apply to the markets? Do we have to be a bit more, you know, do markets have to be less exuberant, given we're not exactly sure when, you know, a good chunk of the population will be vaccinated?
Yes, well, you know, once more on the vaccine, I think there is light at the end of the tunnel. I'm very confident scientists are developing vaccines and medicines which are going to help a lot people to go through this virus crisis. So there will be one. Now, we know there are many questions about production, about distribution, about the impact, and we should not expect a quick, immediate impact. It will take some time, but at least there is a light, and that's what is very important. I think this is well understood by the market, and when I listen to comments made by policymakers like central banks, I think this is what they say. They say, yes, we understand better, we know it's going to happen, we know it's going to help. Now, let's be cautious about the timing, which is, I think, a fair assessment.
Thank you so much for your time today, Mr. Jean Lumière there, the chairman of BNP Paribas. Now, coming up, we'll have plenty more on banks. We'll also look at the incoming and outgoing U.S. presidents and what they offer in terms of starkly different Thanksgiving messages. We discuss that next. This is Bloomberg.
뭐야? 아, 잠시만요. 난 경유에서 쇼핑만 했을 뿐이라고요.
쇼핑한다고 돈이 나와? 응?
샵백 경유에서 쇼핑하고 캐시백 받자. 똑똑한 쇼핑 습관 샵백.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts He has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
Incoming and outgoing U.S. presidents offering starkly different messages on the eve of Thanksgiving. Joe Biden focusing on the need to quell the coronavirus, and Donald Trump calling for the election result to be overturned. Now, coming up next, we focus on ETF, cryptocurrency exchange-traded products in Europe have now topped 1 billion euros in assets. Yet again, Bitcoin proves a volatile ride for investors. So we'll talk, of course, about that and much more on the weekly show, ETF IQ Europe. That's next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Welcome to Bloomberg ETF IQ Europe. I'm Francine Lackwin. Over the next 30 minutes, we'll be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. November's bumper harvest investor give thanks as equities power towards a stellar month of gains, while stock ETF flows close 2020 ahead of fixed income. The Bitcoin roller coaster, crypto-related ETPs in Europe pass €1 billion in assets, but the digital currency proves a hair-raising ride for investors. And a crude comeback just months after their abrupt closure. Triple leverage oil are relaunching this week. We'll ask if the high-risk products are here to stay. Well, first up, let's take a look at which countries and sectors have been attracting the money. Danny Berger has the details. Hi, Danny.
Hi, Francine. Well, as we wrap up the month, it makes sense to look at FFLO Go. These are flows of funds that track European regions. And for the past month, we've seen net inflows of $266 million. But the remarkable thing is that really we were able to see net inflows this month because of the UK. UK tracking ETFs bringing in more than $800 million worth of flows. Now, a lot of the winners there, we have things like FTSE 100 tracking ETFs. One of them from BlackRock was the winner last week. And this might be a sign that investors are more comfortable jumping into these assets with the Brexit negotiations taking perhaps a more clear path. Vaccine progress also, of course, good news for the UK, as it is for most of Europe and places like Germany, which also saw inflows of $300 million. Now, in Germany, that's also interesting. A U.S.-listed fund bringing in the flows. EWG is its ticker, despite the fact of seeing net outflows last month. I should say, though, we had some big drags on the flow picture over the past month, and that was France losing more than $400 million worth of investor money. So investors pulling their cash out. One of the biggest outflows came from a Cacaron tracking index, despite the fact that that index is on track for one of its best months in quite some time, but still some skepticism about those French assets. So a really big divide, despite perhaps the Europe picture looking better thanks to progress on COVID vaccines. Francine?
Danny, thanks so much. Our Danny Berger there with the very latest on what we're seeing in ETFs. Now, it's a bumper harvest for stock investors in November so far. 8.8 billion euros has flowed into European-listed equity ETFs, putting them on course for their best month this year. Now, stock ETFs have gained 8 times more cash than fixed income. So let's get more, of course, on all of this. So joining us now is Hector McNeil. He's co-founder and co-chief executive of Han ETF. Hector, thank you for joining us. What are the quirks that you're seeing out there in the markets?
Yeah, very interesting times, I think. Obviously, the US elections has meant that the markets have got more bullish again, expecting, obviously, some stimulus in the not-too-distant future. But essentially at hand, we're seeing a lot of interest in thematic tech. That's definitely been the case. We have an equally weighted global mega theme product that's seen a lot of volumes into that. We've had a lot of interest into our Bitcoin ETF, BTCE, since we launched it 4 months ago. It's taken about 150 million of assets, which is pretty spectacular. And actually, funny enough, it's the most traded ETP on the Deutsche Börse this morning. So we're seeing a lot of those sorts of flows. Gold's been steady, seen a little bit of outflow in gold, but we expect that to arrest itself when gold finds its levels. But certainly interesting times.
Hector, when you look at some of the volatility out there, and so as you say, interesting time for the markets, does it actually increase the amount of interest in Europe of ETFs? How is this market in Europe, which is really still very small compared to the United States, increasing because of the volatility we're seeing?
Yeah, I mean, I think you're right. I mean, I think we're relatively small. I mean, funny enough, when I started in ETFs 20 years ago, the total market was about 50 billion of assets, and we're over $1 trillion now. So small's always a relative comment. But what I would say is obviously the sort of futures equivalents, the FTSE 100s, the S&P 500s, Euro stocks, etc. They tend to see the volatility when the markets are moving around a lot. And during times, with obviously the macro stories going on at the moment, you're always going to see a lot of that activity, particularly when you have a US holiday like we've got with Thanksgiving, where volumes can be a little bit thin, and you can see extra volatility come in from that perspective. But also, I think what I've seen is a nice trend in the ETF market probably over the last sort of 3 to 5 years is you're getting more what I call investment-related products. So less about market access and trading and more about long-term investments. And, certainly the flows into those products are coming thick and fast. And certainly we're seeing those sorts of exposures, replace the mutual fund wrapper. And therefore those products trade a little bit less and the assets are a little bit more sticky. So I think it is quite a shifting paradigm over time. And I think you'll see more of those sorts of assets flow into sort of smart beta, active, thematic and niche type ETFs as the market moves to that level. And I don't think there's any reason why we can't see Europe accelerate. I mean, if you think about it, Europe's double the population of the US, similar wealth demographic, similar sorts of problems on aging populations, etc. Digitalization of investment. So there's every reason why Europe should catch the US up in the not too distant future. And actually, if you look at it from an issuer's perspective, Europe's probably got the exponential growth. You can see how it can move from $1 trillion to 4, 5, 6, 7 trillion, where the US is probably not going to go far, in terms of exponential rises. It's at 6 trillion now. It probably can see 7, 8, 9, 10, which obviously is a fraction of percentage growth that Europe can achieve. So I'm pretty bullish about Europe from a growth perspective. And I think in lots of ways, if you take the Bitcoin story, for example, we're leading the way, when we're providing products that the US doesn't have yet, so in some ways, Europe's a little bit more innovative as well.
All right, Hector, thank you so much. Hector McNeil there from Han ETF stays with us. Now, coming up shortly, we'll look a lot more, of course, at some of these Bitcoins and the Bitcoin roller coaster. Cryptocurrency exchange-traded products in Europe have now topped 1 billion euros in assets. That's despite a UK ban on selling to retail investors. So we'll have more on that next. And this is Bloomberg.
I'm certain that we will be able to bring our debt levels down and avoid what you could call a debt crisis because we're focused and we've been open enough by telling the nation that we have too much debt.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacroix. Now let's talk about Bitcoin. It's back in the headlines. Cryptocurrency exchange-traded products in Europe have now topped 1 billion euros in assets. Now, inflows have surged since October, but with the coin's price proving highly volatile yet again. The flows have come despite regulators in the UK, the region's biggest ETP market, banning the sale of crypto-related derivatives to retail investors. Well, let's get more with our Danny Berger. So, Danny, what exactly was motivation behind the UK's move to crack down on cryptos?
Francine, what the FCA has said in this announcement they made last month with this ban that goes into effect in January is it's all about protecting the retail investor. So what they've done is say that any of these derivative products that track cryptocurrencies, and that includes exchange-traded notes, will no longer be allowed starting next year. They said it has no value for ordinary investors. They say it'll prevent about £53 million a year in losses. Now, I should say the ban doesn't prevent buying cryptocurrencies itself. Again, it's just these derivative products that track the movement of the prices of the cryptocurrency assets themselves. Now, the ETP community certainly has had some backlash to this decision. Coinbase, which is one of these crypto ETP providers, had one of the first to market, said that this is going to do instead of protect retail investors is just move them on to less regulated exchanges versus perhaps a more regulated exchange-traded product market, Francine.
Danny, given the restrictions, how much has the space been growing recently?
Yeah, well, certainly these restrictions really haven't prevented us seeing this balloon in crypto assets. Of course, these crypto ETNs, they've yet to have any of them approved in the U.S., but in Europe, their assets have surpassed 1 billion. Bloomberg Intelligence says that this is really a key threshold to show that these assets have staying power. And look, more products continue to launch. Just on Wednesday, VanEck announced that they're introducing a crypto ETN into the market, a Bitcoin one that's going to be listed in Germany. It already has $2 million in assets. It's fully invested in Bitcoin. That means that they're going to have a crypto custodian, which puts these in what's called cold storage. It's supposed to help it protect against some hackers. And VanEck, really echoing some of the sentiment about this push and pull between regulation and assets, says that there is staying power, that the next phase of growth in Bitcoin assets are vehicles that fit into the already established and regulated market. So providers certainly trying to thread that needle, Francine.
Danny, thank you so much. Our Danny Berger there was the very latest on this. Now, still with us, Hector McNeil from Han ETF. Hector, we were talking a bit before about cryptocurrencies and actually, the wild ride that we saw in Bitcoin. What does it mean for it playing out on ETFs?
Yeah, what I think is really important when you've got an asset class that's difficult to access, ETPs tend to be a fantastic vehicle to put regulation around that and to put protections such as central counterparty clearing, price discovery, centralized liquidity, trustee structures to ensure that the assets are maintained and looked after properly. And as you mentioned before, there are very secure custody arrangements now, including insurance perspectives. And I think when we listed BTCE on the Deutsche Börse, what was really exciting about that was not only did we get the products in the market in a regulated exchange, regulated market, central counterparty for the first time. The German government actually approved cryptos as financial assets officially, and I think that was very far-sighted by the German government because it sort of recognised the fact that money was flowing into these unregulated markets. And let's be clear, the FCA's banned these regulated products, but it hasn't banned the trading of underlying cryptocurrencies, which I think is a bit of a retrograde step for the market because the one thing about having a regulated product is to access that you have to go through a broker, and if you go through a broker, they have to take suitability decisions and have regulation around what their clients can and can't use in their portfolios. What's interesting about the FCA's decision is it doesn't stop brokers classifying their clients as professional clients, and then they can therefore buy the ETP still, and we're still seeing a lot of interest in BTCE as a result of that. The one thing I've seen that's really interesting over the past couple of weeks, I mean, I was at ETF Securities when we invented gold ETFs, and I see the track and trajectory of Bitcoin ETFs is very, very similar to that when we invented gold bullion securities back in 2002. So I think that the interest we've seen very recently from multi-asset sort of UCITS funds has been phenomenal. And I think those guys are just about to turn on the taps. So we mentioned like $1 billion was important. I can see tens of billions of dollars going into this if the multi-asset funds get involved. So I think it's really exciting times for cryptocurrencies.
Hector, how do you see cryptocurrencies? I mean, you say it's exciting times, but actually, what is it?
Well, I think what I see it is essentially digital gold. I mean, what's been very interesting is you've seen the tracking the flows of gold, ETCs and Bitcoin, and you can see that there is some substitution effect going on for people seeing, the scarcity value of Bitcoin in particular, being a store of value and being an alternative to gold. So I think that's essentially what people are seeing as an interest in Bitcoin, and I think it really is just the tip of the iceberg for the digital economy. Really, I think it really sort of plays into the generations that have grown up and lived with the internet, and certainly I see Bitcoin and cryptocurrencies as a product of that. And I think there's a degree of maturity now as well, because obviously, probably, several years ago, it was probably seen as, extremely out there and, very difficult for the average person to understand. But I think it's crossed that threshold now and has gained a degree of acceptability and understanding. And, investors vote with their feet, so if investors want to trade and have access to these asset classes, then really they're going to trade them, whether they're in a regulated product on a regulated exchange or as they can do through the underlying crypto markets. So I think it's incumbent on regulators to look at that and make sure that they provide the most robust environment for investors to actually do this. And that's what I think is missing at the moment.
Hector, in terms of other thematics, what are the big trends? We talk about ESG day in, day out. Is that being overdone? Is there something else that you would look at?
Yeah, well, ESG is an interesting one, isn't it? Because it's a very broad church. I sort of divide it in, I always look at the world simplistically, and I divide it into to sort of low, medium and high. And I think the ETF market's doing terrifically well at the low end, which is really, giving the sort of minimum level of investor need for ESG. What I think you will find over time is more at the sort of middle to heavy end, impact investing and voting rights and things like that. I think ETFs have still got to grapple with that. Certainly we'll see. I mean, we've got plenty in the pipeline. I mean, interestingly, Hans' business model is we don't do any of our own IP. We work with other third-party asset managers, and we've got several very interesting ESG products coming out, which will look at the world a little bit differently than the sort of bulk standard MSCI type approach, and that will also include ETFs in the active management space as well. So, and that's where I think it will be getting quite interesting in the ESG space. One of the other areas we're seeing a lot of interest in is
finish off and then we'll come back to it.
So finish off on ESG. So I think I think there will be a lot of products. I mean, I do think in 5-10 years' time, we won't even be using the term ESG because I think all products will have that automatically built in. But obviously, we're going through that transition and that journey now. So I'm really excited about the ESG space, if nothing else, for being a human being and wanting, industry to play its part in terms of managing the planet and its resources.
Hector, thank you. Hector McNeil there from Han ETF stays with us. Now, coming up, as the price of crude crashed below zero, Wisdom Tree shuttered its leveraged ETPs. Now, that was a while back, but now they're already making a comeback. More on that next. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, let's get back to some of the things we're seeing in the markets, and it's a remarkable comeback. WisdomTree was forced to shut down its leveraged exchange-traded products linked to crude oil earlier this year when the commodity's price plummeted below zero. But after just a few months, the company says it's bringing them back due to significant investor demand. So let's get the story with our oil trading reporter, he's Alex Longley. Alex, how have WisdomTree now been able to bring back these products?
Well, it's a story of two markets that have recovered. Firstly, the oil space has obviously moved a long way from those days turning below zero earlier in the year. And now that headline prices are much less volatile, sort of anchored in between $40 and $50 a barrel, that's giving funds like ETFs a better underlying asset into which they can invest. And as well as that, the ETF space, which had sort of quite the shakeout as we saw that turn into negative territory, it's also had to adjust. So most of the ETFs, including these 3 times leveraged products that WisdomTree is relaunching, are now holding contracts further along the crude futures curve to try and stop themselves being subject to any wild swings that we tend to see in day-to-day headline prices. So with those two kind of marrying up together, it seems as though WisdomTree is now kind of bowing to the investor demand to have high leveraged oil products again.
And we're sure that things are different this time around.
Well, you'd like to hope so. I mean, clearly the market dynamics are very different. There's no pump at will from OPEC. If anything, there seems to be a broad kind of agreement that the record production cuts that they've embarked on are carrying on. And even with lockdowns returning here in Europe, the hit to demand hasn't been anything like we've seen earlier in the year. So from the market side, people certainly aren't expecting a return to below zero. From the ETF side, perhaps it's a trickier picture. These funds still have, for example, clauses that would force them to move even further along the curve if there was a risk of going below zero. And as ever, most ETFs, once they near zero value, would also kind of force liquidate. So they're not necessarily totally out of the woods, but I think it's clear that the underlying market picture is vastly improved from where it was a few months ago. And that's what's enabled such a quick turnaround from ETFs deleveraging in the oil space, cutting down on their exposure to leveraging back up again.
Alex, thank you so much. Alex Longley there with the very latest on some of the oil ETFs. Now let's get to final thoughts from Hector McNeil from Han ETF. Hector, I guess the concern is that if you're seeing much more products related to what our reporter was just saying about oil products, how do you match it up with demand for ETF? Sorry, with ESG, demand with ESG. How do you match up oil demand with, renewables?
Well, I don't think you do. I think I'm a sort of, from a personal perspective, I believe in the sort of transition process. So rather than jumping from renewables to directly out of carbon carbon fuels, I think you've got to have a transition process. So I think you've got to be realistic and realise that renewables can't be 100% of the answer. I do think we need to accelerate it, but I do think for decades to come, fossil fuels are still going to have a role to play. Hopefully we can be cleaner on that and we can be better. But I think that investors do want access to those markets. Funny enough, the 3 times leverage oil product was one I created when we were at Boost, which Wisdom Tree then bought. So I've always been a strong proponent of those sorts of products. But obviously, in the right hands, they need to be. The investor needs to understand what they're doing and why they're doing it. But I think there'll be a long time for the future to have fossil energy related products. But obviously, as I say, there will be sort of that transition process, and I think investors will take a view. The Northern European the investor is, the more likely they're going to want to go more the green route. And I think the Italians in particular love energy, so I think they won't be stopping trading that anytime soon. And I think it's for good returns as well. I mean, we have an MLP product.
Great, Hector. Thank you so much. Hector McNeil there, co-founder and co-chief executive of HAN ETF. Now, we'll have plenty more, of course, on ETF throughout the week. For now, it is goodbye. That's it for this week's Bloomberg ETF IQ Europe. We'll be back with much more. That's next Wednesday at 9:30 a.m. London time. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Tightening curbs, Chancellor Merkel extends Germany's partial lockdown for at least 3 weeks as the country struggles to regain control of the pandemic. Brexit breakdown. France accuses the UK of dragging its feet on trade with the EU. And drop the debt. An Italian government official tells Bloomberg the ECB should consider cancelling bonds bought during the crisis. Good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacroix. Here in London, Tom Keane off to celebrate in the U.S. as they celebrate Thanksgiving holiday. Of course, Tom in charge of cooking the beast. It's humongous, but he has promised photographic evidence of him at the barbecue. Now let's get straight to the Bloomberg First Word News. Here's Leanne Garrett. Hi, Leanne.
Good morning, Francine. It is the apparent close to a long and bitterly fought criminal case involving President Trump's first national security advisor. The president has pardoned Michael Flynn, who had pleaded guilty to lying to FBI agents about his talks with the Russian ambassador. Conservative allies had portrayed Flynn's prosecution as evidence of a conspiracy against the president. Now, the Trump administration is considering a move that could boost travel. Several agencies are urging the White House to lift an entry ban on non-U.S. citizens arriving from Europe. It was put in place to slow the spread of the coronavirus, but the ban has caused big losses for airlines in the transatlantic market. In Germany, a partial lockdown has been extended for at least 3 weeks to just before Christmas. Chancellor Angela Merkel is trying to gain control of the latest coronavirus resurgence. There are tighter limits on private gatherings, but German schools and most businesses will remain open. And France is accusing the UK of dragging its feet over Brexit. The French foreign minister says the outcome of discussions on a new trade deal is highly uncertain. Negotiations are to resume soon here in London. The UK is set to leave the European Union at the end of the year, whether there is a trade agreement or not. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Of course, everyone who's watching us near and far, especially our American friends, happy Thanksgiving. We know it's an important holiday for you, and this year a little bit different for everyone. Now, global equities are heading for a fresh record high on Thursday. The dollar steady near its lowest level in more than 2 years. Bitcoin tumbled as much as 8.7%. Of course, if you look at Treasury futures, they're edging higher as the cash market, though, is closed with traders off for Thanksgiving holiday in the U.S. And just a reminder of what we heard yesterday, we really had a deluge of data, bringing the first back-to-back rise in weekly U.S. jobless claims since July, an uptick in durable goods orders, a widening trade deficit. And you can see the rally taking a bit of breath in Europe this morning, pretty much flat, and then gold, 1,814. Now, joining us to talk about the markets and maybe his Thanksgiving recipe is Jeff Yu. He's BNY Mellon Senior Strategist for EMEA Markets. Jeff, I'm kidding. I'm not going to ask you about Thanksgiving, but I will ask you about what's going on in the markets. Is there too much optimism about vaccines? Is there too much optimism about a longer-term recovery and not enough focus on what we'll live through the next couple of months?
Well, you're reminding me of my good old days in Minnesota for very large turkeys there. But in terms of where markets are, I wouldn't say there's too much optimism about vaccines, but I think markets just need to actually take stock of what's going to happen between now and when the vaccine comes on a widely available basis, right? And with the US data that you mentioned from yesterday, and with the Riksbank, just announcing the greatest stimulus, for a country that has generally not been closed, throughout the pandemic, these are still worrying times. What Chancellor Merkel announced, a lot more economic pain is going to come, before we actually reach that end of the tunnel.
So, Jeff, is there anything that's mispriced in the markets? Or are we going to see about a lot more volatility?
I wouldn't say volatility per se. When we identify mispricing, one thing that we are looking at as we head into 2021 is whether there's a chance of having some inflationary impulse come through, but without the growth. So it's starting to sound like a bit of a stagflationary scenario. Now, these drivers for inflation, they're not necessarily going to be, genuine signs of reflation and bigger investment pickup, but just supply chain disruptions and how our economies have shifted, our entire inflation baskets have changed as well. Certain services moving higher more than others, and also deglobalization, and that's going to be a trend that will continue for many, many years to come. So that that's something that central banks may need to be a bit concerned about, where you actually do get the price gains up ahead, but without the corresponding income gains, and that is not a very good mix. So it's something that we are watching up ahead, and I don't think bond yield curves are actually pricing for that yet.
Yeah, what happens to inflation in that kind of scenario?
So inflation, could actually start to surprise them, to the upside. Though it's important to know, what our starting point is, right? So for places like Europe, for example, and Japan, your starting point is quite low. Market expectations are quite low anyway. It doesn't actually take much for inflation to surprise to the upside there relative to where it was in the past. Whereas in the US and the UK, where there's higher inflation impulse, that actually may not surprise markets as much. But again, it's not about inflation per se. It's can we have inflation and income growth at the same time? If so, then happy days, risk on. If it's only one whereby we do have stronger inflation, headline prices, but jobs are still problematic, the income growth is not following through, then I think markets will not like that. Stagflation, never good for risk appetite.
Jeff, if we do see inflation, where do you see it first?
I think we will start to see it in terms of price push, right? So we will see it in goods which have seen supply chain disruptions. And I think a very good example will be, what happens to transport costs when really we need global vaccine distribution, right? So, these transport supply chains, that have been affected greatly over the last few years or so, over the last few months or so. And we may actually find out the cost of distributing this may rise, and could that be channeled through across the rest of the market? And again, certain services, we need to pay more for our food and veg, not because the price of the underlying is actually going to increase, but again, the supply chain costs, the transportation costs are going to go up. Certain services provided, so at home, right now, what we pay for software and what we pay for subscriptions, are they going to have to go up because of the investment involved? But on the other hand, there are areas where we don't have to pay as much. Every year in the UK, we look at how much rail fares are going up. When was the last time you actually bought a train ticket, right? I haven't bought that many over the last 6 months or so. So things do balance them out. But again, I would be looking at areas where we could see significant supply chain disruptions. And I think transport would be a very good place to start, and also followed on by just general services.
And Jeff, this is what transport worldwide, or is it also something to do with stimulus in the US?
Well, it's interesting you mentioned this stimulus in the US. Can stimulus in the US actually help or affect the rest of the world? And actually, the short answer is no, because for the US, because it's more of a closed economy, trade as part of GDP is actually a bit lower. So you don't. So the stimulus dollars spent in the US actually tend to stay in the US. Now, the question is, in what form is that stimulus going to come through? Is it going to be money directly into the pockets of households, which is considered a good thing, or is it going to be come as a mix of help for corporates or otherwise? Now, for corporates, you may actually see support, but are they going to invest that in a way which helps the salaries of the underlying workers? If it doesn't, and if all it does is actually let's say raise costs through a demand push by the corporates, that may not be conducive to the economy either. So let's see what the Biden administration comes up with when these discussions do come in place. If we recall what happened in 2009 after Obama's first year, where that stimulus came through, a lot of it was basically helping with wages, checks to households. I think something needs to match that if we're going to make this stimulus work.
Jeff, when you look at some of the concerns that we've had in China, especially because of defaults and some of the things out there, what do you do with renminbi? Are we, too optimistic? I feel like the Grim Reaper. I'm always saying, are we too optimistic about this? Where's the concern? What are you worried about? But is there a danger that we're underestimating some of the fault lines in China?
So from the corporate defaults point of view, some of these have been actually quite well flagged. And one important thing to note is that this is generally considered healthy by China's regulators, right? Because there's been a notion that risk has been mispriced, for a long time with implicit guarantees. Now, every time there's supposed to be a default, then a white knight comes in, or there's an arrangement where a best principle is protected. So the regulators have always hoped that there can be an introduction of risk to investors, as long as it can be done on a managed basis. So I would actually see this as a positive development for the Chinese market. Now, because most of the investors are actually onshore for this, there's no direct link up to the renminbi. Having said that, will the renminbi start to reach valuations what makes it somewhat uncomfortable for the People's Bank of China? Absolutely. So I'm watching the language there closely. Just recall, last week, for example, we had Indonesia, Philippines central banks which cut rates unexpectedly, and citing the concerns about inflation. Clearly a stronger currency has something to do with that. So while I do like the renminbi stronger from these levels, I would be very, very cautious and just note what the inflation numbers are saying, and also just be very mindful of the PBOC's language. I don't think they want to repeat what happened in 2015, where clearly there was an overshoot of valuations, and to get out of it, it was actually very volatile, not just for China, but for markets in general.
Jeff, thank you so much. Jeff Yu there of BNY Mellon stays with us. Now, we'll have plenty more, of course, on the American economy, on the Chinese economy, and also some of the concerns here in Europe. We have that little thing called Brexit coming up. Now, also coming up, Leslie Benjamin, Chatham House head of U.S. and America's program. We'll talk about presidential pardons, and we'll talk about transition. This is Bloomberg.
What moves the human spirit, what transcends time, comes from true craft, the artistry of Japanese craftsmanship. Presage Seiko.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts He has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
eve of Thanksgiving. Well, let's get back to Jeffrey Yu of BNY Mellon, who's still with us. Jeff, so we're in a transition period, just in a transition period. The politics in the U.S. is a bit more stable than maybe what the market was expecting, although, frankly, at times you wonder exactly where they're going. But what does it mean for the markets? Does it, we have Janet Yellen as Treasury Secretary. How difficult will it be for her to get the right amount of stimulus, or does the amount matter less and where she's going to put it?
So firstly, I think markets are just waiting for the Georgia runoffs to see where the Senate is going to lie before making a final determination. But beyond that, I think the general view is there will be a strict limitations on what Janet Yellen and what Joe Biden can do up ahead anyway, given the strong bloc within the Senate. I think that there are areas of consensus that can be reached in terms of a stimulus for the country. I think where the biggest in general, can they meet halfway? We shall see. But the key is, hopefully, there can be agreement that something needs to happen very, very quickly. We don't want to wait until we go from 2 weeks worth of higher claims to 10 weeks worth of claims, because by then you're basing things on backward-looking data, and perhaps it's going to be a bit too late, right? So you always want to front load and also be proactive on stimulus, seeing stuff up ahead, rather than react to what's already happened, because businesses certainly are going to plan ahead. They can't wait. They're not in a position to do so. So speed for me right now is actually much more important, than how, but also amounts matter as well. You can do something quickly, but if it's small and it doesn't make enough of a difference, that's going to be problematic too.
Jeff, we're also getting some breaking news, or actually some headlines from Vladimir Putin, the Russian president, saying he will congratulate the elected U.S. president when the vote is final. I'm not 100% sure if exactly what he's expecting or when, but it's certainly very telling about the relationship that Russia could have with President-elect Joe Biden. When you look at what the market hopes that a Biden presidency will bring, I guess back to multilateralism, maybe more globalization, are we underestimating what he needs to do at home? Are taxes going to go up? How much reform will he be able to do?
Well, it's interesting you mentioned taxes going up, because I was waiting to hear what taxes are going up from Chancellor Sunak's statement yesterday. So I think he was a bit coy, on that. But there will need to be a reckoning, on the fiscal situation in the US and globally anyway. So I think that's going to be a conversation for next year, as maybe part of the fiscal process. But you mentioned globalization. I think markets really need a reality check on how Biden will be committed to globalization, especially in an economic context, right? So in terms of multilateralism, with defense, with NATO, I think he's been clear on that. With climate change, with the Paris Agreement, he's been very clear on that as well. But let's take trade. WTO, now the WTO's appellate body doesn't have enough judges. When did that process of withholding confirmation of judges begin? That was actually under the Obama administration, right? So Biden was part of that administration, which essentially started to hold back trade multilateralism. The Doha round, which actually went through the Obama administration anyway, it went nowhere. So on trade to pick up. So I think for the rest of the world, we have to be braced for the same. For an EU-US trade deal, I really don't think that's going to be high up the agenda either.
What does it mean for Brexit, Jeff? We've managed to get through 20 minutes of the show, and I didn't even ask you about Brexit.
Yeah. Well, that's a new record, isn't it? So now one interesting change language I've detected, soft landing, if I may use that. I think there is momentum still towards a deal, but as we get towards the latter stages, conversations are always going to be difficult. But as always, for the EU and for the UK, they're going to be trying to be creative about it.
So what does it mean for UK assets?
Well, actually, for UK. Here is one fiscal. It's not been a scheme on, taper, off, and then back on again, but still time limited. So I think on the fiscal side, that we're going to see. So even after yesterday, there will be some scarring, there will be damage. Secondly, and more crucially, Bank of England's been consistently, I think, overestimating how strong the UK economy will be, how resilient the economy will be, but data is going to disappoint to the downside. And as a result, more easing is going to be on the way as well. Through QE, I don't think there'll be negative rates in the near future, but QE and a weaker sterling, both of that will be important parts of BOE easing, and I think growth will necessitate it. So next year, if we're right on European reflation and growth and with fiscal in place, and also in the US as well, I think that's where the UK is going to start to underperform.
Jeff, thank you so much. Jeff Yu there, BNY Mellon, Senior Strategist for EMEA Markets. And again, happy Thanksgiving to each and all of you. Now, coming up in the next hour, Sebastian
And we need it relatively quickly because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures because you have no other way at the beginning. This is your best weapon and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Leanne Gerrans with this Bloomberg Business Flash. Salesforce could buy workplace chat tool Slack. Bloomberg has learned that companies have been holding talks and could announce a deal as soon as next week. The news sent shares of Slack up as much as 34%. It would be the biggest deal ever for Salesforce. Slack has a market valuation of more than $23 billion. A cryptocurrency boom turned into a mini bust. Bitcoin and other digital currencies have plunged by double-digit percentages. That is likely to stoke speculation about the durability of the rally. Even with the retreat, Bitcoin has more than doubled this year. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now we're looking at, of course, live pictures of Buenos Aires, where yesterday football lost a real legend. Diego Maradona lying in state in Buenos Aires. His body will lie in state at Casa Rosada, the presidential palace in Buenos Aires. And we have just seen 3 days of national mourning beginning in Argentina after Maradona died yesterday at the age of 60. We'll have, of course, plenty more on that with a bit of a hustle as well. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements we can actually have the superb measurements that we expect of sea level rise, but also the waves, the significant wave height, which is the top 1/3 of the waves if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Chinese capital market, as you know, is nascent, is just developing, and so we think there's an opportunity to build out that. But that's not all. We're also focused on continuing to build our presence in the Greater Bay Area. It's been a good business for us.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, let's talk about Brexit. And France is, of course, accusing the UK of dragging its feet in Brexit talks amid stalling trade deal discussions with the European Union. The French Foreign Minister Jean-Yves Le Drian calling on the UK to abandon tactical posturing. Now, for more, let's bring in our Bloomberg Brexit editor. He's Ed Evans. Ed, as always, thank you. Look, this is, how much of this is political posturing? It's, barbed wires being traded. Barnier says he's no longer coming to London. What do we actually know about what's going on underneath? Do we have a deal? Will we have a deal, or there are still red lines?
Still red lines. Just to back up a second to the first question, yes, there's a great deal of posturing going on. I think you've got to read Le Drian's comments in the context that he was talking for a domestic audience in the Foreign Affairs Committee when he made those remarks. In terms of where the talks have got to, we're in a bit of a limbo period at the moment. Last week, if you remember, one of the EU negotiators was tested positive for COVID, which meant that Michel Barnier, the EU's chief negotiator, had to go into quarantine. And that's really delayed things because they've had to suspend face-to-face negotiations for the time being. Now, we expect those to resume fairly shortly. There'll be a question, as you say, there's been a threat from Barnier that he won't come to London if the Brits don't move on things. But we'll see whether they do come to London and whether over the next few days they get a deal. And if they do, one would expect that to be at some point next week. The thing to remember here is the one deadline that does not move in all this is December 31. That's when Britain leaves the EU single market at the end of the transition period. The deadline that is squishy, as it were, is the deadline, is the point at which they have to reach an actual agreement. If you remember, they were originally hoping to reach this deal back in October, then it became mid-November, then it became late November, then it became, maybe the first week of December. There's still, any deal that is done will have to be ratified by both the UK Parliament and the European Parliament. That is a process that takes time. It can be compressed, and you can see the European Parliament moving to a vote on this maybe even as late as the 28th of December. But, of course, that introduces another risk to this, and that's the risk of, is there a problem in ratifying any agreement that even if one is struck?
Ed, what strikes you at this moment? Are British companies prepared for no deal, or has this dragged on for such a long time that actually companies that needed to move have already moved? I know we spent a lot of time talking about financial services. What do you do with manufacturing companies? Like, if there was a no deal, and I don't know whether it's 50-50 in your eyes, are we ready for it?
I think if you look at the surveys, it is clear that businesses are in the main not ready for it. Don't forget, they've been grappling with COVID for a great deal of the year. A lot of the stockpiles that they run up in preparation for, if you remember, last time we were at a Brexit vote at the beginning of the year, the vote for no-deal Brexit, those have been run down over the course of the year. There are big concerns over whether the border processes are going to be ready and whether companies are going to have the paperwork ready. And they're going to need that paperwork whether there's a deal or not, by the way, whether they're going to have the paperwork ready to get trucks over the border, whether there'll be delays on agricultural products, and so on and so forth. So there are very big concerns. Ironically, finance, I mean, it's been quite clear for some time that they haven't been given an equivalence decision. And those firms have really been pulling people out of London and assets out of London into the EU already. So it may be that that industry is rather better prepared than, say, manufacturing or those shifting, those companies involved in actual shifting goods on the backs of trucks round the EU.
But they're less prepared because the government has prepared them less. So does that point to the government, still hoping for a deal, or again, are we just looking at smoke signals?
Well, I think at the moment, the great problem for business, they don't know what they're preparing for. is it a no-deal Brexit? Is it a deal Brexit? Is there a trade deal at the end of the year? Now, that has huge ramifications for what kind of paperwork, what kind of processes are put in place. So that's part of the problem. The other part of the problem is that businesses with people on furlough and with lockdown, they haven't had people physically in the office for a lot of the time able to think this kind of stuff through. So you've got problems there. You've also got a problem with the government. They've been telling business to prepare. And you can see the beginning, obviously some in government are very concerned that there could be enormous tailbacks at the ports of Dover and at the Eurotunnel terminal come the turn of the new year. And you can see government in the last few weeks has been very clearly basically telling businesses it's on you to prepare. It's businesses' responsibility to prepare for the outcome. And of course, a lot of businesses are quite unhappy with this because essentially they're being told it's on you to prepare for a situation of which you have no control, and the government still can't tell you, with 30-something days to go, what the outcome will be.
Ed, we spoke to you, I think, last week, and it was a couple of days after Dominic Cummings left Downing Street, and now we have President-elect Joe Biden also, in the White House come January 21st. What does that mean for Boris Johnson?
That has implications for the Northern Ireland Protocol. If you remember, one of the big political arguments in the first phase of Brexit, as it were, when we were signing the withdrawal agreement, was how do you avoid putting a hard border in Ireland? And if you remember, Boris Johnson agreed essentially to put the border in the Irish Sea. Now, it has been quite clear with the Internal Markets Bill that the British government wants to rewrite that agreement, at least in part, and that has sparked concern in both Ireland and with Biden that this could effectively impinge on the Good Friday Agreement. Now, the other point of this, of course, is the UK really wants to get a trade deal with the US after Brexit, and that had been moving forward under President Donald Trump. And if Biden is there, Biden's linked it very clearly, a trade deal very clearly to Britain, Britain respecting the Good Friday Agreement. So there is a question with the Northern Ireland Protocol, and particularly with the Internal Market Bill that Johnson's putting through. This is the legislation essentially to rewrite it. How far does he push that? If he gets a deal, a lot of that can fall away. But if he doesn't, how far does he push that without and jeopardize a US trade deal?
Ed, thank you so much. Ed Evans there, who, of course, manages all of our Brexit coverage. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Trump administration plans to keep up the pressure on Iran during its final days in power. The U.S. sanctioned 5 companies in China and Russia for their alleged dealings with Iran's missile program. More sanctions on Iran are expected in the coming weeks, related to weapons of mass destruction and human rights. It looks as though China will not meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of U.S. products slowed last month after hitting a high in September. As of the end of October, China had bought only 44% of this year's target of $172 billion in American goods. And a divided U.S. Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. He wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against those limits. Chief Justice John Roberts joined the court's liberal wing in dissent. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
generation's biggest problem.
Climate change.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with interactive brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
Deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Chief economist, that's at 11 a.m. in New York, 4 p.m. in London. Bloomberg Surveillance, and I'm Francie Lacqua here in London. Let's talk about U.S. politics. And U.S. families are facing a financial chasm as coronavirus aid expires. That's a warning from one of the President Trump's senior economic advisors. Peter Navarro made the comments to Bloomberg as he called for Congress to reach a deal on a new stimulus package.
We have profound structural adjustments that are primarily hitting our major metropolitan areas. And restaurants, office buildings, the transportation sector, all of these things are going to change in ways which probably won't snap back to what they used to be. So we're going to have to figure that out. My own view is, and this is consistent with President Trump's philosophy, is that in order to offset the lost service sector jobs, we're going to have to make it up in manufacturing jobs. And that means bringing more of our manufacturing here. But, you know, one of the bad news is part of the data was that our trade deficit went up. Our trade deficit's going up because we're buying more than we're selling. Part of that is because we are recovering faster than much of the rest of the world. But over time, what we got to do is create jobs here, and our best shot is going to be by creating manufacturing jobs, kind of in the Trump image, where particularly for blue-collar Americans.
Precisely, but I mean, you know, The Economist, and I'm on my Bloomberg terminal right now, and it says Wednesday's data indicates that the economic rebound is becoming more tenuous amid soaring coronavirus cases, fresh lockdowns, and an extended deadlock in Congress over a new stimulus package. The markets are anticipating that there's going to be additional stimulus. I don't want to go to the talking points of Republicans versus Democrats on why there hasn't been a stimulus deal, but how do you, well, for both of us, but how do you actually break through this? Because you're staring down a December 11th deadline to keep the government open. You've got coronavirus cases. Respectfully, the data disagrees with you that it's just impacting the cities. It's impacting the heartland just as much. So how do you actually provide this assistance, not in terms of long-term restructuring, but right here and right now?
Yeah, well, these are the questions. And I think the conversation you and I and Taylor are having is the way, I think, to break the impasse, because we're having, I think, an intelligent conversation about what I describe as the second derivative problem. The first derivative, it looks like things are still getting better, right? But the second derivative is they're getting better at a slower rate, which means eventually that flips. So what I see ahead is a chasm as all of these programs expire and we struggle with these structural adjustments. I take your point that the heartland's hurting as well, but I would say that it's the major metropolitan areas that disproportionately are suffering pain in these service sectors. But the point, Kevin and Taylor, is that let's have this conversation. What I'm sending out as a message to you and the American people today is we can see what's coming. And if we can see what's coming and it's bad, we need to be able to avoid it. And the way to avoid it is basically hit those 3 points of the compass in a phase 4 deal, which was the PPP small business loans, a stimulus check, and more relief for unemployed workers. And if we don't do that, there's going to be a lot of pain in America, particularly. Look, and this is these lockdowns are a regressive tax, meaning that they hurt the people least able to afford it the most. These are the lower income service sector workers that have been kicked to the curb by the virus from China. And you know, we intelligently, now the election's over, We as a country have to look at the chessboard and figure this out.
Presidential advisor Peter Navarro there speaking to Bloomberg's Kevin Surley and Taylor Riggs. Now, to talk a lot more about the U.S., we're delighted to be joined by Leslie Vinjamuri, Chatham House head of the U.S. and America's program. Leslie, thank you for joining us, especially as I know it's a big day for Americans on Thanksgiving. When you look at some of the things that we've seen, Leslie, what's more incredible in your eyes? Or is it the spat between the Fed and the Treasury Secretary that could actually mean that the new Treasury Secretary could have a hard time in accessing some of the funds? Or is it something else?
Well, I think it is exactly this. We're in the middle of a transition. It's finally now formally a transition that's taking place to President-elect Biden. And yet the situation in terms of getting closer to that stimulus and a broader economic package to really help the recovery is actually getting worse. And the virus, as we know, is getting much worse. The stories are quite shocking. Not only the number of Americans who have very tragically died, but the number who are now infected. The stories of states having to send patients to other states because the hospitals are full. This has clearly hit the American Midwest, but it's hit many, many states. So I think, the mixed messaging has been a problem throughout, but now we have a President-elect Biden who is trying to really take control and deliver a clear message on not traveling on Thanksgiving, on masks, but facing a very difficult situation. And again, that fiscal stimulus just looks further down the road. The moves from the Secretary of the Treasury not looking promising for, the broader economic recovery. And the tack on China and the bilateral trade deficits just seems like the focus is not really in the right place.
So, Leslie, how, if you look at the Trump administration or the people around President Trump at the moment, how much more difficult will they make the transition? How much more difficult will they make it for the Biden administration?
Well, I think this is, the real concern. Clearly, on the economic front, there are some really critical deadlines, and we're seeing those. But on any number of dimensions, we've watched what's happened at the Pentagon. I think there's real concern that on the military and security side that we might see a more rapid drawdown of troops from Afghanistan that could lead to some unintended consequences that put the next administration in a difficult place. It is a very competent set of individuals who are coming into position with deep experience, knowledge, relationships globally and across Washington. So they're as prepared as they can be. But I think right now, that incoming administration is every day waiting for the other shoe to drop, not quite sure what they will be faced with beyond America's borders, when clearly the number one priority is really what's going to happen at home on the health and economic front.
Leslie, when you look at some of the, questions out there, how do we, or what do you think Joe Biden needs to do to make the over 70 million people that voted for Donald Trump feel included?
So this is a clear concern, I think, for all Americans. We've seen the millions of Americans who voted for President Trump. I think there are, first of all, we have to be very clear not to make assumptions about why people voted the way that they did. Not everybody who voted for Donald Trump did so for the same reasons. But clearly they made a very significant choice in casting that vote. That the incoming administration, I think, is very clear that if you take an area like, for example, trade and managing the global economy, what the incoming Secretary of State, Tony Blinken, has said very clearly is that America needs to be including a much broader range of stakeholders at every step of the way, that the outcomes won't be announced. The bridge building won't start once negotiations are concluded. They'll really start at the beginning. This is an administration I think is very aware that domestic policy, foreign policy has to really be developed in order to shore up domestic policy. The investments that need to be made at home in infrastructure and education, in health, those are all targeted really at a lot of people who will have voted for Donald Trump. And they're seen as absolutely vital for America's ability to be competitive with China in particular. working with Europe will be key. But really, all of that will be with a very clear eye to the distributional challenges that are defining American politics and have driven the votes that took place earlier this month.
Leslie, how important is it that Joe Biden tries to make a difference within the first 3-4 months of his administration? Will that set the pace, and what will he have to focus on? Is it coronavirus and climate change?
It's absolutely critical, as we know, right? Those first 100 days for any administration are seen as a honeymoon period where the goodwill of people, the electorate of Congress, as much as can be the case, tends to be on the side of the administration. This is a slightly different transition, as we've already seen. It's been delayed. It's taking place in the context of this pandemic, of an economic crisis. Nonetheless, that puts even more pressure, I think, on the Biden administration to immediately renew America's position in the world. We're already seeing that with the phone calls that President-elect Biden has made to Europe, to Asia, to Jordan and beyond. But yes, on day one, we expect that America will go right back into Paris, that there will be a reinvestment in the WHO and any number of multilateral agreements. Tony Blinken has talked about shoring up the base. You have to start with your base, and that for him means Europe. So I think reaching out to Europe, to the United Kingdom, and beyond, and really showing that America is back. But I think not with the naivete that America is unchanged, that the global context is unchanged. It's clearly changed very dramatically. And I don't think anybody envisions America being able, willing, or even interested in pretending like it hasn't. But we're seeing some really, some things that are, for some people will be a throwback. That Jake Sullivan, the incoming national security advisor, calling out the potential for some grave human rights violations in Ethiopia. Tony Blinken talking about Egypt. So there's whole questions of democracy and values. I think we will see a signaling that democracy, values, multilateralism, and internationalism matter, but they matter because democracy matters at home, not only in the United States, but for America's democratic partners across the country, and I think that across the world. And I think that this is the message that the administration is going to try and really put forward in those first 100 days, while trying to tackle the challenges.
Leslie, thank you so much. Leslie Vinjamuri there of Chatham House. Now, we'll have plenty more, of course, on U.S. politics. We'll also look at banking. We'll bring you an interview we did with the BNP Paribas chairman, Jean Lemierre. This is Bloomberg.
It is important for each side to understand the sensitivities of the other.
Former U.S. Secretary of State Henry Kissinger said the incoming Biden administration should move quickly to restore lines of communication with China that frayed during the Trump years, or risk a crisis that could escalate into military conflict.
Unless there is some basis for some cooperative action, the world will slide into a catastrophe comparable to World War I, with a technology that is even more difficult to control than the technology of the period then.
A Roma c'è un francese che mi ferma e poi mi fa: Monsieur, la cittadina.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. Live pictures from Argentina, where we have thousands of mourners for Diego Maradona as he lies in state in Buenos Aires. A very moving picture for many, of course, attending there, but also watching from afar. He meant so much to many people out there. 3 days of national mourning have begun. This is after Diego Maradona died yesterday at the age of 60. His body there lying in state at Casa Rosada. And, it's amazing the number of people that remember him, have stories about him. He even influenced monetary policy of the Bank of England. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
and drop the debt. An Italian
Conservative allies had portrayed Flynn's prosecution as evidence the ban has caused a big loss for airlines in transatlantic. And more than 120.
as much as 13%. Overall, the market seems to be where
if, for example, every day I receive some information regarding Bitcoin. The equity market, and as the market large scale in the Bitcoins. It happened in smaller scales before that. And it's a process that will repeat. Significantly higher from when they are currently. And that is good news for the oil market. Interest rates start to move higher, and hedge funds, asset managers in the
concern are we going to see on the market?
in the United States as it becomes field that it touches you, that if amount of time.
Sebastian, what do you do with China? China is that, I don't know.
And the rebound in China propagating expectations regarding growth in China is probably looking at 8% next year. This is very impressive. So it's a machine which is well oiled, well managed, and particularly the SOE problem. The SOE problem is too large. That means that they'll have to isolate some of it and restructure some of the debt. So some of the restructuring is simply going to continue in a more coordinated and intelligent way, but they're simply going to continue. What we do know about the Russian government as well as the Chinese government is that they are very reluctant to add debt. They view debt as ultimately a liability in the long run if it's too high, and therefore they want to free themselves of these potential liabilities to be more free on the geopolitical scene. That means simply more restructuring. We're quite excited about this. We're excited about ESG and other topics, of course, but the problem that the Chinese have is domestic consumption is simply not very strong. Why? Because the unemployment rate is probably much higher than they actually say, and what you can expect over the next 6 to 12 months is actually that this unemployment
in America offering stark
We all have a role to play in beating this.
There will be enough capacity to
Happy Thanksgiving, everyone, especially in the
side effects or speculations floating about from Moncef Slaoui saying that the group that had the 90% was a younger group. Frankly, this is just all nonsense. We need to go back, get the data from the trial, the part that was properly designed, and then tell us what the answer was. Currently, we don't know what the efficacy of this vaccine is.
Okay, Sam, I'm not sure what a manufacturing error actually means. It's not dosage, right? Is it concentration of what goes in it?
Yeah, so remember, Francine,
I don't want the vaccine.
Then even
December 2nd, so next week. We're no longer in the UK in a national lockdown. Tiers, whatever you want to call them, how much do they help scientists in understanding how the virus
France and in areas where they have the blanket approach would love to have that kind of tiered approach, because some areas just don't have the number of cases that other areas do. So why should they be under the same pressure? That's the kind of question that politicians, again, need to answer.
Sam, thank you so much. As always, Sam Fazeli there of Bloomberg Intelligence. Now, we're getting a couple of news from a couple of different sources. First of all, you're looking at a live picture of 10 Downing Street. For those of you listening on radio, it's just a simple white door, and that usually happens when we're expecting the Prime Minister to come out and give some kind of announcement, what we know he will talk about when that door opens. And I don't know whether we'll see a glimpse of on regions less affected to travel. For the deficit, they have to we'll talk a lot more about retail and
$5 billion American water park no longer hold
Black Friday. Just offering seasonal deals $89 billion. To survive. Industry analysts warn that shifts towards e-commerce and contactless shopping methods could be permanent. So if shoppers don't have a good experience this season, retailers could risk losing them for good.
And TikTok has bought some time with the Trump administration. Authorities have been given China's ByteDance another week to complete the sale of its popular video sharing app. TikTok has been downloaded more than 100 million times over in the US. The administration argues that private data gathered
and that's been deflating the spirited risk rally. Bitcoin also off for Thanksgiving. Defensive tech shares gaining the most in Europe, and
once it goes into this plant, it's heated up very quickly to 600 or so degrees.
there's a lot of concern in Hong Kong, and you can see the way reactions and further anxieties arise. I hope we can settle down to a new normal.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Losses when government's pandemic support is ending. Joining us now is Christian Schultz. He's Citigroup Economics Team Director. Christian, great to have you on the program with us. When you look at, first of all,
borrowing considerably. There's also a second driver, which is a bit less good, which is that the government actually hasn't borrowed that much this year, and so it's kind of postponing some of the borrowing into next year. So it's actually the borrowing this year is probably going to go down, and the one next year
you start talking about it, and I've heard it from a couple
pay for it, and that they pay for it via low interest.
or at least one advisor of the Prime Minister
Of course. The other is structural reforms, labor market reforms, things which are harsh in the short run, enough to close the output gap and hopefully deliver stronger inflation is the ECB deploying its would be severely diminished. However, I wouldn't be so worried about this.
Hi, Francine. Attendance limits at some worship The move lets Prime Minister Boris Johnson
will start to bring that number.
Investors, of the question is the decision which is going to be made by the ECB. Yes, we vaccines and medicines.
An update from the UK Health Secretary, Matt Hancock, speaking in the House of Commons.
I understand the
is happening.
And the world's most innovative solutions.
This is Bloomberg surveillance.
perhaps a more regulated exchange.
Here we sit, a couple of years It's just purely based on its volatility. This is an asset like nothing that anybody has ever seen before, and that makes it really hard to call. What we've seen in the past, though, and I think what's happening again this time, earlier in the year, back in May, we saw a tightening of supply. Every, I think, 210,000 Bitcoins that is blocks that is created, there's a tightening of Bitcoin supply. And that's happened again back in May. And every time in the wake of that, we've seen significant rally. The supply tightening played a significant role. Of course, supply can only matter if you've also got the demand there. Just tightening supply alone won't matter if people don't want to buy this. But in the previous instances, we've seen Bitcoin rally by more than 1,000%. So I wouldn't say that there's anybody that can predict exactly how high it's going to go. It's still very much an unknown entity. But I think we've seen these previous squeezes higher, and they do go up significantly.
Eddie, so what do you do with gold in this kind of environment?
Yes, the crypto fans set this up as a battle between store of wealth. In the very long term, if Bitcoin for just a reassessment as we go into the December period. But coming back to gold, I think gold is at risk of a real pullback. It had a mania earlier in the year. It went through significant support levels or previous resistance levels, went up above 2,000, and I think it feels like the pullback is on the cards.
Eddie? The pullback on the cards by Eddie van der Velde. Thank you so much for joining us. We'll have plenty more, of course, on the markets. This is Bloomberg.
It is 12 noon here in London, 7 a.m. in New York. US markets are closed, of course, today for the Thanksgiving holiday, but it is still a regular trading day here in Europe. So from London, I'm Anna Edwards. This is a special edition of Bloomberg Markets. Let's check those markets for you then now. And we'll go to the ones that are open, shall we? European equity markets move to the downside, down around 0.1%. Some of the sectors that are really being beaten up today, the banking sector and energy and autos and auto parts. But with banks and energy moving to the downside, it's difficult for London to make ground, difficult for the Spanish market to make ground, and so as a whole European equity markets retreat, even if some of these indexes are actually fairly flat. The German DAX and the CAC 40 not moving all that much in this morning's session and into the afternoon here in Europe. So we are kind of directionless a little bit without the US trade. US futures, for what they're worth, no US equity trading today, but US futures are flat to positive if you're looking at the Nasdaq, flat elsewhere. In terms of FX markets, keeping an eye on that euro, it has been strong of late. A little bit of weakness today, 119.04, down 0.1%. And the pound, with all things Brexit in mind, as we're hearing the latest lines from UK politicians around easing of lockdown measures here in the UK and what kind of tiered arrangements we go to, the focus still for investors in part is on Brexit and those trade negotiations. 133.57, down 0.2% for the pound this morning. That's a quick look at the markets. Let's get back to the virus story, because AstraZeneca and Oxford University are facing mounting questions about their COVID-19 vaccine trial, the results of which, after they acknowledged a manufacturing error. Let's get the details now from Bloomberg Intelligence Director of Research, Sam Fazeli. Reading through this story, Sam, good to speak to you today. Reading through this story, it's quite interesting. It seems that an error resulted in only half doses being given to some participants, but they decided to persist with that, and it is now that so-called error that has resulted in some really divergent performance of the drug in trials. Give us a bit more detail on what we know about this error and what happened.
Yeah, good morning, Anna. So whether it's the error in that group that led to the difference, the apparent difference, I want to choose my words very carefully here, whether it's the error in that dosing group that led to the apparent difference in efficacy is unknown. They don't know why that would have been the case from a scientific perspective as regards to the dosing, etc., why the response would have been different. And we still don't know what the difference between the two groups was in terms of age, comorbidity, etc. And finally, whether it's actually real, whether if they added another 3,000 people with that dose, the effect would have turned up to be 100%, which of course is impossible because you already have X number of cases on vaccine, or less. So lots of questions left. I do not believe that number until I see the detail.
OK, so we do need to see some detail. We've had some suggestions coming through from some. The head of the US vaccine program, Operation Warp Speed, suggesting that those who were given the lower dose were a different demographic, were younger, and we just don't know exactly. In other situations, in flu, for example,
if there is a difference here, AstraZeneca is quite clear. It will be at best hypothesis generating. Unfortunately, that's exactly what happened.
So if you're a country buying up supplies of vaccinations at this point, Sam, do we know enough to decide which vaccines you really want to go for? You might not have free choice in that. You might already have done deals with some and not others.
I do wonder whether here that we have a vaccine that clearly does something. UK, European Union, many other countries rely on the Astra vaccine as well.
Here, Bilal Hafiz, macro term optimism and balancing the two.
And that's a very good uncertainty, so we have less world. So Europe is much more strict. The US less so, and so
state things. I mean, the most recent news points have suggested that the UK is loosening a little, that France is loosening a little, Germany is maintaining its stricter stance ahead of Christmas, ahead of the holidays. But maybe that's too simplistic. I mean, what do you expect to see as things develop through the winter in Europe?
No, that's a fair point. You know, I do expect a loosening of some of the measures as we get closer to the Christmas period, and probably in most countries. You have to remember with Germany, the level of restrictions wasn't as aggressive as some of the other countries in the first place. But I do think, just like we've seen with the UK, there are some lifting of restrictions as we go into the Christmas period, because many of these countries recognize that, one, from a retail perspective, Christmas is an incredibly important, stage for businesses, but also from a cultural perspective, you know, it's a time off for people. And what we have seen with the lockdowns, and if you look at the political responses to the current lockdown measures, there's less support for lockdowns this time around. And so the governments across Europe have to be very careful about keeping the public on side. So I do think there will be some sort of loosening as we go into the Christmas period.
And for those watching this in London, and there'll be a few, London is going to enter Tier 2. We found that out in the last hour or so. England's middle level after this lockdown Mark 2 is removed. As we look at all of these measures and what this does to our ability to get out and about, Bilal, as we enter into December, do we risk missing the bigger picture changes, the big structural shifts? And of course, we talk about those as well. But is that where your thought process goes? You know, how much of this work from home, which I'm enjoying so much this week, how much of that work from home will live on into the post-pandemic era, and what big changes that could make for investment strategies?
Yeah, absolutely. You know, my kind of sense, and this is something I'm telling all kind of investors and clients and so on, is that, you know, for me, the bigger story is not so much, you know, the current kind of lockdown measures or the vaccines even. It's more about what's going to be the enduring impacts of 2020 on our lives. And in some ways, if you kind of step back and think about this, what happened in 2020 was essentially the world went on pause. It was like a major reboot of the world where everything stopped. And everybody had to suddenly find a way of working when you weren't able to be mobile, which essentially meant a mass widespread adoption of existing technologies that weren't adopted before. And this is in some ways quite revolutionary. And what we're finding is, and this is a lot of academic work has come out on this very recently, is that a lot more people have discovered that they can work remotely. And managers previously who were very skeptical of remote working have suddenly said, actually, it kind of works. And in fact, most have had a positive experience from it all. So I do think there will be this enduring impact on the labor force where we'll see much more remote working. And if we do see that, that has some significant implications. One, it has an impact on cities versus smaller cities and villages and so on, where people will now find it more comfortable to live outside of big cities. Also, people will have access to jobs that they didn't have access to before because they can now access it remotely. So that sort of opens up the opportunities that are available. So I think these will have some quite profound impacts on markets.
Yes, I'm sure it's a short-term phenomenon in my industry, but I'm sure for that, we stay here in London with
long and bitterly fought criminal case involving President Trump's first national security advisor. The president has pardoned Michael Flynn, who had pleaded guilty to lying to FBI agents about his talks with the Russian ambassador. Conservative allies had portrayed Flynn's prosecution as evidence of a conspiracy against the president. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Thank you very much, Leanne Gerrans, with your first news update. Coming up on the program, that's what Bilal Hafiz next.
Now, it's a key test for the
This is Bloomberg Markets. I'm Anna Edwards, live in London for this special edition of the programme this Thanksgiving. Let's check out what's happening in the markets that are open. Of course, many closed stateside. And Danny Berger has been tracking the market action here in Europe for us today. Danny.
And it really does look like traders are happy to take a pause today after what we've seen as being an impressive rally so far in November. Stock 600 down 0.1%. But also what we're seeing is a reversal of some of the euphoria that's been in the markets the past couple of days. Those higher beta cyclical sectors are really what's leading the market lower. In the Stock 600 UK stocks certainly having a big drag today as those London tiers get announced. And looking at S&P 500 futures, they are flat. But again, this goes back to that reversion to a safety trade, though cash markets are closed. Futures in the NASDAQ are getting a bid of 0.3%. Again, it's that safer sort of tech trade we're seeing. Now, let's look at some of the currencies and switch up the board. Dollar spot, it is gaining, according to Stephen Innes of SPI Asset Management. There's been a huge corporate bid for the dollar ahead of the Thanksgiving holiday, so just really holding on to that bid during a day with lower volume. Bitcoin, we've been talking about this a lot, a nearly 8.5% decline. But look, Bitcoin's so volatile that sometimes perhaps an 8% decline isn't that huge. Coinbase CEO also talking of perhaps some more regulation across the digital currency space. So that is certainly pulling back from some of that record rally we've seen in the digital currency. Pound also moving lower, trading at the lows of the day, down 0.25%. Again, some of that news over the tier system, dragging the pound down perhaps in Brexit talks as well. But look, I want to get into the charts because the trend of the pound over the past few days has been higher. Yes, it's lower today, but in the blue, if we look at what the pound has been doing, trading near a 3-month high. But underneath the market, that optimism is not there. In fact, it's more bearish. The risk reversal is now trading near their lowest in September. Sebastian Galen of Nordea says that not enough risk for no deal is currently priced into the market. So perhaps we're seeing that in options, Anna.
Yeah, really interesting. Danny, thank you very much. Danny Berger on the markets. And she was talking there about UK assets. Worth mentioning the UK's Matt Hancock, the Health Secretary, says that the virus cases are rising in parts of London. A lot of work still to do to keep London in Tier 2. So let's remember that as we head into December, if you are, like me, in the UK capital. Now, still with us, Bilal Hafiz, Macro Hive founder, CEO and editor. Bilal, we talked a bit about the virus and how it's managed and how that impacts on investment strategy. What about the impact that it's having on inflation? I know that you've been giving some thought to the way that the service sector has been hit through the pandemic and what impact that should have on our inflation expectations. Can you link up some of those thoughts for us?
Yes, absolutely. Of course, one of the biggest debates at the moment is, will inflation go up or will it fall in the period going forward? The people who are very bullish on inflation or expected to go up are focusing a lot on the build-up in debt, the amount of printing by central banks. But for me, the most important thing is much more to do with the supply side aspects of the virus and which part of the economy is affected the most. And unlike any other recession, it's a service sector that has been completely negatively impacted during the COVID period. So that's the part of the economy that has really dropped significantly, whereas manufacturing held up. And if you look at inflation in advanced economies, in rich countries, most of inflation is service sector inflation. And so it's really, and if you go back over the last 10, 20 years, the only area of inflation we have seen in rich countries has been service sector inflation, whereas goods inflation, the cost of TVs and such things, have been close to zero. So my sense, first of all, is if it's a service sector negative shock, therefore, you should naturally see a downward pull on inflation. And then longer term, my point there is that within the service sector, the technological adoption that you've seen over the COVID period should structurally lead to lower service sector pricing pressures going forward.
Yeah. It's really interesting, isn't it? Because we were dealing with low inflation and lots of questions as to why that was, even before the pandemic, weren't we, Bilal? And now we've got added dynamics to consider. And I wonder if one of those is the news about the vaccine and what that does to people's propensity to consume, to consumers and also to investors' propensity to invest, businesses' propensity to invest, rather. If you know that the vaccine is coming, does that change things? Does that add a little bit more pricing power? How do we deal with that vaccine news flow when it comes to inflation expectations?
Yeah, no, that's very true. I do think that this will lead to a build-up in demand and greater optimism and greater investment and so on, which could, in the short term, have somewhat of a positive impact on inflation. So there could be a bit of a pull up in inflation, and there's certain base effects that will see inflation pick up. But already, a lot of that is likely to be seen through commodity inflation. So oil prices have been picking up, food prices have been picking up. So the food and energy component of inflation, is probably the area where you'll see most of that occur. Outside of that, I think it's less clear, because if you think about the main areas of service sector inflation, one is medical costs. There's been a big spike in medical costs this year because of COVID. That's probably going to start to head down. The other is education. So, are educational establishments, are they going to increase their prices in the years to come? I doubt it, especially with remote education and so on. Then there's a big one, housing. Are rents going to pick up significantly going forward? Or instead, are we going to see a move out of high rent locations like cities towards lower rent places, which will then have this inflationary impact?
And we've seen, Bilal, Philip Lane, chief economist at the ECB, just speaking in the last minutes, saying that it is essential not to let the yield curve steepen prematurely. And I guess this feeds into the inflation conversation, doesn't it? The extent to which central banks are going to be desperately trying to keep yields low to enable all indebted parties to pay back those debts.
Yes, absolutely. And Europe has a chronic, low inflation problem. I mean, core inflation is around 0.2, 0.3%. I mean, it's anemic, the inflation there. So Europe really does need to do whatever it can to sort of boost inflation. And the importance of the yield curve is that, if you have inflation so low, if the yield curve steepens a bit, you end up with positive real rates in an environment where you really want to boost your economy. So this is the message from the ECB that they really want to keep policy very loose, keep the yield curve low to really, allow consumers and businesses to have the best interest rate environment possible.
Bilal, thanks very much. Thanks for joining us. Macro Hive's Bilal Hafiz, thank you very much for spending this period of Thanksgiving with us. Coming up on the programme, George Buckley, Nomura Chief UK Economist and Co-Head of European Economics, will join us. Lots to talk about with George. We'll certainly talk about the ECB latest news flow because there's an advisor to the Italian Prime Minister who's been calling for the ECB to forgive some of the pandemic debt. We'll get into that conversation. Are we talking about debt forgiveness? Are we talking about just increasing the maturity of debt? What, if any, of that is going to be possible in the eyes of the ECB? Excuse me. So we'll talk about all of that coming up. European equity markets then are open, even if markets stateside are closed, of course, for Thanksgiving. European equity markets are open, moving to the downside, down by around 0.1%. Banks, auto parts, energy stocks under pressure. An interesting mix of things to the upside. We have healthcare and travel and leisure stocks going higher, providing just a little bit of upside where we find it. European equity markets then on the back foot, looking for a bit more guidance perhaps tomorrow on Black Friday from the United States. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
I'm certain that we will be able to bring our debt levels down and avoid what you could call a debt crisis because we're focused and we've been open enough by telling the nation that we have too much debt.
This is Bloomberg Markets. I'm Anna Edwards, live from London. Happy Thanksgiving if you are celebrating. If you're here in Europe, then European equity markets, of course, are open. European equity markets looking a little bit directionless this hour, down around 1/8% as a whole. The FTSE 100 down 0.6%. The CAC and the DAX do a little better. The IBEX over in Spain also retreats down around 0.75%. Interesting to watch the euro right now, down 0.2% at 118.89. And we've had some interesting comments from the chief economist at the ECB. ECB's Philip Lane says he sees the first signs of worrying financing conditions. What implications does that have for the banking sector and indeed for European corporates and the broader European economy? We'll think about that as we go through the next couple of hours or so. Let's get a first word news update. For that, we go to Leanne Gerrans. Leanne.
Hi, Anna. The Trump administration plans to keep up the pressure on Iran during its final days in power. The U.S. sanctioned 5 companies in China and Russia for their alleged dealings with Iran's missile program. More sanctions on Iran are expected in the coming weeks, related to weapons of mass destruction and human rights. It looks as though China will not meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of U.S. products slowed last month after hitting a high back in September. As of the end of October, China had bought only 44% of this year's target of $172 billion in American goods. A divided U.S. Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. He wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against those limits. Chief Justice John Roberts joined the court's liberal wing in dissent. And shipping industry associations are calling on the world's richest person to bail them out. The problem, some 400,000 sailors are stuck on merchant vessels because of restrictions to stop the spread of the coronavirus. Shippers wrote an open letter to the Amazon founder Jeff Bezos to pressure global leaders to recognize seafarers as key workers. They say Amazon's success relies on shippers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Leanne, thank you very much. Now, Germany has registered a record increase in new coronavirus cases, bringing the total to just under 1 million and prompting an extension to the country's partial lockdown.
The measures that were put in place on October 28th will be continued, firstly until December 20th, and we're expecting, and this is something that the states and federal government are in agreement on, that because of the very high infection numbers, the restrictions will have to be in place until the start of January.
Here in the UK, Chancellor Rishi Sunak has set out spending plans as the country faces the worst slump in the economy in 300 years. And in Italy, Prime Minister Giuseppe Conte's closest advisor is calling on the ECB to consider wiping out government debt bought during the crisis. Let's get the latest on some of these developments. Bloomberg's Maria Tadeo joins us now from Brussels. Maria, let's start then on the German situation. As we were hearing from Bilal Hafiz, it's difficult to compare one part of Europe with another. You know, the lockdown Mark II that we saw in Germany was not as tough as it was in other parts of Europe, and maybe that's why it needs to be extended for a little bit further. Different parts of Europe taking slightly different strategies from here.
Right, Anna, and that's why this is becoming difficult to implement on a policy aspect. The numbers are different in every country. If you look at the situation in Germany, Angela Merkel was very clear that she doesn't like the numbers that she's seeing at this point, and that Christmas doesn't mean that restrictions have got to be lifted or can be lifted. And in fact, they're now being extended until December 20th. When you look at the situation in France, it's different. Emmanuel Macron is really gearing up the country to reopen by December 15th. But you could argue that at this point, the French were immersed in a second wave and they're more in a stop and go strategy. When you look at other countries like Spain, Italy, they haven't gone for a national lockdown. So it's the fact that you do get different situations in different countries and still policy whiplash between member states that is making this difficult. And I would say on that note, there is somewhat of a diplomatic spat that is being or perhaps could brew over the next few days, which has to do with the skiing resorts, what to do with them as we enter into the Christmas period. this is a crucial time for skiing resorts. This is a big industry for Europe. As you know, Italy, France, Germany, and Austria all share skiing areas. Some countries like Austria do want to go ahead and open. The Germans are saying they don't want this to happen. The big implication here is that, of course, in Europe, we operate under Schengen. There should be freedom of movement, and that may complicate things better. So again, that feeds into what you were saying. It's the different measures that are making this a one approach coronavirus response difficult in the EU 27.
Yeah, meanwhile, we saw the role that skiing played, or skiing destinations played, in the spread of coronavirus in the first part of this pandemic, Maria, didn't we? On another matter, we're watching these lines coming through from the ECB accounts, and we'll get some analysis of that shortly with our next guest. But on the subject of the ECB, one of the other stories that's really interesting this morning here in Europe has been this Italian call, and a key advisor to the Prime Minister in Italy asking for or suggesting that the ECB should go about some debt forgiveness when it comes to all of the debt that is bought up from European governments. What's the latest on that, Maria?
Yes, Anna, and this is an interview by Bloomberg that's generated a lot of reaction today. And we're talking with one of the key aides of Giuseppe Conte, I would say, the Italian Prime Minister, who's clearly putting out three ideas. The European Central Bank could cancel some of the debt that is taken on during the pandemic. They could also exclude from the deficit calculation the money that you put forward for green policies. And they're also perhaps putting forward another idea that suggests that some of the maturities of the debt could be extended for so long, almost ad infinitum, that in a practical way you end up not repaying it. But I would say this is a debate that is not new. All of these ideas have been floated. What is interesting here is that this is coming from a member of the Italian government, from someone that is close to Giuseppe Conte, the Italian premier. This is not just some professor in a university considering or floating ideas. I would say, however, when you look at the reaction we have heard already from the French, Bruno Le Maire, the finance minister, almost pushing back against the idea, saying that debts you have to repay. When you take on a debt, you assume that you will have to repay it. And of course, you run into a much bigger issue here, which is the opposition that you could get, and probably Italy will get, from Brussels and Berlin. They've always said canceling debt is something that the European treaties do not allow for, but also repeated many times the idea that the best thing you could do when it comes to debt sustainability is be fiscally responsive. So a number of hurdles here for that idea that the Italians are floating.
Maria, thank you very much. Maria Tadeo in Brussels. We'll pick up on that story shortly. I want to get next, though, to George Buckley, Nomura chief UK economist and co-head of European economics. And I want to, good afternoon to you, George. I want to come to you on the latest lines coming through from the ECB and its accounts, talking about how the euro area recovery was losing momentum. The risks are clearly tilted to the downside, according to the ECB accounts. Also making an interesting point, and this ties into what the ECB does from here. The ECB accounts saying that more bond buying might not have the same impact now. Do we see a sort of diminishing returns when it comes to the PEP programme and other quantitative easing bond buying programmes that central banks have put in place? What's your response to that line of thinking?
Well, certainly the ECB is coming out and saying now that it can't exclude, for example, a double dip recession. And to be honest, I think it'd be surprising if we didn't get a double dip now. So they do need to do more. They are going to do more come the December 10th meeting. Now, of course, when you start to increase the amount of quantitative easing to the scale that they have done, it is questionable whether it's doing the same amount of good. And one of the reasons is you have to question why is it helpful? And one of the reasons it's helpful in pushing yields down, but yields are already exceptionally low. So it's questionable just how much more they can do. Of course, by taking government bonds out of the mix, investors have to buy something else, and that could be very positive for financial markets. But it may have been the case that by preventing Italian yields from rising even more than they did back in the early part of this year, that had a much bigger effect than it would do now when we don't have that problem.
What can the ECB do, George, that is within the rules that they are allowed to do that means that governments can increase borrowing substantially? Many of them are going to be doing that to help their economies through this pandemic. Is the ECB doing exactly what it can do? It's the buying of government debt, and that's what we've seen already. Or is there anything in this Italian call for some kind of debt forgiveness, or even if we don't go that far, some sort of extension of the maturities on some of the European government debt?
Well, as Philip Lane was talking about earlier today, it's all about keeping financing conditions as favourable as you possibly can, whether that means keeping a lid on long-term interest rates. So, for example, government bonds via the PEP program and the asset purchase program, or whether it be via short-term yields, and whether that be potentially cutting interest rates again, or more likely the making the teltros more generous, the lending to banks much more generous, and encouraging banks to on-lend that cash to the real economy at lower interest rates. So I think it's all really related to keeping interest rates low and encouraging firms to and households to borrow.
Right, and so is that going to be the focus of things then from the ECB? Is it going to be about more cheap loans to banks, more teltros, rather than the PEP QE programme, George? Just looking at the lines from Philip Lane earlier on today, he said there are some worrying signals in recent survey data, and this is about financial conditions or financing conditions. He says we will recalibrate our instruments as appropriate to respond to the unfolding situation and to ensure that financing conditions remain favourable. Is there a worry then that banks might not be able to do as much as governments want them to do or central banks want them to do to support businesses at this time?
I think there is a worry, but I don't think we should rule out quantitative easing as being very important. I suspect that if the European Central Bank did absolutely nothing to expand or extend its PEP program, the markets would be exceptionally disappointed. So I think it would be better for the ECB to do more. It's always better when you add all of these policies together and try and loosen in various ways, a package of measures, if you will, throwing the kitchen sink at the whole problem. Because the two problems that we've got right now is, in the very near term, we have GDP, which is likely to fall again over the winter months. But the second problem is that inflation, even before the pandemic, was being revised lower, expectations of inflation. And it's still the case that we're not expecting inflation to be much above 1% in 3 years' time. The European Central Bank thinks it won't be that far ahead of our forecast, probably 1.3, 1.4. But that is materially below what the ECB would like it to be, which is close to but below 2%. So I think that they need to do a lot in order to try as best they can to throw everything at this problem, to help GDP through and the economies through the crisis, but also to try and encourage inflation expectations higher.
Yes, and in terms of thinking about those inflation expectations, we heard from De Guindos of the ECB over the last 24 hours. He was saying that the vaccine has bolstered sentiments. I wonder if you see that in any of the data that you look at, George, any of the high-frequency data that we're now so used to sort of poring over. Does any of that suggest that as we've got more concrete proof that vaccines can work, that consumers have been prepared to spend more, that businesses have been prepared to invest more? Has any of that come to pass?
I think it's probably a bit quick to see that in the data as yet, but certainly we have seen the equity markets respond very positively to the vaccine news, and also that will have an effect on some of these surveys which measure things like expectations and analyst expectations of where things are going in the future. So to the extent that the markets are responding positively, that might also be encouraging for household and firms' expectations.
OK, George, thanks so much for your time. Really good to speak to you today. George Buckley of Nomura, thanks very much for joining us. Coming up on the programme, it is the biggest shopping day of the year, tomorrow that is, how retailers are transforming to a more COVID-friendly solution for the holiday season. We'll talk about Black Friday. That conversation coming up next. This is Bloomberg.
mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I'm Anna Edwards, live in London for you. European equity markets moving to the downside then, down by around 0.1% this afternoon. Of course, European equity markets are open. US equity markets not open, not giving us that usual direction. For what it's worth, US futures look fairly flat. NASDAQ futures, though, point to the upside. In terms of FX markets, we see a little bit of weakness in the euro. Interesting comments from Philip Lane around financing conditions in Europe. And, of course, we had those ECB accounts not ruling out a double-dip recession for the Eurozone. Let's talk about shopping, shall we? Black Friday marks the unofficial start of the holiday shopping season. But as with everything in 2020, it's going to be different this year. COVID-19 has changed the shopping experience, and America's biggest retailers and department stores are rushing to adapt. Bloomberg's Ritika Gupta reports.
Black Friday, the unofficial start of the holiday shopping season, is upon us. While retailers would normally showcase doorbuster deals, fully stocked shelves, and a frenzy of shoppers, COVID-19 has drastically changed the shopping landscape this season. Stores are rushing to adjust, offering seasonal deals earlier this year to avoid a holiday crunch. Stores are bulking up direct shipping and in-store and curbside pickup, with Adobe Analytics predicting a 40% rise in pickup shopping methods. Traditional brick-and-mortar businesses are also focusing on shifting to e-commerce. Online sales are expected to surge 33% to $189 billion, according to Adobe Analytics. That will not only pressure retailers to adapt, but will stretch fulfillment networks across the US. Getting that change is crucial for struggling stores to survive. Industry analysts warn that shifts towards e-commerce and contactless shopping methods could be permanent. So if shoppers don't have a good experience this season, retailers could risk losing them for good.
That was Bloomberg's Ritika Gupta with a look at holiday shopping stateside. Charles Allen, senior retail analyst for Bloomberg Intelligence, joins us now. And Charles, I know your focus is more on Europe, and we'll get to that in a moment. But just reflect on what we were hearing there from Ritika on just how different this holiday shopping season is going to be compared to other years. Today looks different for a start in terms of the US retail space, doesn't it?
Yeah, it's that almost all the big U.S. retailers that had gradually sort of had a few hours opening on Thanksgiving, usually in the afternoon, have decided to close. So Walmart, Target, Best Buy, etc., will not be opening today. I mean, you can shop online if you want, but it's sort of making sure that all the employees have a holiday as well.
And in terms of the European experience, I mean, clearly Black Friday has become an increasing presence, I suppose, in the UK, either on the high street or in terms of online shopping. Is that going to change this year? There's certainly been some pushback. The UK is a bit different, isn't it, to other parts of Europe? There's certainly been some pushback against the sort of Black Friday, Amazon in particular, phenomenon in some parts of continental Europe recently.
Yeah, I mean, there's sort of all sorts of different things going on. I mean, in France, they've postponed it for a week, including Amazon, so that all the small retailers can participate once the lockdown finishes tomorrow in France. I mean, in the UK, it's a mixed picture. Obviously, non-essential retailers are closed tomorrow, so you can't go to some shops. I think, the other thing about this year is that, one typically associates Black Friday with, things like electronics and computers and things like that as sort of big bargains for that. I'm sure there will be some of those offerings around because people will have bought for it. But you also have to remember that these have been really strong categories through the whole lockdown. So an awful lot of people have bought themselves a new computer or a new TV this year. So it's not the things that normally people would buy are not necessarily going to be in as much demand as they may have been last year.
And in terms of the UK shopping experience, Charles, clearly Black Friday has become increasingly important, but there's also a big sales phenomenon that happens on what we call Boxing Day on December 26th, just after Christmas Day. I see a headline just crossing, very timely for our conversation with you, Charles, a headline just crossing from Marks & Spencer's, a UK retailer, says M&S reverses its decision to open on Boxing Day so that colleagues can spend time or more time with loved ones. That's another part of the balancing act that these retailers are going to have to throw into the mix. It's of course about making the most of the time they are able to be open, but also mindful of the tough year that 2020 has been for many of their staff.
Yeah, and actually, given that Boxing Day falls on a Saturday this year, it's really quite a big decision to say that you're going to be shut on that Saturday. But yes, it sort of mirrors what the people in the US have done and what was traditionally a holiday for shop workers as well, but then became more and more of a working day. So decision to just make it, an online-only promotional day probably makes sense for a lot of people.
Now, whether it's Black Friday in the US or Boxing Day in the UK, we always look to illustrate, in TV land, Charles, we look to illustrate these stories with images, pictures of people cramming in through doorways, trying to get to the latest bargains. That just simply is not going to happen. Are some stores on both of these occasions going to be taking some quite drastically different approaches to actually limit the number of people who can get into their shops?
Yeah, well, I'm sure that they will be, and I'm sure that they'll have to. There has to be concern for the safety of their employees as well. So you don't want, 10 people crowded around every employee, even if everyone's wearing a mask. So I think, the companies like Primark, have got one-way systems to go through stores. You've got, make sure there's more distancing. There's obviously more protection around all the till points. Things like changing rooms are either closed or, under a different regime. So yes, it is. And I think this is probably even more true in some countries in Europe where the social distancing will be even more enforced than it is here.
And when we normally talk about Black Friday, Charles, we talk about the danger that can be posed to margins. Just briefly, is it going to be that same conversation again, or is just 2020 is just so different?
Well, I think that the retailers have moved on from just discounting their regular stock for Black Friday. Once it became apparent that it was a major promotional event, they bought merchandise especially for it, just as they had done for Boxing Day sales and things like that. So, the TV that you see at a really attractive price on either today or on Boxing Day has probably been bought especially for the occasion, and the retailers will make a good margin on it. But so,
Charles, thank you very much. Anyway. Thanks for bringing us the analysis. Yeah, we'll keep OK, we'll keep an eye on that margin story. Charles Allen of Bloomberg Intelligence, thank you. Coming up in the next part of the programme, our next conversation, we are going to be talking with Alberto Gallo, Algebris Investments Portfolio Manager. We'll talk about what he's been learning through the pandemic, what 2020 has taught him as we get closer and closer to the end of this year. This is Bloomberg.
What moves the human spirit, what transcends time, comes from true craft, the artistry of Japanese craftsmanship. Presage, Seiko.
In our interconnected world, if people in low and middle income countries miss out on vaccines, the virus will continue to spread and the economic recovery globally will be delayed. Equitable access is in the national interest of each and every country.
But this also means if we have a vaccine, we should have a common approach to give a fair share to everyone so that the most vulnerable groups, the frontline workers and the healthcare workers, for example, are the ones who get the vaccine first.
We're donating another $70 million to fight COVID-19. $50 million of that will be for buying vaccine doses for low-income countries, and another $20 million will be for researching even further and new vaccines altogether.
Il nous faut nous assurer que les conditions réglementaires et politiques sont toutes réunies pour un accès le plus large et rapide possible à ces produits, tout en respectant les standards internationaux de qualité. C'est pourquoi la France propose que puisse être rapidement adoptée une charte d'ACTA qui réaffirme ces grands principes. Partager la connaissance, soutenir les systèmes de santé, avoir des produits rapidement accessibles et abordables.
Chinese capital market, as you know, is nascent, is just developing, and so we think there's an opportunity to build out that. But that's not all. We're also focused on continuing to build our presence in the Greater Bay Area. It's been a good business for us.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It is 1 p.m. in London, 8 a.m. in New York. From London, I'm Anna Edwards. US markets are closed for the Thanksgiving holiday, but it's still regular trading here in Europe. Welcome to Bloomberg Markets. Let's have a look at those markets. And we've got European equities down by 0.1% right now. The Stoxx 600 down by 0.1%, as I mentioned. Difficult for the London market and the Spanish market actually to make ground as we see selling in energy stocks and banks. Interesting moves in the pound. We heard from Philip Lane over at the ECB talking about concerns around financing conditions for small, medium-sized businesses, perhaps. And so that was an interesting story to watch last hour. 118 is where we trade. So we've dropped down from that 119 handle on euro-dollar. It is Thanksgiving. Let's kick off this hour with some US politics. In the US, two very different messages from the incoming and outgoing presidents this Thanksgiving.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts he has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
Contrasting visions then, contrasting assessments and priorities, I suppose, from the US president and US president-elect. Let's talk to Kathleen Hunter, who covers US politics at Bloomberg and joins us now. I suppose we shouldn't be surprised that the messages are so different, Kathleen, given the very different focuses we saw in two presidential campaigns running through much of this year.
Absolutely, and I think those different types of messages we saw reflected in the Thanksgiving speeches that we heard, or the Thanksgiving addresses that we heard from Trump and Biden, just now. I think that also, though, it's important to remember that, Trump is the incumbent at this stage. And so, he obviously is going to paint a rosier picture of how things stand in the U.S. than one that Biden might paint. Then Biden, of course, is going to talk about, the need to change things and, make them better in the new year. And so I think in that sense, it's kind of traditional what we would see from an incoming and outgoing president. But of course, because this is Trump and Biden, everything's just a little bit more of a stark contrast.
Yeah, not necessarily so typical in that sense. Kathleen, we are coming to the end, really, of the Trump presidency, aren't we? But he is, of course, still president, and he's still making decisions, and he's still taking actions, as you would expect. To what extent is there nervousness in the Democratic camp as to what President Trump might do through December, whether that's on Iran or on China or in other policy areas?
Well, of course, I think there is nervousness out there. We've seen that reflected in, the news stories that have come up. And, I think it's a result of the actions that Trump has taken. There have obviously been reports that he, has considered in recent days some kind of a military strike on Iran. Obviously, that has not happened. There's no indication that would in fact happen. But, I think that's a question that's on people's minds. He's taken actions already toward China. And this is all against the backdrop of having, major shakeups at the Pentagon and the Department of Homeland Security. And we know that right after the election, for instance, he fired the defense chief. And so I think that is making people nervous. There's still about a month and a half that Trump's going to be president, and he is going to be the one setting the policy for the U.S. Through that time.
Kathleen, thank you very much. Bloomberg's Kathleen Hunter with an assessment of the US political backdrop this Thanksgiving. Let's get to how markets are reacting to news from around the world today with Alberto Gallo, portfolio manager from Algebris Investments, who joins us now. Alberto, good to speak to you. So we're having a conversation with Kathleen about the contrasting assessments of where the US is at the moment. When you try to look at the latest data we've got from the US, some of it has looked quite mixed, hasn't it? When you look at jobless claims maybe and retail stories not looking quite, the consumer story not looking quite so rosy, but other parts maybe asset investment by businesses maybe more positive. How do you assess the tough winter ahead in the US, Alberto?
There is a lot of good news in the market. The first most important news is we have a vaccine that is going to be distributed before the end of the year. So we're going to get the first doses out, both in the US and Europe, before the end of the year. At the same time, the economy has rebounded. Mobility data shows us that people are out, even though there are some lockdown measures. So, if you take a look from 30,000 feet, it looks very much like a V-shaped recovery. But if you look under the hood and you look closer, it is a K-shaped recovery, and there is still a lot of sectors and businesses that are behind, and also states and parts of the country that are behind. So markets are very euphoric. We went from euphoria in Q1 2020 to panic, and now we're back towards euphoria. The fear and greed index is at 88%, where 100% is maximum greed. So we are definitely happy because there are some positive developments, but our investment stance is a lot more cautious compared to March, April, or May, where we were deploying capital and buying a lot of risk assets at fire sale prices. We're a lot more selective now.
Okay. Right. I wanted to ask you about what you're doing with your portfolio, Alberto. You mentioned the fear and greed index. How greedy are you for some of the more cyclical plays then at this time? How tempted are you to reposition the portfolio around some of those reopening trades, the cyclical stories, the value stories, given what we know now about the vaccines?
So we want to position for a reopening of the economy. We have been lending money to firms in sectors that are linked to face-to-face activity, for example, hotels or cruises or airlines. We want to be in the right part of the capital structure, so have a senior or a secured claims on assets. And investors have been paid very well for lending to these sectors. In a world where interest rates are very low, at zero or negative, and they're likely to remain low for the next few months and possibly years. So we like those sectors. We also like the cyclicals, traditional cyclicals like industrials and banks. And generally, I would say that across asset classes, we see still some value in equities in non-US markets, so Europe and emerging markets, and in credit, but only in those sectors. So the indices, the benchmarks have gone a long way. They're back to pre-COVID levels. So we want to be a lot more selective. Now, the real question is, who's going to pay the bill? Because there's been, as you know, a lot of investment from governments, a lot of borrowing to bail out the private sector. And interest rates are capped at very low levels, but eventually, high government debt will call for some measures, and we know what they are. It can either be forcing investors to receive low interest rates, negative against inflation, or higher taxes. So we see very little value in government debt at these yield levels.
Okay, and so if somebody has to pay, when does that paying back start, Alberto? When would it be sensible to start those conversations? Because the IMF and others have been urging governments to keep those fiscal taps open for the moment.
Essentially, if you're a bondholder in government debt, you can either lose money slowly or you can lose money quickly. You lose money slowly if central banks keep interest rates low and fiscal stimulus drives inflation a little bit higher, not to very high levels, but we're talking about a range of 1 to 2.5%, which is already much higher than what you get paid on government debt. You lose money quickly if bond vigilantes wake up and start unwinding holdings of government debt and move into other assets. But so far, central banks have leaned against this. So something in the end has to give. And generally, I would say we're in the first scenario where bondholders are going to see yields rise, price drops, but very, very slowly. Central banks will maintain a dovish stance, as we have seen from Philip Lane earlier today, but governments will try to essentially borrow more at very low levels and inflate out the debt. There are also some governments that are more aggressive. We saw in the UK the reform about retail price inflation, so bonds that refer to RPI, which was a complex indicator with a lot of flaws, will now refer to CPI starting from 2030, and CPI usually pays a lot less, and bondholders are not getting compensated for that change. So essentially, some countries may just change your inflation indicator and pay you less on your inflation-linked debt. And on nominal debt, they're paying you already very little.
Okay, so those are some of the risks for bond investors. Where are the bond vigilantes, Alberto? Do you think, given what your reference to them there, do you think they'll come back?
I think they are asleep at the moment. I don't think they are completely dead. We need to understand how much fiscal stimulus the Biden administration will be able to create next year. And we still have the elections in Georgia with 2 Senate seats that may be won by the Democrats. And in that case, with a potentially blue Senate, the door to more fiscal stimulus is open. I would say that there is a lot of optimism in markets today with the vaccine, and it's a good thing, but a lot of this optimism is underpinned by a very dovish stance from monetary policy. And I think that will continue for next year. But the easy gains have been made, and we were bullish, in the period just following the virus. Now we've got to be a lot more selective. And if there is a trap in the market, is to be invested in sovereign debt. We definitely don't want to have that overall in our asset allocation. Or if you want to be a lot more selective, only in a few countries. So it's a lot tougher now than it was 6 months ago.
Thank you. I think we've got a different view coming up later on in the programme in terms of sovereign debt, so really interesting to get your perspective. Alberto Gallo from Algebris Investments, thank you very much for your time this afternoon here in London. Let's get to the First Word News now, some of the big stories we're covering here at Bloomberg, and for that we go to Leanne Gerrans. Leanne.
Hi, Anna. Here in the UK, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed into Tier 2. That means pubs, restaurants and bars can open for business, but alcohol can only be served as part of a meal. Households will not be allowed to mix indoors. Now, it is the apparent close to a long and bitterly fought criminal case involving President Trump's first national security advisor. The president has pardoned Michael Flynn, who had pleaded guilty to lying to FBI agents about his talks with the Russian ambassador. Conservative allies had portrayed Flynn's prosecution as evidence of a conspiracy against the president. A cryptocurrency boom has just turned into a mini bust. Bitcoin and other digital currencies have plunged by double-digit percentages. That is likely to stoke speculation about the durability of the rally. Even with the retreat, Bitcoin has more than doubled this year. And Disney has announced 4,000 more job cuts after virus lockdowns forced the closure of its theme parks. That takes the number of layoffs set for the next 6 months of the year to 32,000, more than 10% of its workforce. The coronavirus pandemic has hammered Disney's traditional businesses like studios, parks and cruises. And the Trump administration is considering a move that could boost travel. Several agencies are urging the White House to lift an entry ban on non-US citizens arriving from Europe. It was put in place to slow the spread of the coronavirus, but the ban has caused big losses for airlines in the transatlantic market. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Thanks very much for that, Leanne. Coming up on the programme, managing differences. China's president congratulates Joe Biden on his election win. We'll look at the relationship between the two countries under a new US administration next. That conversation coming up here on Bloomberg Markets this Thanksgiving. This is Bloomberg.
it is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back this Thanksgiving to the special edition of Bloomberg Markets. Let's check out the market action. There are some markets trading. Danny Berger has been looking at the movers. Danny.
Anna, there are markets trading, but it's important we keep in mind that those that are trading, volumes are still severely depressed, rather. In Europe, volumes are off as much as 30% in some of these markets. So keep that in mind as we look at a market that's really struggling for direction. The Stock 600 has pared some of its losses down around 0.1%, but it really is value, those more riskier stocks that are leading the decline after posting pretty solid gains this month. Traders perhaps happy with taking a pause after those November surges we saw. And that same story is playing out in U.S. futures. Yes, the cash market is closed for Thanksgiving, but at the same time, we're seeing this trend of NASDAQ doing better, those big tech things, and also the dollar getting another bid. According to Stephen Inez of SPI, there's a big corporate bid coming in to the dollar before Thanksgiving, and that is holding. The pound also slumping today, along with UK stocks falling 0.2%. Some different forces in here that continue to be the two that the UK is really focused with. We have tiers announced. London is in tier 2. That's going to be decided every 2 weeks, according to the UK's Matt Hancock. And, of course, Brexit negotiations ongoing. Now, finally, Bitcoin down 8.5%. And this comes after it was just within $7 of hitting another all-time high. It continues to be volatile. But I want to jump into the charts because, as Eddie Vanderwalt from MLive says, I think puts so greatly, is Bitcoin is forever the comeback kid. One characteristic of what we see Bitcoin do are these intense rallies followed by bear markets. According to Citi's Tom Fitzpatrick, that is the characteristic that will continue to define Bitcoin. So that means more gains are possible from here. And perhaps that's the way to look at it technically, because if it's driven by hopes and dreams and not fundamentals, perhaps it's that pattern we should keep looking out for, Anna.
Thank you very much, Danny. I wonder what the Bitcoin crowd are up to today, perhaps overdoing it on the turkey. Danny Berger, thank you very much for looking at the markets for us. Back to the geopolitics. China's President Xi Jinping has broken his silence on Joe Biden's election victory, sending the president-elect a message that he hopes they can manage differences. Let's discuss the future of US-China ties with Bloomberg's executive editor for international government, Ros Matheson. Ros, really good to speak to you. Many people have said that their sort of working assumption is that the US government, the new U.S. administration, doesn't necessarily about face on Chinese policy at all, but that the tone of the conversation will shift entirely and will be back to the more sort of diplomatic language of old. Does that have the power to actually make quite a big difference in this bilateral relationship?
Well, it may at least make things more predictable. I think that one of the difficult things, obviously, even keel, a politer kind of relationship, that it becomes more predictable and therefore less reactive. So you might see those kind of extremes of reaction perhaps diminishing. But that said, Joe Biden has every reason to be tough on China as well. In fact, he may in some areas be more so, because the Democrat Party may not hold back from criticizing China more heavily over human rights issues, for example, Xinjiang and Hong Kong and elsewhere. So you wouldn't expect it to be a warm relationship, but it may become much more predictable.
Yes, given the questions around human rights and the way the US, as you say, the Democrats like to reference that, it might be very difficult to see a rollback of some of the sanctions that have been put in place on China by the Trump administration. So I suppose we limit our expectations for change on that front.
Very much so, because you can see that Donald Trump is in fact escalating sanctions in some parts of the world on China, but also on Iran and Libya and North Korea and elsewhere. And that's to sort of scatter these landmines in a way in front of Joe Biden, because once sanctions are on, they're very difficult to remove. And you wouldn't imagine there'd be much appetite in Congress either for that to happen, because both the Democrats and the Republicans are likely to see that stronger stance on China needing to remain. So it's very difficult for Joe Biden, even if he wanted to try and unpick that, and he probably wouldn't want to waste political capital doing so. So you can imagine those sanctions regimes will continue. What you might see is perhaps a de-escalation of this kind of very endless tit-for-tat. To have their next round of trade.
This is clearly something that China views as important, that the US presidents understand the Chinese position on. Is that an area where tension could flare up still under a new administration, or will
for China? And we've seen Xi Jinping making very clear that he doesn't want anyone going near that. You can see, in fact, anxiety in Taiwan as a result, that the
China and Russia. Just briefly, Ros, are there things you're watching in the last month or 2 months?
Or breathe any kind of life, indeed, into the Iranian 2015 nuclear deal that Donald strike on Iran before Trump leaves office, which is closely to get a sense of what might happen then.
Thank you. Ros Matheson, thank you very much. Bloomberg's executive
frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements we can actually have the superb measurements that we expect of sea level rise.
Sea level rise is accelerating, and it is not geographically uniform. In some regions,
what is at the moment what we see as scaled up worldwide, globally, beyond CureVac even.
Welcome back to this special edition of Bloomberg Markets for this Thanksgiving. European equity markets are awake, are trading. We are midway through the afternoon here, European time, and we've got the Stock 600 fairly flat, actually. The UK markets underwater, as well as the IBEX over in Spain, the banking sector, the energy sector, both heavy weights in those indexes, and so as a result, they find it difficult to move higher. Different for the CAC and the DAX, both of those in Paris and in Frankfurt. Fairly flat this hour. That's a quick look at where we are on these European equity markets. US futures for equities, fairly flat actually. No trading, of course, in live markets, live cash markets today, but for what it's worth, Nasdaq futures point to the upside. Let's get a first word news update. For that, here's Leanne Gerrans. Leanne.
Hi, Anna. The Trump administration plans to keep up the pressure on Iran during its final days in power. The US sanctioned 5 companies in China and Russia. Buying American goods under the Phase 1 trade deal. Chinese imports of US products slowed last month after hitting a high back in September. As of the end of October, China had bought only 40 York City that are COVID hotspots. Justices voted 5-4 against the limits. Chief Justice John Roberts joined the court's Liberal wing in dissent. And here in the UK, Chancellor Rishi Sunak has opened up a new rift within the Conservative Party. Sunak has moved to cut the his priorities are with the needy here at home rather than those overseas. And the AstraZeneca and the University of Oxford face more questions about their coronavirus vaccine trial results. Oxford says a manufacturing error led to later phases of the trials halving a dose given instead of a full one. That's led to the doubts that US regulators will approve the vaccine. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
An impact on the sort of exponential growth. Europe, which is a big deal, of course, in terms of the amount that Europeans travel. It also played an important role back in March in actually spreading the virus. So no surprise then that Chancellor Merkel finds herself focusing on that.
Yes, indeed, Anna. So this is one of the things that the regional state premiers have urged Angela Merkel to do, is that she should talk at a European level about banning the skiing season right until January 10 this year, in order to avoid such super spreader events as we've seen in Austria. Amid a lot of resistance. Impact if the skiing season
ended, and they have been extended into much of December. I say lockdown, but that doesn't really mean anything anymore, does it? I mean, I'm sitting here in London. I know that we're going to be in Tier 2 up until Christmas, and I know what I can do in London. There's no household mixing. Pubs and restaurants will shut at 11 and various other things being introduced. What will life in Germany look like then in the run-up to the festive season?
Yeah, so it looks fairly similar, actually. So retail stores and shops, so they will not be allowed to let as many customers in as previously, in order to avoid too big crowds sort of doing their Christmas shopping there. Now, this has already prompted some warnings from the German Retail Association, saying that this will lead to chaos in the run-up to Christmas and huge queues.
Global head of FX strategy at Bank Lombard ODA. Vasilios, good to speak to you. So there's a host of factors I want to talk to you about when it comes to the euro. Let's start.
Really bad and deteriorating inflation outlook if you start excluding potential base effects that we're going to have next year. So it is quite likely that these voices are going to increase. It is quite likely that the ECB is going to step up verbal intervention. But one really, as far as the spot price action is concerned, has to consider how much of an impact that this is going to have in the euro. And I think It is likely that it's going to curb the pace of appreciation, potentially flatten out a bit the curve around 120, 122, 123. But it will not be possible, given the exhaustion of the tools that the ECB has done so far, for the central bank to be able to sustainably talk the currency down. That would be my view.
Yes, I mean, if we did see further quantitative easing coming from the ECB, a top-up of the PEP programme, more bond buying, what kind of impact would this have on the currency? I remember recently when we saw the Bank of England announce further QE. In earlier rounds of QE, that had been currency negative, but actually this was seen as currency positive because the market, just like the citizenry, I suppose, had concluded that further support from monetary and fiscal authorities was desirable at this point, and so it sent the pound higher. So what is the link between QE and FX in Europe at this point?
Well, it's certainly not linear, and it can be different at different points in time. I mean, obviously, with ECO 101, if you increase the supply of money by the central bank, this is going to decrease the value of the First of all, the big player now, this time around, I don't expect that the euro is going to react. Indeed, we're going to see an expansion of the ECB's pandemic asset purchase program, that this is going to bring time. I don't think that the euro dollar is going to be the big trade in next. Asian currencies, and especially the renminbi. Biden's victory is a game changer for the renminbi. I think it doesn't need to be elaborated any further. It just puts it into a dialogue situation between the US and China. The risk is to the downside.
OK, so we'll watch that with interest and not expect too much in terms of rollback of tariffs then, perhaps, Vassilios. On the pound, we've heard from Ursula von der Leyen. We also heard from the Irish foreign minister today, both of them emphasising the importance of the coming days. It sounded quite short-term, the language. I wonder what your expectation is. It feels like we've been to the cliff edge on Brexit a few times.
I think we need to cleverly they will draft the agreement but I wouldn't chase cable higher really than above 137, 138, because we have to remember there are going to be a number of structural headwinds in the UK economy because of Brexit, and at the same time the country is struggling with a huge debt burden.
Okay, thank you so much, Vasilios Giannakis of Bonclobard ODA. Just on the subject of Brexit, we're just getting some lines coming through from the UK Prime Minister's spokesman, Jamie Davies, briefing reporters, saying the UK is keen to intensify talks and reach a deal with the EU. It's up to the EU to decide if they travel to the UK for Brexit talks. This has been after reports that suggested that perhaps the French delegation didn't see that there was a point in travelling. Such was the lack of progress in their view. Coming up on the programme, with the US election behind us and 3 promising vaccines on the table, investors are positioning for what's next. We discuss how to manage stocks and bonds in a low-yield era. Barry Ritholtz joins us next for our next conversation here on Bloomberg Markets this Thanksgiving.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to this special edition of Bloomberg Markets. Then, for this Thanksgiving, investors have been focused on equities in the post-US election, pre-COVID vaccine period of time. But Bloomberg opinion columnist Barry Ritholtz writes it's a mistake to overlook the fixed income part of their portfolios. To explain why, we welcome Barry Ritholtz, chairman and CIO of Ritholtz Wealth Management. He's also the host of Bloomberg's Masters in Business podcast. Great to speak to you. Happy Thanksgiving to you, Barry. Thank you very much for joining us on this special edition. Let me ask you about your thoughts then on the reasons to hold bonds at this moment. We were talking to a guest earlier on this programme, Alberto Gallo, was saying that he doesn't want to hold bonds. He doesn't want to hold sovereign debt anyway at this point. He doesn't see the reason to. What is the argument for holding it right now?
Well, I don't necessarily disagree with him. The issue is, what are your alternatives? And people seem to forget that bonds serve two purposes in a portfolio. One is yield, but the other purpose is to act as a volatility dampener. And it was much easier to ride out the February-March 34% sell-off in equities in the U.S. if you weren't 100% equities, if you had some cushion. And typically, that's a 70-30 or a 60-40 split between stocks and bonds. Doesn't mean you should be all treasuries and certainly not the longer duration ones, but you need some ballast in your portfolio to offset the volatility of equities.
Mm. Does it provide that diversification that people searched for? Is that part of the reason to hold treasuries, or should we not look at them for that? I mean, so many things seem to be correlated these days.
Right. Well, look what just happened in March in the middle of that sell-off. Stocks plummeted. Even things like preferred stocks fell just about as much as equities, but bonds held their own and did better. It becomes a safe harbor. By the way, you don't have to only hold long-term treasuries. High-quality corporates are yielding significantly higher than the 10-year. You also can look at things like municipal bonds that have a higher after-tax yield. And if you feel like you can manage your own behavior, you could shorten your duration in your portfolio, hold 3-month notes instead of 10-year notes, and allow yields to eventually return to normal with the plan of rolling out of 10% of those shorter duration holdings every couple of years as rates rise. The best solution is a bond yield ladder, but that takes a decent amount of cash, and not every portfolio is going to be able to do that.
And every investor has their own sort of risk tolerance, don't they, Barry? And I suppose you've got to keep that in mind when we hear investors talk about going up the risk spectrum and deciding to take on more risk to see if they can find more yield. Are you having a lot of conversations with people about that at the moment?
Well, we spend a lot of time educating clients on the fact that stocks go up and down, and that it's a feature, not a bug. The reason you get a reward in equities is because there's risk involved. And there are years where you're going to see substantial pullbacks, 5% just about every year, 10% every other year. Something like 30% drop like we saw in 2020 comes along much more frequently than people realize. And I've heard a number of people advocate for a 100% equity portfolio. I mean, if you're 25 and you have a 50-year time horizon and you're not going to open your statement each month and freak out, sure. Although if you're a 25-year-old, you're on Robinhood and getting updates every tick. But if you have the ability to ignore the ups and downs, you can bump up your equity exposure a few percent. 60-40 becomes 65-35. But I wouldn't go from 60-40 to 90-10. You're going to have a hard time managing yourself the next time we see a 20 or a 40% drop.
Okay. A good time to have this conversation, and as interesting as it is, Barry, to talk about this, I was really interested in your blog, reading your blog post on how, in your assessment, we're in the midpoints of this changed lifestyle we are all enjoying around the pandemic, and the way that people should think about spending their time. When you reflect on what you've done with the last 7 or 8 months, Barry, and what you'll do with the ones still to come, are you making changes?
Yeah, I've done a number of things. Look, if the lockdown dates to March and best estimates of the 3 different vaccines being distributed in some form of herd immunity is June, we're just about the halfway point, which is kind of horrifying to think about. But, you know, a good part of financial planning is the ability to project yourself forward and imagine how you're going to feel when you're looking back. And that June date made me stop and think, what am I going to wish I did starting now so that after the next 8 months, I have something to show for it beyond, you know, being sick to death of the same 4 walls and walking the same few miles of trails around where I live. So I have friends who want to learn to play guitar, want to learn a different language. I'm a little bit of, I'm pretty handy in a kitchen, but I'd really like to learn how to be a better chef. So I've started taking some, reading some books and taking some classes with that. Same with some classes I took in college on astrophysics that always intrigued me. I've been doing more and more of that. The list is endless of the things you can do in terms of what do you want to have to show for your 16 months of lockdown. Hopefully it's more than just boredom with where you live and some minor changes you've made around the edges.
Barry, my piano's getting a little better. It wasn't very good to start with, but, you know, it's all at the margin, isn't it? And I've seen a number of our guests who we normally talk to about financial markets posting, you know, on various social media platforms, them performing music and that being something of an escape. I suppose it's whatever makes you happy. How's the book coming along?
Well, you could see the cards on the wall behind me is a method of structuring I stole from Ryan Holiday. But, you know, it's slow and steady progress. You have to make a concerted effort to set time aside to do the things you want to do. And all of us who normally would be commuting anywhere from 10 to 20 hours a week, that's found time that could best be put to work with it. It's very easy to get lost on Twitter and social media and online distractions. I'm building a number of breaks within my day to make sure I don't fall into that rabbit hole. And I just keep trying to iterate my calendar, my schedule, and get better at both managing my work time, my play time, and my, you know, self-improvement and learning time.
Barry, thank you so much for your time. Good to speak to you. Walking, that's my new rediscovery. Barry Rittles of Rittles Wealth Management, thank you so much for joining us. Really good to speak to you today. And happy Thanksgiving to you and yours. Coming up on Bloomberg Television, Nomura FX strategist Jordan Rochester will be joining us. Lots to talk to him about. A live shot of New York for you now. The annual Macy's Thanksgiving Day Parade is due to get underway shortly. It is like many things this year. It will look very different. It's a virtual parade in 2020 with performances in a closed set outside the flagship Manhattan store. Not quite the Thanksgiving you're used to, but still. This is Bloomberg.
It's important for each side to understand the sensitivities of the other.
Former U.S. Secretary of State Henry Kissinger said the incoming Biden administration should move quickly to restore lines of communication with China that frayed during the Trump years, or risk a crisis that could escalate into military conflict.
Unless there is some basis for some cooperative action, the world will slide into a catastrophe comparable to World War I, with a technology that is even more difficult to control than the technology of the period then.
There's a lot of concern in Hong Kong, and you can see the way actions, reactions, and further anxieties arise. I hope we can settle down to a new normal.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Two p.m. in London, 9 a.m. in New York. From London, I'm Guy Johnson. U.S. equity and bond markets are, of course, closed for Thanksgiving in the United States. Happy Thanksgiving. Welcome to Bloomberg Markets. Let's talk about what is happening. Markets-wise, light volume is certainly a theme, but nevertheless, some interesting narratives developing. European stocks basically just going sideways. We're seeing a similar story in the SPOOs as well, so S&P futures basically doing nothing right now. But elsewhere, the story is starting to get a little bit more interesting. Euro-dollar at 119. Are we starting to approach levels where the ECB is going to be concerned about what is happening with the currency? We've had ECB accounts today, some indications from Philip Lane that he's getting concerned about what lending conditions are looking like. Does that up the ante in terms of what we can expect come December from the ECB? Then we take a look at what is happening with Bitcoin. A huge reversal continues. 17,000 now the price. Is there going to be a ripple across into stories such as Tesla, other speculative bubbles, some would say? We will watch all of these stories with interest. Some great coverage coming up over the next 3 hours. The virus, though, remains front and centre. Europe continues to grapple with the pandemic. Germany is extending its partial shutdown to at least December the 20th as it sees a record increase in new cases. Joining us now with all the details, Bloomberg's Emma Chandra.
Thanks very much, Guy. Yes, you mentioned Germany there, and we're seeing more than 32,600 new cases in the last 24 hours in Germany, and that is a record increase. We've seen the number of new cases triple since the start of October, and that's bringing total cases in Germany close to 1 million. And that's why we're seeing this extension of the partial lockdown in Germany until at least December the 20th. If you look at the rest of Europe, though, Guy, we are seeing a bit more of a nuanced story. We've got a Bloomberg terminal chart that will show you new cases among the major nations in Europe. I'm talking of the likes of Italy, France, Spain, Great Britain, and of course Germany. And what we're seeing there is that while those cases have surged through the end of October and through November, a lot of those are tailing off in the likes of France, Great Britain, Italy, and Spain. And therefore, we're starting to see those countries change their lockdown measures, perhaps easing some restrictions as we head towards Christmas.
Emma, Thanks very much indeed, Emma Chandra, on what is happening with the virus story. The question we're all asking ourselves now is, as we approach Thanksgiving, as we look at what is going to happen with Thanksgiving, are we going to see an uptick in the United States as people get together? We are seeing some loosening of restrictions here in Europe as we approach Christmas as well. Are we going to see a similar thing over here in Europe? And if so, what is the playbook? Jordan Rochester, Nomura FX strategist, joining us now to discuss this and plenty of other issues. Jordan, if we do see this uptick and numbers are already elevated in the United States, what is the playbook?
Well, Guy, the playbook is don't overreact. Unfortunately, what's happening in the real world is different to what happens in markets. For us, what we need to consider is, does this pickup in virus cases lead to a change in the current playbook, which is central banks are easing monetary policy, they're keeping financial conditions loose, and the fiscal policy keeps on pumping out. That won't change if virus cases go up. In fact, what that means is good news for equity markets, it's good news for risk sentiment, Guy. If you have virus cases going up and lockdowns being needed, it will lead to the Fed striking a more dovish tone in December. It could lead to the ECB also being dovish as well. The question we have to ask ourselves, this would change the playbook, I think, when it comes to currencies, is does it lead to rate cuts? Because we had the Fed cut rates much earlier on this year. The ECB avoided that. They didn't cut rates. And the playbook would change if in December they were to look at the virus numbers, look at the impact it's having, and decide the best step forward is both quantitative easing in the form of their pandemic emergency purchase program and a rate cut. Now, the jury is a bit undecided as to whether the ECB will do that. The market's not really thinking it's going to happen. If it does, then it does change the playbook for the likes of the euro, it would start to weaken. I think really, though, I've got all my medium to long-term charts, Guy, which say with a vaccine on the way, now's the time to be long the euro. It's the time to be long those countries that have underperformed during this crisis as well. A country that is overexposed to leisure and tourism and travel is going to be on people's minds when it comes to what's the trade for next year when vaccines get rolled out. We just have to get through this winter. And it's how long investors can ignore that virus data, Guy, and look to the future. Because you're right, with Thanksgiving, the risk is we have a massive spike in US cases. I think the UK provides a good example. Well, last time I spoke to you, Guy, was actually the day before we went into lockdown, and we kind of called it a last hurrah. I mean, I had a restaurant table booked for that Wednesday before we went into lockdown, and it was actually one of the most busiest open table days in the year. Even versus last year, it was up 40%. So the day before lockdown, everybody went for a dinner if they could, and we actually saw that impact feed through to the data, Guy. We saw around 30,000 cases or so in the UK on a single day. The main point from that lesson is it came off thanks to the lockdown itself, and the numbers have started to fall in terms of cases, at least for the UK. The question will be, will that be the same for the US? Will lockdowns be rolled out after Thanksgiving to reduce the spread of the virus? It's an open question.
Yeah, we will certainly see. It will be done on a state-by-state basis. It certainly seems at the moment. And we do have this patchwork operating across the United States. Let's talk a bit about some of the other issues you've raised in there. I want to start off with the ECB. So let's kind of pick this all apart. We had the accounts a little bit earlier on. Philip Lane, though, is talking about the fact that financial conditions are starting to tighten in the Eurozone. And he may be the canary in the coal mine in terms of exactly what you've just discussed, the possibility that we do get more from the ECB in a few days' time, week after next, and we start thinking about a wider range of assets being used at that point. And Lagarde has talked about this. Jordan, how high do you think the barrier is for the ECB to get over to have to achieve that? Because Lane's already talking about it now.
Yeah, you've also got a stronger currency feeding through to that. The credit lending conditions, they're still supportive, but there's been some tightening in terms of the amount of credit given to households and firms and the standards being attached to that. And that's really important. What we don't want is for the credit channel to tighten up, especially with a vaccine in the pipeline. It would just be really unfortunate if, just as things start to look better, that we see a tightening in conditions that leads to a scarring, a permanent scarring to the economy. The idea is to hope for a V shape and at least get a U shape if we can. And so that's why, for this time being, governments have stepped in. And when it comes to the ECB, that's the point. Their quantitative easing, their PEP, their Pandemic Emergency Purchase Program, it's so powerful. Look at the like of the peripheral spreads, Italy and Spain and so forth. their sort of spread markets have tightened to the bund, allowing the sort of typical trades during a recession is, during a recession, you typically have credit spreads widen. And that hasn't happened in this recession, thanks to the actions of policymakers. So the ECB needs to make sure PEP is stepped up. And they've really spoken about that. Like in the speeches Lagarde made recently, the focus has been on PEP, and it's been on the bank lending channel via TLTROs. Rate cuts are there, and rate cuts tend to get talked about when we approach 120 in euro-dollar, and here we are at 119. But the main thing I'd point out is that the euro versus the dollar, it has strengthened. But actually, versus the likes of China, its biggest trade partner, 22% of all European trade is with China. It hasn't strengthened that much at all. The CNH has also been outperforming. It's just reflective of the broad dollar weakness. So I think, Guy, the market's not too convinced December's going to be a rate cut. You had my colleague George Buckley on earlier. He's got a rate cut penciled in for that meeting. If it happens, it does mean euro comes off quite a bit, as it will be a shock to the system. But what would be the question I would have is this a one and done? Or is this a series of rate cuts to come? And if it does happen, it's probably more likely to be a one and done, with next year going to be the reopening trade and back to normal trade, where central banks won't need to be cutting rates. They'll just be here to make sure that fiscal can continue and have a lot of QE.
Jordan, final quick question. Crude down a touch today. NOKI's been a huge beneficiary over the last few days. How much more is there in that trade?
Well, the problem with oil is OPEC's going to try and manage the supply side here. And so with the return to normal trade next year, the normalization trade, I would be optimistic on energy. I would be optimistic on the likes of CAD and NOKI. It's just how much demand picks up versus the supply that OPEC will be giving. For the time being, OPEC will be trying to make sure prices stay sustained. So I'm pretty optimistic, Guy, on the likes of NOKI. I think NOKI could be one of the outperformers of next year. It's already outperformed this year. But in terms of the return to normal trade, I've got to look at the likes of Aussie, Kiwi, CAD, NOKI. Those high beta currencies will probably be the ones that investors look at. A lot of us are really just looking at what happened in 2009. And you had the big commodities boom. And the question is, does that happen? I'm not going to call for a big commodities boom, but it's at least going to be in one direction, which is slowly drifting higher. So the likes of those currencies, I think, should outperform next year.
Jordan, stick around. We still need to talk about Brexit. Can't believe we've got this far without mentioning it. We'll be there soon. Jordan sticking around. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
12 minutes past the hour, live from London. I'm Guy Johnson. This is Bloomberg Markets. Let's talk about UK assets and what is happening with Brexit, the pound, and everything else. Here with the details, Danny Berger.
Guy, well, just a quick look at what's happening in UK markets today. You can see they're absolutely underperforming the stock 600, and really is a story of what we've seen over the past few months. And that's this confluence of factors for the region, not just COVID, but of course Brexit concerns as well. We had seen the pound do better over recent days, over the past week, really with speculation that we're getting closer to a deal today. And overnight, the French foreign minister says that the UK is dragging its feet. Unclear whether that deal will be reached, what progress it is making. So we're seeing the pound decline, but this is reversing a couple days of gains, about 4 days of gains. So yes, it's down 0.3%, but there's not a lot of volume. And what that gives us is a picture of divergence. And I want to dive into the charts for this because the pound floating around a 3-month high, again, despite the fact that we've seen it decline. Here it is in blue. So you can see it continues to do well. But as Nordea, Sebastian Gailey says, that there is perhaps not enough risk priced into the pound. You can see that happening underneath the surface. Here's what risk reversals are doing. 1 week risk reversals now at their most bearish since September. So investors perhaps pricing in that things are not as sunny as the cash markets are saying, perhaps gearing up for any sort of hedging because the cash market is higher. But really, more investors are saying any temporary boost we get from a deal will likely be followed by a drag lower in the pound as coronavirus continues to hurt the economy, Guy.
Danny, thanks very much indeed. Danny Berger setting up very nicely our next conversation. Still with us, Jordan Rochester of Nomura. Jordan, is cash not pricing enough when it comes to the downside? The UK economy is taking a beating right now. Brexit, the risk of a no deal still lingers. Are we really pricing that in at 133?
I think Danny summed up really well there, Guy. First of all, if I look at the futures positioning data, the market isn't really long sterling at all. It's actually net short, a very small amount, around half a billion or something like that. But the numbers are really tiny. Why? Because a lot of people have just said, you know what, I don't have a good idea what Brexit's going to mean into this year end. Let's not have too much risk in this. So the speculative market is actually playing this very lightly. It's why you've seen that drift higher in cable, as that chart just showed you, but 1 week risk reversals, which is hedging for the 1 week downside in cable, has been picking up. I think, Guy, if you look at the spreads as well, we look at 26 different UK assets from rates, credit, equities, and FX. There is a premium priced in for Brexit. So the trade we've had on, actually, I've got long cable on, looking for sort of 135 levels on a deal being done to 136. That's the sort of targets I have in mind in the short term. And bear in mind, we're talking about cable as well. And we've got a very strong view that the dollar should weaken in the medium term as well. So that should drift cable higher along with it, thanks to what the euro is doing too. So you've got risk priced in. It's just not as crazy as it has been in previous hard Brexit episodes. Why is that, Guy? It's because we're so used to the trade deal or the necessary steps being made at the very last second to avoid that cliff edge. Now, Boris already threatened a hard Brexit several times, more recently in October, I believe. The market shrugged it off. And why is that? It's because the base case remains a skinny free trade agreement. It's not a game changer. The City of London loses passporting. So it's a small positive, and in the long term makes very little difference versus a hard Brexit, according to some models. So, Guy, view from us is the deal should be done. It's just frustratingly boring when it will happen. Will it be this week? Will it be next week? And the front end of FX markets has to deal with that. But I do agree with the comment from Danny there. Yes, it doesn't look like it from cash markets that enough risk is priced in the short term. But the problem is we've just had 4 years of this. The market's just got to grow a thick skin to all of this sort of political drama and focus on the base case, which is dollar weakness and a deal hopefully done with Brexit in the medium term.
OK, a couple of things in there. First of all, would you fade that move to 136? And do you think there is a setup now that is growing for a counter-cyclical short-term rally in the dollar?
Well, OK, so if we have the deal, I said for a while that when we get the deal, it will be a buy the rumor, sell the fat moment. So you'll have sterling go up, it will trade sideways for a few days, and then actually start to drift lower. Looking at the situation with the US, with the sort of split Congress we've got, in terms of the balance of payments from the US and the lack of Fed QE mopping up that excess Treasury issuance, it's actually really hard for the dollar to rally. And that's why with cable, it's kind of a tricky one to be bearish on the pound with. If you want to have a clearer investment outlook, for me, it is the euro. So perhaps to buy the rumor, sell the fact trade is not in cable. It's more of a euro sterling sort of trade. And then if you really want to get where we're sat right now in the UK. So it's also going to be one of the countries that people look at as the return to normal trade, even though it's got Brexit, which won't be normal, in the background. So it's definitely a mixed picture there. Going to your dollar question, there's only really one chart I can show you that suggests you should buy the dollar, which is positioning. It's everyone's favorite consensus trade, short the dollar. So typically it leads to these position squeezes. We saw it earlier this week. Euro went from 119 nearly down to 118. It was a big move just within a matter of a few minutes. You're going to see more price action like that. But again, I've got about 40 charts telling you to buy euro dollar, and I've got just that one chart, which is speculative positioning. But just got to deal with it. Really found it exciting, but I've just since then just hands off. Not for me to mess around with. The vol's too high. 9% in a day. It's not for me.
It is a little whippy. I think that probably is an understatement. Jordan,
it's an understatement.
Thank you very much. Yeah, thanks very much indeed. Jordan Rochester of Nomura joining us.
Once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonises it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
Happy Thanksgiving. Time for Bloomberg Business Flash. Let's take a look at some of the biggest business stories that we are watching right now. Disney has announced 4,000 more job cuts after virus lockdowns forced the closure of its theme parks. That takes the number of layoffs set for the first 6 months of the year next year to 32,000. That's more than 10% of its workforce. The coronavirus pandemic has hammered Disney's traditional businesses like studios, parks and cruises. Bloomberg has learned that Foxconn will move the manufacturing of some Apple iPads and MacBooks from China to Vietnam. The company is trying to mitigate the risks that a trade war between China and the US may continue after Donald Trump is facing more questions about their coronavirus vaccine trial results. Oxford says a manufacturing error led to some participants getting the half dose instead of the full one. And that's your Bloomberg Business Flash. Now, let's take a look at the future of European banking. Bloomberg's Francine Lacroix spoke to BNP's chairman, Jean Lemierre, a little earlier on today. She started by asking him the big question for European banks, and that is, when will they be able to restart paying dividends?
Of course, shareholders do is possible. I think the decision made, the recommendation given by has been broadly but to a large extent we are still in difficulties. Let's be the reopening of the business is moving forward, but there are still many difficulties. So I think there's still a level of difficulties, but I think there's more certainty. I think we understand better what by the ECB about the recommendation they will give in December.
Markets have to be less exuberant.
Light at the end of the tunnel. I'm very confident scientists are developing vaccines and medicines which are going to help a lot people to go through this virus crisis. So there will be one. Now, we know there are many questions about production, about
Francine Lacroix a little bit earlier on. This is Bloomberg.
Jawohl. Können Sie einmal noch ganz kurz zu uns kommen? Ganz kurz.
Davor stellen.
Our generation's biggest.
바다에서 태어나 바다로부터 자유로움. 리얼 앵글러를 위한 오리지널 피싱 기어 잔카.
I'm certain that we will be able to bring our debt levels down and avoid what you could call a debt crisis because we are focused and we've been open enough by telling the nation that we have too much debt.
To give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From London, I'm Guy Johnson. This is Bloomberg Markets. Let's check in on the Bloomberg First Word News. In the UK, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed in Tier 2. That means pubs, restaurants and bars can open for business, but alcohol can only be served as part of a meal. Households will not be able to mix indoors. It looks as though China won't meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of US products slowed last month after hitting a high in September. As of the end of October, China had bought only 44% of this year's target of $172 billion worth of American goods. And a divided US Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. Cuomo wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against the limits. Chief Justice John Roberts joined the court's liberal wing in dissent. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 127 countries. Let's keep the focus on the coronavirus crisis. US authorities say airline passenger numbers reached their highest point since mid-March as Americans fly for the Thanksgiving holiday. All that travel could, of course, worsen the pandemic. Joining us now, Hamish Adolja, Johns Hopkins Center for Health Security senior scholar. Good morning and thanks for joining us on Thanksgiving. What is your expectation in terms of the uptick that we could see in case counts in the United States as a result of all this travel and gathering we're going to see today on Thanksgiving?
Based upon what we're seeing with airports, with travel patterns, with mobility, and people's desire to get together with their families, I think it's inevitable that we'll see a significant uptick maybe 10, 14 days after this, which will end up leading to more hospitalizations and more hospitals worrying about capacity. I think we saw, if you look at the Canadian Thanksgiving about a month ago, the same type of phenomenon occur. And I do think that we will have that same scenario in the United States in a system that's already feeling a lot of stresses from COVID patients.
Dr. Adolja, do you think as a result of that, we are going to have to see tighter restrictions in terms of social mobility?
I hope that we don't have to go to tighter restrictions. I hope we can use targeted public health, understanding that many people are getting infected now at private gatherings, and it's going to be very hard to keep those under more control because public health can't really reach into people's homes the way it can if you're talking about a restaurant or a bar or a gym. So I really think it's important that we understand how people are getting infected and target only those activities in which people are getting infected. This has to be a sustainable approach, and we're really facing a lot of pandemic fatigue right now in the United States. So we want to make sure that we're doing the most measured types of actions that don't cause us ancillary damage, but keep our hospitals out of crisis. And it's a very tight balance. And again, the problem really is that we don't have a way to reduce the harm from this virus without home testing. And I've been seeing a lot of discussion about home testing, and hopefully that will be something that really allows us to move forward in this pandemic prior to the vaccine.
Do you think the change of tone from the incoming administration will have had any effect?
I do think the change in tone is going to have a dramatic effect. We know from the very beginning of this pandemic that the highest levels of our government evaded, misinformed, and lied and took the wrong actions when it came to COVID-19. So it can only get better with a change in transition, with the change in team. And also, if you look at what the transition team has articulated, it's many of the same principles that all of us in the field had been talking about since January of 2020. So finally, we may have a pandemic response that will be on track to actually get some level of control of this virus.
Doctor, I've heard the phrase over the last few days, light at the end of the tunnel, and there seems to be a sense that we're beginning to understand how long the tunnel is. What is your sense of how long the tunnel is?
The tunnel is several months long. If you think about the general population of the United States or some of the developed countries, we're looking mid-2021 for them to have access to the vaccine. Healthcare workers maybe can start to get the vaccine next month, but it's only going to be in small numbers. So we're still going to have to think about trying to control the spread using our ordinary means of social distancing, of people washing their hands, of wearing face coverings, and avoiding congregate settings where people are too crowded together. So this is still going to go on well into 2021. There are lights at the end of the tunnel. It's really important to remember that. But again, as we've said, there is a long tunnel that we still have to traverse, and a lot of people are going to die during that time, and a lot of hospitals are going to worry about capacity during that time.
In terms of the new administration, back to that, what is your sense of their ability to handle what is going to be a huge undertaking in terms of getting the vaccine rolled out, particularly the mRNA version of the vaccine, considering the temperature restrictions that are required to keep that stable?
No matter who's in charge, it's going to be a Herculean project. This is going to be one of the biggest public health endeavors we've ever done in this country and in the world. So it is going to be something that requires a lot of coordination, a lot of challenge. So it's very good that the Trump administration is allowing the transition team to meet with those individuals finally to allow this handoff to be seamless. But I do think because of Operation Warp Speed, and I would say that this deserves credit, this is one of the bright spots in a really bleak pandemic response. There is a lot of work that's been done, a lot of logistics with the U.S. military, with UPS, with McKesson, which is a company that delivers products to hospitals. So I am confident that this can be done. It's going to be very challenging with the Pfizer candidate. As you said, it requires an extreme cold chain, -70, -80 centigrade. That's going to take extra steps. And UPS, for example, is making freezer farms in places like Kentucky so that they can distribute from there. The other vaccines are less logistically tricky, but it's likely the Pfizer vaccine that's going to be the first that starts being put into the arms of Americans. There's going to be hiccups. It's not going to go off without a flaw. And it's really questionable how well states themselves can deliver these vaccines. Do they have the funding to be able to set up distribution channels? All of that's going to be really important. It's not going to be an easy thing, and we should expect that there's going to be holdups and issues with supply chain. But I do think that this looks to be a robust process, and hopefully it goes off without a hitch as fast as possible.
As I say, thank you for joining us today on Thanksgiving. Dr. Adolja, we really appreciate it. Dr. Amish Adolja of Johns Hopkins University. We should also note that he also works with the Bloomberg School of Public Health, JHU, which Bloomberg LP's founder, Michael R. Bloomberg, of course, supports. Coming up, we're going to talk shopping. Amazon backlash. Well, that's a phenomenon here in Europe. Retailers are getting ready for Black Friday, but the e-commerce giant is in Europe's bad books. We're going to find out why next. This is Bloomberg. Live from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. So retailers all over the world are getting ready for Black Friday. But Amazon has ended up in Europe's bad books. In France, the e-commerce giant has agreed to postpone the event until shops reopen in December. In Germany, the Verdi Union has called a strike in Amazon warehouses on the biggest shopping day of the year. Joining us now for the Black Friday backlash, Bloomberg's Maria Tadeo. Maria, walk us through why this is happening.
Well, Guy, there's a number of reasons. And the one is, the first one I would say is very obvious. It has to do with coronavirus and it has to do with the lockdowns. If you have a clothing store, if you are a bookshop, clearly you've not been able to do your normal business hours. You're not making the money that you hope you would have made by now, and your revenue has really plunged. You're still having to expense, however, perhaps the rent of your store and the office space that you take. On the flip side, when you look at the business for Amazon, it has really just rocketed under coronavirus. We're not able to go out on the street, so clearly we turn to online shopping, and that's being reflected in the market cap of the company, but also the personal wealth of Jeff Bezos. And that is something that is really hitting a nerve for the small, medium companies in Europe, but also for governments. They have to react to this, and they can tell that a small company doesn't have the same amount of distribution. They don't have the same means that a big company, big U.S. company would have, and they have to attend to that. That's being reflected in some of the measures that the French government has put forward, really forcing Amazon to delay the Black Friday so that there would be fair competition for both and everyone. And then lastly, Guy, there's a huge debate here happening on the tech and the taxation. This is something we've talked about for a year. The Europeans do feel that the Americans should be paying much more and that they should play under the European playbook. So it's a lot of different issues coming into phase, but of course the pandemic really hitting a nerve in a number of countries in Europe.
Is this becoming something of a populist theme as well? You highlighted in a note earlier on the fact that Matteo Salvini was talking about this in Italy. We've also got Barcelona coming up and talking about this as well. Is this something that opposition parties, populist parties, are starting to talk about and using as a point of attack?
Yeah, they do, because it taps into the anger that we are seeing and that we are going to see. Because, Guy, I mean, this is not a secret. By the spring of 2021, we are going to see companies go down. A lot of the help from the governments and the moratoriums that we've seen on payments are going to disappear. We're also going to see unemployment level very highly or very likely go up. So clearly here you have a group of people that are unhappy, that feel they're not being treated equally, that American companies, big American techs, does get some advantages that they do not get, and that of course are going to vote, whether this is a national or a regional election. It's a market, I would say, or it's a group of people that clearly for opposition parties is something that they want to tap into. And for the government, it's very difficult to handle too, because they're trying to appease everyone, but of course they'll have to decide whether you're some big company or not, and some will have to go down.
Maria, thanks for the update. Maria will be rejoining us a little bit later on. We're going to talk about the ski season as well. As with everything in 2020, Black Friday is going to be different this year. COVID-19 changing the shopping experience, and America's biggest apparel retailers and department stores are certainly rushing to adapt. Bloomberg's Ritika Gupta has the details.
Black Friday, the unofficial start of the holiday shopping season, is upon us. While retailers would normally showcase doorbuster deals, fully stocked shelves, and a frenzy of shoppers, COVID-19 has drastically changed the shopping landscape this season. Stores are rushing to adjust, offering seasonal deals earlier this year to avoid a holiday crunch. Stores are bulking up direct shipping and in-store and curbside pickup, with Adobe Analytics predicting a 40% rise in pickup shopping methods. Traditional brick-and-mortar businesses are also focusing on shifting to e-commerce. Online sales are expected to surge 33% to $189 billion, according to Adobe Analytics. That will not only pressure retailers to adapt, but will stretch fulfillment networks across the US. Getting that change is crucial for struggling stores to survive. Industry analysts warn that shifts towards e-commerce and contactless shopping methods could be permanent. So if shoppers don't have a good experience this season, retailers could risk losing them for good.
Ritika Gupta previewing Black Friday tomorrow. For more on how this translates across the Atlantic, let's bring in Charles Allen, Bloomberg Intelligence Senior Retail Analyst, and Bloomberg's Emma Chandra. Emma, let me start with you first of all. How big a deal in reality is Black Friday over here in Europe? It came about 10 years ago, I remember. Has it embedded itself in our cultural identity?
You're absolutely right. It is an American import. It started really because we saw Amazon go after these big Black Friday deals in the US, also the likes of Walmart, but Amazon really the sort of transatlantic company that we all came to know. And that really put a lot of pressure then on companies in the UK and in the rest of Europe to follow suit and offer deals at this time of year. It has been something that we've seen a number of companies really push and adopt as a way to get shoppers into store pre-pandemic and in the past 2 years. But there is some evidence to say that it is starting to wane in terms of its popularity. Some information from PricewaterhouseCoopers coming out saying that UK spenders less likely to spend this year on Black Friday, that only about 40% are looking for particular deals this time around. That can also have a lot to do with, of course, lockdown fatigue, the fact that a number of stores are closed, or most stores are closed in this partial lockdown. And so we're starting to see perhaps a waning of interest in Black Friday in Europe. Whether or not we will see the end of it, whether 2020 will see the end of Black Friday in Europe, remains to be seen. But it isn't as big as it is in the US, certainly.
Charles, let me bring you into the conversation. When I was growing up, you would wait until we saw the Boxing Day sales and then the New Year's sales, i.e. there was a run-up to Christmas that allowed retailers to make money. Black Friday has undermined that. How damaging is it for European retailers?
Well, I think, Guy, that you have to recognize that the retailers plan for Black Friday. I mean, yes, there are a lot of promotions around and things like that, but these are planned promotions, just as many of the Boxing Day ones are. So people are planning to make a profit on Black Friday. And, I mean, the bigger problem is maybe arguably about how you've created this peak at the end of November, which drags a huge amount of business from early December to that peak, and then you get the build-up to Christmas, and then, as you say, the after Christmas and New Year sales across everywhere. But I don't think you should necessarily see Black Friday as it was maybe in 2013 or 2014 as just discounts instead of full-price sales.
Is it starting to fade?
Well, again, I mean, it's difficult to know. I mean, as we've all said, this is a very unusual year. And, I mean, I think one thing you've got to recognize is that this year, during lockdown, we saw what you might say is sort of traditional Black Friday items like laptop computers, home appliances, televisions, some games consoles and things like that, all sold really well over the summer. So, I'm not surprised that if you bought a laptop in June, you're not going to want to buy another one in November. So I think it'll have to be more than 1 year before we see that. But, it is part of the planned promotional calendar. I mean, there will be retailers, AO World or Dixon Scarphone, who will be sitting down,
Coming up for you, the Bitcoin roller coaster. Hi from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. So Bitcoin fell as much as 10% today. It's on track for its worst day since May. The rout began just hours after Bitcoin rose within $7 of its record high. Joining us to discuss both the boom and the bust, Danny Berger. Danny, in terms of the impact that this turnaround is going to have, how are investors likely to take it? Will it just be a blip, or do you think this is something more serious?
Guy, even though some of the weakness may have been driven around concerns of U.S. regulation, I think it's really, really difficult for investors to write Bitcoin off at this point. I love what Eddie City points out that Bitcoin, throughout its entire history, has these intense rallies followed by bear markets.
So let's talk about the relationship
capitulate when it comes to gold, but I think Bitcoin is still exchange traded market. It has a lot in Europe. Van Eck just launched one today, but they're not allowed in the U.S. The UK just put new regulations that make it very difficult to launch anything. So I think volatility coming down and more of those products really are key to see Bitcoin start to challenge gold.
just in a few seconds.
And in the UK, same story, concern about protecting retail investors. They think Bitcoin is just too volatile and too much money can be lost.
Particularly around value stocks. What is his take there? Also, we'll get his take on the pound. Chris is going to be joining us shortly.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing.
Three p.m. in London, 10 a.m. in New York. From London, I'm Guy Johnson. US equity markets and bond markets are is leading up by around 1%. The cyclical sectors are underperforming. Cars are down by 1.4. Banks, energy, insurance, the mining sector coming under a little bit of pressure. US futures are telling us that we're going nowhere as well. Not much action there. Euro dollar trading with the 119 handle. That's starting to alarm the ECB a little bit. Accounts out a little.
Thanks very much, Guy. 32,687 new cases in Germany in the past 24 hours. That's a record increase. We've seen new cases in Germany triple since the start of October, and the total number of cases approaching 1 million in Germany. And what this means is that the partial lockdown that we had seen in Germany is going to be extended. In the major European nations, cases surge through the end of October into November. But they are starting to tail off. Not in Germany again, but they are starting to tail off if you look at France, the UK, Spain and Italy. And that's what we're seeing now from those nations. Today in the UK, we're going to see England's lockdown. You have to remember it's a more nuanced issue in the UK because of the different nations and regions. But England's lockdown is due to end now on Wednesday. And what we'll see is that reintroduction of the tier system. With different regions, different
us now, Chris Watling, Longview Economics. In the virus case.
Some of the numbers are quite extraordinary. I was looking at the energy sector yesterday, up just short of 40% in the month of November so far, with a day or so left. So quite extraordinary, some of the sector moves and some of the rotation. But actually, what normally happens at major turning points in markets, when you get a major shift in leadership, you tend to get very dramatic moves because the shorts get squeezed very aggressively. No one's in those sectors because they've performed so poorly for so long. And you get a scramble to sort of start moving into them and a scramble to get out of the shorts. So, I think that's behind why the moves are so dramatic. But having said that, there's clearly quite a lot of speculation in this market in the very near term. And you can see that in terms of the sort of level of call option buying and some of the moves we've seen in some of these stocks, as I say. So, I think if I look at some of our indicators that measure fear and greed, the market's become very greedy on a sort of short-term, multi-week basis. So I think this is the start of a very major medium-term, long-term move, but I suspect it needs a pretty serious pause for breath or even a bit of give back to unwind some of that excessive optimism and greediness that's just sort of creeped in.
So potentially better entry points still to come?
Well, maybe better entry points than what we have today, but certainly not better entry points than we had at the beginning of November. That's right, yes.
In terms of how you manage this process, and yet I look at what is happening. Is still in a position where it's likely to have to raise significant amounts of cash, and that is likely to be dilutive.
Well, there may well be an argument for making sure you pick the winners in each sector, the stronger hands that survive. The points, everything goes up, and the stuff that's the highest risk, highest volatility, the most uninteresting stuff in a way from a fundamental point of and they're still not really convinced, particularly if you think about European banks. But if we've genuinely changed the really, the trade's just begun, the investment story's just begun. It's just a pretty
$80 bips and change. We're trying potentially to get
a good move already. I think it was 55 bips on the 10-year in the US back in, I think it was in August at its lows or July. And as you say, we're now 80 and change and moving higher. That's quite a significant move on terms of, percentage of the basis points up, if you like. But yeah, we need to get to 1. We need to get to 1.5. Look, I think the biggest risk to this equity market is not a steady move higher in bond yields. That would be terrific, but a dramatic move higher in bond yields sometime over the next 6-9 months, because it strikes me there is so much stimulus in the pipeline. There's so much cash in people's bank accounts. And there's such a high risk, I think, of inflation picking up and growth being super strong next year that bond yields at 80 bips just seem completely the wrong level to me. So I think, and by the way, on top of that, the positioning in markets is completely wrong. Everyone is long 10 years and 30 years and overweight that area. So, I think there's enormous amounts of risk that we have a repeat of a 1994 bond market sell-off or something like that. And I think that's the sort of thing that if it really happened and was dramatic, then I think we'd have some challenges for the equity market.
Can I just focus on the banks a little?
Well, yeah, I mean, yes and no. I mean, I'd say no because actually the one trade we've got on, or one of the trades we've got on, is a widening of US Treasury yields relative to bond yields. So, you know, there's a much stronger case for Treasury yields to back up than there is in bond yields. So, I mean, bond yields than there is in the Eurozone. So the growth drivers are much better in the US, so the spread should widen. And actually, if you look at it, Eurozone banks correlate much better with
about what is happening in the UK.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Chinese capital market, as you know, is nascent, is just developing, and so we think there's an opportunity to build out that. But that's not all. We're also focused on continuing to build our presence in the Greater Bay Area. It's been a good business for us.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. Thomas Byrne, the Irish Europe Minister, just making some comments on Brexit. Brexit talks at a critical juncture, he says. I think I've heard that one somewhere before. Very little time left. I think I've heard that one as well somewhere before. Let's figure out where the markets are, though, when it comes to Brexit. Here are the details. Danny Berger.
Guy, I guess it's another crunch week for Brexit as well. This sort of roller coaster ride continues, and it continues to impact assets as well. Some speculation that we've seen over the past week that we were heading closer to a trade deal helped to send the pound up for 4 consecutive days. Well, that's now reversing. You can see sterling down about 4%, 0.4% versus the dollar. But I really want to point out this divergence we're seeing in the rest of Europe versus UK assets. They're mostly flat. Yes, trading as light. flight. There's a U.S. holiday. But I think this continues to emphasize the dual risks that the U.K. has to deal with. The economy and the effect on the economy of COVID. The U.K., of course, has been very hard hit, as well as these Brexit risks. And that divide, you can continue to see what's happening in the cash sterling market versus what's happening underneath. And I want to dive into the charts for this because this really interesting divergence has been occurring over the past week. It's not this one, though. This is virus flare-ups in Europe, of course, relevant as well. But we've seen the pound continue to gain. It's at about a 3-month high. But 1 week risk reversals, those right now are at a September level of bearishness. In other words, the option market is saying the pound is going lower from here. It wants to protect itself against 1 week, whereas the cash market is not saying that. As Nordea's Sebastian Gailey said today, the cash market is not pricing in enough of the risk that we don't have a deal. There's the chart. There's that divergence, Guy.
Better late than never. Danny, thank you very much indeed. Danny Berger on what is happening with sterling. Do you believe the cash price, I guess, is the question. Does Chris Watling believe where we're pricing cash at the moment? He joins us from Longview Economics. Chris, do you sell the pound here? It seems we've got a bunch of risks coming into view for the UK economy. We still don't know what is going to happen with Brexit. We saw the dire economic projections from the Chancellor yesterday. Nevertheless, if you believe in the bounce-back trade, I guess the UK could be well positioned.
Well, I mean, everyone's well positioned, so it's a relative game, isn't it? And of course, the UK has this special factor of Brexit that's had some influence on its currency. I mean, clearly the currency's rallied in part because the dollar's been going down against everything over the last few months. But I think Brexit's got its own sort of special influence here in the UK. And, you know, markets are very forward-looking, and really all the chatter has been, really, if you think about it, we're going to get to a deal. It's basically the implication. So I think the market expectation is relatively robust for a deal to come through. And no doubt we'll get a little pop on the announcement of the deal when it happens. I mean, who knows? As you say, it was supposed to be last week. It's supposed to be this week. And now it's supposed to be next week. But we'll probably get a small pop on that. And it's interesting, you know, we're at quite a key level for sterling. 134 is quite a level. It's been quite a resistance level a number of times over recent years, and we've really only been above it once over the last few years. So you know, we're quite close to that. Maybe we pop above it briefly on the announcement, and I think that's an opportunity to sell sterling because I think fundamentally we don't look as good as we could look, and clearly Brexit's a bit of an impediment to growth in the medium term. And actually, we've performed very poorly relative to the rest of the world in terms of, you know, our COVID health response, but also our GDP numbers as well. We had some of the worst GDP numbers of the lot. So I'm bearish on sterling. It's become a consensus long. You know, the consensus sentiment's very bullish. So you want to lean against that. You've got an interesting resistance level, and I'm not sure the UK is going to be outperforming the US economy over coming quarters and years. So yeah, I would be looking to average into short positions on the pound versus the dollar.
Can I just come back to that issue of how beaten up the British economy has been by COVID? And part of that is down to the composition. There is a lot of consumption in the UK. There is a lot of hospitality. All of that has certainly suffered as a result of COVID. But in theory, therefore, that should make it one of the bounce-back trades, shouldn't it?
Well, that's true. There's something to be said for that. But I just think also our approach to lockdowns and our approach to healthcare weren't very good. I mean, to be fair, they weren't that good in the States either. So you could make that argument there. But yeah, I just feel that there's some real issues that are Brexit related, London related, and I think there's some real challenges this economy faces. So it's yeah, of course, there's a bit of cash in bank accounts. That's going to help. But I think across the board, our general sort of governance, our performance of the government, I just think it was poor. And I think that adds to the reason to be negative, particularly when everyone's bullish, as I said.
How bad would a no-deal Brexit now be? It does seem as if you could put a very thin piece of paper between a deal or no deal. Manufacturing would certainly suffer, one of the areas that has actually stood up during the COVID crackdown. How bad would it be? The Bank of England is suggesting that it can actually be even worse in terms of its impact than COVID.
Well, I think there's some real challenges short term. Yes, you'll get all those queues, they'll get the paperwork. What will happen to the financial services sector? I mean, that already looks slightly out there and a lot of uncertainty as to how that's going to pan out between the equivalence or non-equivalence debate, so to speak, between the City of London and European financial services. And I think with queues at the ports and struggling in terms of supply chains and challenges for a financial services sector in a no-deal Brexit, I think it would be a real issue for this economy over the course of the next 6-12 months. So that's clearly a very UK-specific risk that's pretty meaningful. I mean, of course, it has some knock-on effects on the Eurozone as well, but primarily it's a risk for this economy. So, yeah, I think it could be quite serious.
Chris, on that note, we will leave it. Thank you very much indeed for your input today. Chris Watling of Longview Economics. We're just getting some numbers through from Andrew Cuomo, stateside New York, reporting 6,933 new positive cases. That being tweeted out just a moment ago. That's a pickup of around 1,000 versus yesterday. New cases for the first time picking up really quite sharply now. Hospitalizations now above 3,000. What do we got coming up for you? A brewing diplomatic spat over skiing. The German Chancellor Angela Merkel pushing for European ski resorts to be shut down this winter due to the pandemic. Not everybody's on board. We're going downhill fast next. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. So a diplomatic spat over European ski resorts is now brewing. The German Chancellor Angela Merkel basically says that they should all be shut down for the time being this winter to rein in the virus outbreak on the continent. Joining us now from Brussels is Bloomberg's Maria Tadeo. Not everybody agrees. How big an issue is this?
Well, they don't agree, and Guy, this would almost seem like a sketch. It would almost seem like a parody in the midst of a pandemic. We are debating whether or not to go skiing, but it is becoming an issue between four countries. That's Germany, Austria, Italy, and France. Now, the Germans, as you pointed out, they've made it clear they believe resorts should not be operational this year. Angela Merkel does believe that we could see a third wave after the Christmas holidays. And she's also pointed out that one of the lessons we should take from the summer is that opening up too much and too quickly is problematic. However, the Austrians say that they do not fully agree with this. They have taken the measures and they want to open. They also signal that if you are a resort and you're not able to open up this year, you're not able to actually do a normal season, you're going to turn to the state. And ultimately, it's the government that's going to have to pay for this. It's also leading, Guy, to some surreal regulations regulation coming out of European governments. Today, the French government said that they would go ahead and open, but just to give you an idea, the cable car that takes you top of the mountain, that would not be able to be operational as usual because it means too many people in a closed space. So it does have potential to run into a diplomatic issue. If one country decides to open, the neighbor says they don't want to open, but also it's just some of the surreal regulation that is coming out of this. It's also very difficult for people to follow, frankly.
Yeah. Okay, if you telemark, but for everybody else, probably not so good. Maria, I just want to turn to a more serious issue. This is serious, but there are more serious issues that Brussels faces right now. We are starting to get some comments coming through from Viktor Orban out of Hungary. Hungary won't accept the EU plan that Poland doesn't accept. There is commonality between Hungary and Poland, apparently. They've signed a joint statement on the EU budget. They are aligning their positions, saying as well that the EU must separate the rule of law debate from the spending plan. How does this get resolved? Because at the moment, the 7-year budget plus the attached rescue plan is going nowhere.
Yeah, it's going nowhere. And, Guy, that December 10th meeting, it's looking harder and more complicated by the day. There's a lot of issues that European leaders will have to deal on that day. Now you're looking at a potential veto on the recovery fund, on the European budget. This is extremely, extremely problematic for the Italians and for the Spanish. They've made it clear yesterday to those two countries that they do want to see this recovery fund operational by January. Now, how do you solve this? It's difficult because Poland and Hungary are simply restating positions that they already said they have, that they want to see a separation between the funding and the rule of law, that they see one as just being purely economical and the other one is about politics and ideology. They don't agree with this liberal view of the world. But for the European Union, it's very tricky to separate the two of them, but also for countries, particularly like Mark Rutte, like the Netherlands, the very liberal democracies of Europe. They've made it clear they're not paying a cent if this money is going unchecked to Viktor Orban. Now, ultimately, perhaps this comes down to Angela Merkel and the EPP party, but at this stage, it's very difficult to see how you cut a compromise right now. The two sides are very far apart.
You wonder what the plan B is. We may find out after the meeting on the 10th, as you say. Maria, thank you very much indeed. Bloomberg's Maria Tadeo. Coming up, we'll talk more about what is happening with the ECB. The ECB stimulus plan luring investors into Eurozone corporate credit. We'll talk about also the accounts today that were delivered and those comments that came through from Peter Lane. Peter Chatwell, Mizuho head of multi-asset strategy, is going to be joining us next. This is Bloomberg.
In our interconnected world, if people in low and middle income countries miss out on vaccines, the virus will continue to spread and the economic recovery globally will be delayed. Equitable access is in the national interest of each and every country.
But this also means if we have a vaccine, we should have a common approach to give a fair share to everyone so that the most vulnerable groups, the frontline workers and the healthcare workers, for example, are the ones who get the vaccine first.
We're donating another $70 million to fight COVID-19. $50 million of that will be for buying vaccine doses for low-income countries, and another $20 million will be for researching even further and new vaccines altogether.
Il nous faut nous assurer que les conditions réglementaires et politiques sont toutes réunies pour un accès le plus large et rapide possible à ces produits, tout en respectant les standards internationaux de qualité. C'est pourquoi la France propose que puisse être rapidement adoptée une charte d'ACTA qui réaffirme ces grands principes. Partager la connaissance, soutenir les systèmes de santé, avoir des produits rapidement accessibles et abordables.
What is at the moment what we see as scaled up worldwide globally, beyond CureVac even, there will be enough capacity to really vaccinate the world, well, let's say until the end of next year.
We explore the trends, investments and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. So, European credit markets are striking an upbeat note today on rising optimism that the end of the pandemic is in sight. Risk gauges for both the investment grade and high yield debt are retreating. We'll continue with the spread compression. Peter Chatwell-Mizuho, head of multi-asset strategy, joining us now. Peter, let's talk about the sustainability of this move. It's interesting. So over the last few days, we've seen Carnival be able to come to market and raise money unencumbered. It was able to do it without having to put ships up as collateral. Lufthansa was in the market as well, raising money and doing relatively well. I'm wondering whether or not you think that these are sustainable trends and you worry that the kind of the long, hard winter we're all facing could undermine them.
The way I see it is the vaccine was the key turning point here. That means the prospect of societal normalization in time for summer of next year is very high. So that means that the COVID-afflicted sectors, such as Carnival, such as Lufthansa, they really do have the opportunity to get back to some sort of normality on their top lines. But what we then need to see and really assess over the course of at least the first half of next year is these accommodative financial conditions. Are they going to be used correctly? Are they going to be used for balance sheet repair? Or is it just going to be a case of loading up on more debt? If it's the latter, then what we'll have is a rally in the first half of next year, but then it will stall out. What we think is that there is going to be a significant amount of balance sheet repair, and that is going to mean that credit markets can continue their outperformance of equity markets, and then they'll go and reach the tightest spread since the great financial crisis.
In terms of the danger around that thesis, a lot of companies, as you say, have raised an awful lot of money already, and there is this fear that if the economy doesn't pick up sharply enough, that balance sheet repair will not be viable, and as a result of which these companies are not really going to be able to cover their costs on the credit side. How big a threat is that, and how granular are you going to need to become in terms of picking individual credits and working out kind of who is going to be able to manage it and who isn't?
That's a super question. And I think the ECB will have a major role to play in assessing the type of financial conditions that they're creating and whether or not it's turning to be problematic, whether or not the incentive structure is incorrect. Now, it will mean that the value in real detailed digging and analysis of a corporate balance sheet comes right to the surface. That's going to be where the alpha generation is next year. And I think there's going to be a lot of performance from beta if our thesis is right, but really to add alpha to that, fundamental credit analysis is going to be super important next year.
OK, so where do you see the areas that you want to be? Get granular for me, both at a sector level and maybe even down to individual credits, because there is a lot to choose from out there, and it's pretty clear that COVID has accelerated a bunch of trends that are going to have a meaningful impact on business models.
Well, if I look at the risks that are facing us now for next year, I have to say that COVID is not one of those, or it's just a small component of that. And I have that feeling of confidence because of the vaccines. And really the only risk I see, which could have COVID coming back onto the radar, is if vaccines are not accepted by society, if there's a big anti-vaccine movement. Otherwise, the main risk factors I see are actually about geopolitics, about the possibility that corporates don't do the right thing and repair balance sheets. And so actually, I feel very comfortable in picking the COVID-afflicted sectors. So let's take airlines as an example. I think that the recovery for those will continue. And so I like those sort of themes. And I would recommend long in the COVID-afflicted sectors and names. And then I would recommend doing those positions, being long those positions against the low betas, looking for continued spread compression. And I think that's going to be a theme for the first half of next year. It's just had about a month of really good performance. I think it's got a long way to go yet, probably 6 months.
Well, let's just stay with this theme then and think about what is going to happen. One thing that COVID has changed is businesses' appreciation of how many times they need to put their people on the road. Airlines make traditionally a lot of their money at the front end of the plane, particularly those that cater on the North Atlantic, for instance. And even if we see 20 to 30% of that business disappearing, that is going to have a massive impact on the ability of these businesses to make money. How does that factor in? The pandemic has changed a lot of behaviour, and some of that behavioural change is going to stick.
Indeed. When we've done our analysis, we have not assumed a normalisation of top line for the afflicted sectors at all during 2021. What we've done is we've looked at their revenue paths, and we've assumed that we've forecasted a revenue path based on our macroeconomic assumptions and forecasts, which doesn't see their revenues getting back to normal towards 2023 for some of the afflicted sectors. And taking that into account and looking at where they can raise debt, where they can issue equity if they choose to, that's how we still come to this picture of outperformance for many of these sectors. Really, we're looking at the probably the lowest risk ones as being the best value right now on a market neutral basis.
Peter, talking to people I know in sales before the crisis, they were flagging to me that some of the stuff that was going out of the door, the covenants that were attached to them were really not designed to provide really that much protection to investors. Very, very light covenants being applied. And I wonder, as we go through a kind of rolling period in which defaults may not spike as they traditionally have done, but just continue at a more elevated level, which is, I have to say, probably looking more and more likely. How protected are investors going to be in terms of recovery rates? What do you see recovery rates looking like?
Well, so far, recovery rates have really surprised to the downside. And I think that's the point you make there is extremely valid. And it's why doing your full fundamental and legal research on the higher risk names is absolutely crucial here. So the way I think next year is going to pan out is that there is going to be this selection process whereby if you are not overly financially engineered, haven't issued these covenant light structures, and simply trading at a wide premium because of the sector you're in, or you've lost an IG rating, have gone into crossover or slightly wider into high yield, but you're still viable once society normalizes, then those are the businesses, those are the names which are going to perform, I think, really in quite a powerful way first half of next year. But we're still going to have this backdrop in the weaker names, in the triple C kind of area, where there is still going to be a lot of risk, and we're still going to be realizing quite elevated default rates with quite low recoveries, and I think that that's just a fact. But don't forget the amount of investors there are with very deep pockets that are going to be chasing returns, and particularly in European fixed income, because the story for next year is not just about the return to relatively normal spreads for much of the credit market, but it's also about the cyclical recovery in many currencies, the euro being a key one for that. So as the euro appreciates, more and more investors are going to be coming into European assets. And that's going to mean the wall of liquidity, which has been chasing European assets in the past 6 months, is going to be growing. So we may well have a degree of mispricing actually developing over the course of next year.
Tighter spreads to come. Peter, thank you very much indeed. Peter Chatwell of Mizuho. What have we got coming up for you now? AstraZeneca and Oxford facing mounting questions over their COVID-19 vaccine candidates after acknowledging a manufacturing error. We're going to talk more about this next. This is Bloomberg.
일상이 추억이 되는 곳, 이곳을 담은 에피그램.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Hi from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. Let's check in on the Bloomberg First Word News. The coronavirus resurgence is making it an unhappy Thanksgiving for many in New York. Almost 7,000 cases reported in the last day, and hospitalizations are now over 3,000. In the United Kingdom, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed in Tier 2 That means that pubs, restaurants and bars can open for business, but alcohol can only be served as part of a meal. Households will not be able to mix indoors. And the Trump administration is considering a move that could boost transatlantic travel. Several agencies have urged the White House to lift an entry ban on non-US citizens arriving from Europe. It was put in place to slow the spread of the coronavirus, but the ban has caused big losses for airlines in the formerly lucrative transatlantic market. Global News, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Let's stick with the virus and vaccine development. Development questions mounting over AstraZeneca and Oxford's vaccine candidate after they acknowledged a manufacturing error that affected trial results. Joining me now with more from London, Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst and Director of EMEA Research. I'll get that out. Sam, save me. Who messed up here?
It's somewhere between the Oxford vaccine group and the manufacturer, which obviously involves the people who make the viral doses and then fill and finish them. Somewhere in that group, somehow, possibly involving the clinical trials organization, if there was one involved, that's where it's gone wrong. What is nice to know, I think that's what we know, is that it wasn't like a batch was made and then it was only half active. They literally gave people a vial which had half the dose in it. If it was that issue with the half active, then that's a bit more concerning. But I don't think that's the case. So Astra, I don't think can really be thought of as anyone as really that guilty here.
And in some ways, this was serendipity. It allowed a higher efficacy rate to be generated. How will this problem with the dosing, do you think, affect acceptance of the vaccine? There was much criticism earlier on this week from the United States, some suggesting that it wouldn't be given approval there.
Yeah, so I'm not going to go as far as you have. This hasn't proven anything. Once you know much more about that group of people who apparently gave you 90%, I'm choosing my words very carefully here, apparently gave you 90% efficacy, then we can start deciding whether it was the half dose, full dose thing that drove it, or whether it was because there were younger patients, because there were healthier patients, or because we just didn't have enough numbers in that group. So that's where I think we have something that we still have to figure out, which is why I suspect there's all this question marks, not just from the US. I think from the get-go we were also skeptical.
So what needs to happen? How does this need fixing? How does it get fixed? And how does it get put right?
Right. So this combined group of Brazil and the UK trial had up to about 23,000 people in it. What we can do is get to the end of it, subtract the half-dose, full-dose people, and go to what the trial was designed to test, which was, in fact, the opposite hypothesis, high dose followed by low dose, and also two high doses, and see what that tells us. And then see if this other group has any other reasons to explain the 90%. If it does, you go back and redesign another trial and test that. You can't run away assuming that half dose plus full dose is what we should give people. You can't make that decision for 2 billion people on the basis of a 3,000 patient outcome.
In terms of why this is important and to get an idea of the scale, how much of the world is relying on this type of vaccine, the J&J vaccine, as opposed to how much of the world is likely to rely on the newer mRNA vaccine, which has the issue of stability and temperature?
Yeah, so I've said this a few times, Guy, and I probably said it to you on your show as well. You know, we put satellites into the sky and put people on the moon and exchange amazing things with the International Space Station. I'm sure we can solve the logistic problems of shipping something at -70 and -20. if we put our mind to it. The Ebola vaccine needed those kind of temperatures, except that they were given to far fewer people, but still they managed it in the Congo. So I'm sure it's doable. The point is, obviously, we all need less. It would be much easier to have a vaccine you can just put in your pocket and take around. So today, the United States has sufficient doses contracted with Moderna and Pfizer to cover its population and more. The UK and the European Union and the rest of the world are currently dependent on the Astra vaccine. So that needs to get sorted out. But in due course, we'll get news from Johnson & Johnson, and we'll get news from Novavax, and find out whether those vaccines are, how effective they are. And once we have that, we can start thinking about how quickly UK, Europe can open versus United States versus elsewhere.
Yeah, it's going to have critical economic impact. Sam, always appreciate your time. Thanks for joining us. Sam Fazeli of Bloomberg Intelligence. This is Bloomberg.
There's a lot of concern in Hong Kong, and you can see the way actions, reactions, and further anxieties arise. I hope we can settle down to a new normal.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. Time now for a Bloomberg Business Flash, which is a look at some of the biggest business stories in the news right now. Let's start with Disney, which has announced 4,000 more job cuts after virus lockdowns forced the closures of its theme parks. That takes the number of layoffs set for the next 6 months of next year to 32,000. That's more than 10% of its workforce. The coronavirus pandemic has hammered Disney's traditional businesses, of course, like studios, parks, and cruises. The Spanish oil producer Repsol is going green. The company says it intends to wind down the search for oil and expand its renewable capacity by fivefold in the next decade. Repsol was the first major oil company to set a net zero emissions target. It did so a year ago. And the second largest mall in the United States is getting its first big test starting tomorrow on Black Friday. The $5 billion American Dream Complex opened its retail stores last month. The timing is, well, less than perfect, though. The coronavirus pandemic has driven more shopping online, of course. Plus, the American Dream is built around experiences. Its indoor ski slopes and water park, well, they no longer hold the same appeal. And that's your Bloomberg Business Flash. Nice to go skiing. Looks like we're not going to see much of that in Europe, at least for a while. Let's turn now our attention to what is happening in the real estate market. I guess it's a linked theme. The amount of construction on new office space in central London has plunged. The figure halved in the 6 months through to September, according to Deloitte. Here with a look at this commercial market is Bloomberg's Danny Berger.
Guy, we know that a lot of companies have really been turning in and giving up a lot of their office space with more workers cocooned at home. But what's starting to emerge because of the coronavirus is this very strange bifurcation of the London real estate market. And this is really a global trend as well. But what's occurring is because there's so many yield-hungry investors out there, real estate is, of course, a great place for that. Anything that can still command high rent, it's seen its value grow. At the same time, older office space has seen its value lessen. So we're getting more of a divergence in these different markets. And it's turned real estate into a market that's really all about quality. You can't just really buy any more undervalued property thinking you're going to get a good return on that because workers won't necessarily come back to those offices. Instead, what's important now, it's about quality, it's about ESG, it's about top amenities that'll bring people back into the office. I spoke earlier with LaSalle Investment Management's Europe CEO, Philippe Lapierre, exactly about this topic. Here's what he had to say.
We don't believe the office is dead. However, the near-term outlook for the office sector is going to be, a lot less certain as it was prior to the pandemic. The longer-term piece is going to be that much more interesting, and you'll probably kind of need almost a social psychology study on human behavior to see how people return to work. And the one statement that I like with that is, work is no longer a place. Work is now a more diffuse picture.
I love you said you need a sociologist study done on the market. That's how complicated it's become to find valuable real estate. But the demand is certainly still out there for that flight to quality, Guy.
That makes it presumably a much more specialized asset class.
It really does, and not just for investors, which maybe still will have the same demand because of that yield, but for these investment management firms themselves, they need to get more specialized. We've seen more big firms buy up boutiques, and presumably to do just this, it's getting more complicated, and you need a different skill set to really find attractive offices.
Danny Berger, thank you very much indeed. Danny, on the retail sector, I just want to return to the issue we were talking about just a moment ago, and that is AstraZeneca. Some breaking news coming through from Pascal Soriot, who is the CEO of AstraZeneca. Pascal saying that Astra is likely to run a new global COVID vaccine trial, and that probably is going to mean the clearance from the FDA is likely to take longer. Astra saying the new study will be faster, though, and need potentially lower numbers of patients. Nevertheless, a little delay now looks likely in terms of approval for that Oxford vaccine, certainly over in the United States. We're going to carry on the conversation over the next hour. We'll talk more about what is happening with the global economy. Janet Henry, HSBC's global chief economist, will be joining us, as will Vincent Juvens, JP Morgan Asset Management Global Market Strategist. That's all coming up. This is Bloomberg.
It's important for each side to understand the sensitivities of the other.
Former U.S. Secretary of State Henry Kissinger said the incoming Biden administration should move quickly to restore lines of communication with China that frayed during the Trump years, or risk a crisis that could escalate into military conflict.
Unless there is some basis for some cooperative action, the world will slide into a catastrophe comparable to World War I, with a technology that it's even more difficult to control than the technology of the period there.
일상이 추억이 되는 곳, 이곳을 담은 에피그램.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
PM in London, 11 a.m. in New York. From London, I'm Guy Johnson. U.S. equity and bond markets, of course, closed for Thanksgiving. Happy Thanksgiving. Welcome to Bloomberg Markets, everybody. Quick look at where financial markets are with U.S. markets closed. Light volume, obviously a theme across most assets. The stock 600 now negative, but not by much. SPOO's also in a similar position. Below the surface, though, the rotation back towards tech continues. That's where we're seeing the outperformance here in Europe. The auto sector, the energy sector, etc., underperforming a little bit. Euro-dollar has a 119 handle, though it is off its highs. And we're starting to track towards some areas where previously we have had some concern from the ECB, i.e. 120. And Bitcoin now trading with a 16 handle, 16,863, a 10% downdraft after that huge upswing we saw in the price. The virus, though, remains front and centre, as does the race for a vaccine. And AstraZeneca's candidate front and centre. It now, though, may take a while longer. This after questions were raised over trial results. The company's CEO, Pascal Soriot, telling Bloomberg within the last few minutes that it will now likely, as a result, run a new global trial, saying, quote, "Now that we have found what looks like a better efficacy, we are going to have to validate this. So we need to do an additional study." I.e., it looks like it's going to be half dose, full dose, that could produce a much higher efficacy than maybe a full dose. Meanwhile, Europe and the United States continue to struggle with containing the virus resurgence. Germany is seeing a record increase in new cases, while New York cases are approaching 7,000, hospitalizations hitting their highest since June. Let's deal with the details now. Here with those, Bloomberg's Emma Chandra.
Thank you very much, Guy. Yeah, a little bit less rosy virus news today after a week in which we had seen what was seen to be good news from AstraZeneca on their vaccine. Today, hearing, of course, that they're going to look to have another global trial of that vaccine to test this efficacy of the dose or the half dose, full dose that they think will be better. And as you mentioned there as well, getting some more troubling figures out of large economies, the likes of New York, also of Germany, about the level of cases. As you said, in New York, we're seeing some nearly 7,000 new cases in the last 24 hours. Hospitalizations topping 3,000 in New York. Over in Germany, setting a record for the number of new cases in the last 24 hours. Some 32,687 new infections. As I said, that is a record increase in Germany. Cases tripling since October there, and looking at the number of cases approaching 1 million in Germany. And for that reason in Germany, we're not seeing any easing of its partial lockdown restrictions. They are going to stay in place, Guy, until December the 20th, so right up until Christmas. There is a bit of a different story when we look at some other countries in Europe. We do have a Bloomberg chart which should show you how new cases are starting to fall off. We're starting to see a reduction in the number of new cases when we look at the likes of France, Italy, Great Britain and Spain, and therefore there's a slightly more positive story there as we start to look at some easing of restrictions in those countries, Guy.
Yeah, we are seeing that easing. So let's walk through the details of that. We heard from Emmanuel Macron earlier on in the week. Today we got the details of the UK tiering system as the UK's partial lockdown ends next week. Walk us through what we know.
So what we know about France is that their lockdown will end on the weekend, this Saturday. President Emmanuel Macron announcing that earlier this week. In the UK, that data or the news very much coming out today. The lockdown in England, remember, in the UK, we have to look at the different nations and regions. So the lockdown in England ending on Wednesday and going back to this tiering system. But what's interesting there is that London has avoided the toughest restrictions. It's gone into tier 2. That means some services like pubs, like restaurants, like hair salons, they can reopen, though there'll be no mixing of households, Guy.
Yeah, I think very few places in the UK now look like they're going to, or England are going to end up in tier 1. The Isle of Wight, Cornwall, and I think somewhere else as well. Only 3 areas.
The Scilly
Emma,
Isles,
thank
Guy.
you very much.
The Scilly Isles.
The Scilly Isles. How could I forget the Scilly Isles? Emma Chandra always has all the details. Thank you very much indeed. Joining us now, Janet Henry, HSBC's Global Chief Economist. Janet, we are seeing, as Emma pointed out, case counts starting to rise. And the US is celebrating Thanksgiving today. That comes with mixing and travel, and as a result of which, we're likely to see a significant spike in the case count. Hospitalizations are also rising. How is this factoring into your thinking about how the recovery and 2021 is going to look economically?
Well, we need to balance, obviously, the good news on the vaccine front. Clearly, there's been some mixed headlines today, but compared with where we were about 6 weeks ago, there is no doubt that the broad news on a vaccine, the certainty that at some point in 2021, we will be some way towards containing this pandemic, against what are obviously some fairly big negative downside risks for the very near term. So, yeah, there's light at the end of the tunnel. It's just that this valley that we've got to cross in terms of the weakness of activity, if anything, looks set to be a little bit longer. And certainly that's been the message we've been getting from the likes of the Fed and the ECB at the moment. If anything, they're positioned for near-term downside risks rather than getting carried away about the optimism regarding the vaccine.
So what does that mean in terms of policy between now and Christmas?
Between now and Christmas, central banks are going to do more. We've known for some time that the ECB, there's nothing that's going to stop them from recalibrating all of their measures. Well, not all of them. We don't think they're going to go to more negative rates at this point, but they will be delivering some kind of package of measures in December. And I think it was pretty clear from the Fed, not that they're going to up the degree of insurance that they talked about yesterday, but that they will continue the asset purchases. So the total amount of monthly purchases of 120 billion a month, if you include, obviously, not just the government bonds, but other securities as well, that they will continue into next year. And I think that was further emphasised by Philip Lane today. You know, he's very nervous that the good news on the vaccine might actually cause the yield curve to steepen a bit too quickly, and that, you know, that might impact a bit more quickly than what's happening on the real economy and for households and for companies. Central banks still ready to do more and certainly to keep monetary accommodation in place.
Janet, we seem to have had a little issue with your screen, but we'll carry on the conversation. The story on fiscal on both sides of the Atlantic seems to be stalled, both in the United States and here in Europe. Here in Europe, it's Hungary and Poland that seem to be holding it up. Over in the United States, obviously, it is the politics between the Democrats and the Republicans. Will the central banks fill that gap, and are they capable in reality of doing so?
No, central banks can't fill the gap. Obviously, even before this pandemic, we knew that central banks broadly were running out of ammunition. They played a critically important role in terms of unlocking financial markets at the start of the pandemic. They played an equally important one subsequently. But it was very clear in the ECB accounts today, they are playing a supporting role. The heavy lifting everywhere has to come from fiscal policy, but they are taking their supporting role very seriously indeed. The lead role has to come from fiscal side. It's coming through in Europe. And admittedly, the Fed is probably frustrated that anything they're likely to get in the next few months or next few weeks from the US is going to fall short of what they've actually been advocating in terms of the scale and the mix of fiscal stimulus. So, no, the central bank support is very much a supporting role.
Was that what we saw today, though, in some ways from the Riksbank? It understands that it can't do what fiscal can do, but nevertheless it appreciates that there is still a great deal of uncertainty and there is a need to get in front of it. We don't know what's going to happen. There was a fear maybe in the market first thing this morning that the Riksbank was signalling it knew something that the rest of us didn't. But is it just as simple as maybe the Riksbank just wanting to get in front of the story?
I think that is partly it. I mean, we've heard it not just from the Riksbank, but we heard it from the ECB, we heard it from Philip Lane, some signs of a tightening of financial conditions. And, you know, as much as we can kind of look across the valley and hope that at some point the vaccine comes through and we get a more meaningful recovery, we know that the scarring on the economy will be determined by how deep this weakness in activity, how deep this recession is, and how long it lasts. So the last thing that they can cope with at the moment is an unwarranted tightening of financial conditions. So, yes, to your point, it is about getting ahead of the story, but making sure that governments do too. You know, everyone looks back with hindsight on what happened in the wake of the global financial crisis, where arguably across Europe, fiscal policy was tightened too quickly. And I would argue even in the US, with the degree of state tightening because of the balanced budget requirement, policy was maybe even tightened on the fiscal front there too quickly, prematurely. So both for central banks and for governments, it's the same message. It's way too early to think about you know, I suppose, reining it in anytime soon.
Janet, stick around. It would be great to talk a little bit about also what we learned from the US data this week, particularly that claims number. Janet will be back in a moment. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Top minutes past the hour, live from London. I'm Guy Johnson. This is the European close on Bloomberg Markets. Happy Thanksgiving. Let's check in on the Bloomberg First Word News. In the UK, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed into Tier 2. That means pubs, restaurants, bars can open for business, but alcohol can only be served as part of a meal. Households will not be allowed to mix indoors. A divided U.S. Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. Cuomo wants to hold down crowds at synagogues and some Catholic churches in parts of New York that are COVID hotspots. Justices voted 5-4 against the limits. Chief Justice Roberts joined the court's liberal wing in dissent. Meanwhile, New York is reporting today there are almost 7,000 new infections. And AstraZeneca is likely to conduct another global trial of its coronavirus vaccine. Current studies raise questions over its level of protection. The new trial will evaluate a lower dosage that performed better than a full amount in Astra's studies. The lower level was actually given by mistake, hence the new trial. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Let's turn back now to the United States, the economic data and the Fed. The FOMC yesterday releasing its minutes. That was of the November meeting. From the November meeting, officials discussed updating bond buying guidance fairly soon, but saw no need for immediate adjustments. Still with us, Janet Henry of HSBC. Janet, this obviously predates the 2 weeks that we've had of rising claim counts in the United States. The labour market is starting to take a turn for the worse stateside. Are we setting ourselves up for a significantly worse payroll report? And if so, do you think that could sway the Fed to do more?
You're right. We have seen a slight creeping up in terms of the jobless claims. Also, importantly, we've seen in the latest release some drop in household incomes. So, it was already clear that the fiscal stimulus that was initially delivered was starting to wane. We are now seeing that start to feed through. It may not be material enough yet for the Fed to actually up the pace of purchases, the monthly rate, but certainly it is enough to continue at the current rate, not just to the end of this year, which we already knew, but to extend it into next year. In terms of the payrolls release, it's a little bit early. We'll have a better idea in the next few days. But certainly it is pointing to a softening in the rate of improvements in the payrolls. I mean, it's been the big surprise, I suppose, in the course of the last 6 months, just how quickly the unemployment rate was falling. It was already set to slow. It would appear that, maybe we see this levelling off pretty much immediately.
Janet, one of the things that's being actively discussed at the moment is that if the Fed were to act, the way that it would act would be to buy more long-dated bonds to try and flatten the curve. I understand the market effect of that, i.e. a flatter curve, and the kind of the spin-offs from that. I'm wondering what you think the economic impact of such a move would be.
Well, I think it does feed through into broader financial conditions. And obviously, the way it feeds through to the average person in the US or elsewhere, where mortgage rates are tied to long-term interest rates, is obviously through the housing market. Now, one of the surprises in this pandemic, compared with what people might have estimated last March, is that housing markets in many countries in the world have been remarkably robust, particularly if you're not buying apartments in city centres and such like. So it would be supportive in that sense in the real economy, broadly in parts of the housing market, which, although they've been very resilient, may not be quite as resilient in a world where we might see more permanent job losses creeping through in the course of 2021. So that is one of the main implications. Also, it obviously feeds through in terms of corporate financing. Spreads have obviously not widened, but in some concern about growing defaults as a lagged response to the depth of the recession that's come through. Anything that prevents those financial conditions from tightening prematurely, that will as well feed through to the real economy. And obviously the shift in asset purchases towards longer dated purchases is something that we've already seen from other central banks, for instance, the Bank of Canada.
Just before we wrap up, can we have a quick conversation about what's happening here in the UK? We saw a spending review yesterday. Within that was an effective public sector pay freeze, excluding the healthcare sector. But there have also been hints recently from the Chancellor and others close to him that we could also be lining ourselves up for tax hikes. Do you think it's too early to consider public sector pay freezes? Do you think it's way too early to even be thinking about, talking about the possibility of putting taxes up?
Well, these are all political choices, and obviously there are certain things that have been ring-fenced in various manifestos, although people will question whether manifestos should be stuck to in a pandemic world. But I think there are probably, we know that ultimately a consequence of this pandemic and the rise in debt is that it will ultimately mean higher taxation. So I think there are probably some areas that can be approached over, in a relatively short period of time, maybe in 2021. In the UK, maybe we even get those first moves in areas related to wealth, whether it's capital gains taxes or other areas taxing higher earners could start to come through, but potentially it might just be a commitment to what happens in 2022. So perhaps it's a little bit early to be making the comment at the same time when actually what was announced yesterday was another big increase in spending rather than anything on the taxation front. It could dampen confidence, it can affect savings behaviour and therefore economic activity and even investment intentions at an earlier stage. So arguably it is a little bit early. We know that it's very important to ensure that the economy is on a sustainable growth path rather than looking to consolidate too early. It's just that, what will be the new long-term growth path, we really don't know at this point because we don't know what the full extent of the scarring is going to be from the rise in structural unemployment and the hits to investment spending and particularly to productivity and such like. So it's pretty early to be making bold calls about the timing for fiscal consolidation to come through.
Janet, always a pleasure. Thanks for spending some time with us today. We greatly appreciate it. Janet Henry of HSBC. We'll talk to Charlie Bean of the OBR a little bit later on in the programme to get his take on all of this. Coming up as well, we'll be back to AstraZeneca. AstraZeneca now looking as if it's going to conduct another global trial of its COVID-19 vaccine candidate. This after questions were raised about the level of protection being provided and the way that the studies have been done with the various dosing regimes. Bloomberg conducting an interview today with Pascal Soriot. We'll get details of that interview in a few minutes' time. This is Bloomberg. Live from London, I'm Guy Johnson. This is the European Close on Bloomberg Markets. So as we've been hearing, AstraZeneca now likely to conduct an additional global trial to assess the efficacy of its COVID-19 vaccine. This after current studies raise questions over the level of protection and the dosing. Joining us now to talk about all of this is Susie Ring, who has just conducted an interview with the CEO of AstraZeneca, Pascal Soriot. What did we learn? What did he say about what happened with the studies that were conducted and the dosages? Kind of how much clarity do we understand around what went on?
He said that it shouldn't be viewed as a mistake. Ultimately, they did have a lower dose than they expected that they gave to participants, and they looked at that, and rather than deciding to scrap, those participants from the trial, they had discussions with regulators, they had discussions with each other and decided to keep them as part of the cohort. Now, they didn't expect that group to have a higher efficacy rate for sure, but now that that's come out, they don't see it as a mistake or a bad thing. They see it as evidence that they can do further studies to show a higher efficacy rate if they can get more data on that dosing level.
What I just read suggested that this was going to be a global trial. Is this a global trial, or is this a trial aimed at achieving FDA clearance?
It is a global trial. They had said on Monday that they would likely add an arm of a trial to the US because the US trials haven't been completed yet, and that they were planning to discuss with the FDA this week how they would do that as a way to kind of shore up this higher efficacy number. What Pascal said today, which hasn't been said previously, is that they actually think they will probably do a global trial. I imagine because they want to make sure that they, can have no question of the ultimate efficacy rate that comes out from that lower dosing regime. So we would expect now them to set up in the near future this second arm, not just in the US but globally, and that would also help in terms of diversity and demographics.
OK, well, let's talk about that. There were some questions as well surrounding whether or not there was a significant or suitable component of the trial that was in an older age cohort. Did he say anything about that, and how are they going to correct that?
So, again, that would be addressed by these new global trials. The cohort that got the half dose, that wasn't originally intended, but they followed through with, only went up to age 55. So that obviously means we don't know anything about how that lower dose would react in older people. This global trial would look to address that. So what we'd be expecting them to do is to have a range of ages, a range of ethnicities, exactly what we've seen from the other trials, to firm up, was this just a fluke? Was this just because younger people can respond better to vaccines, or is this actually a lower dose, a more effective vaccine?
Susie, will this affect approval in Europe?
Pascal believes not. He thinks that the vaccine is still on track for approval potentially by the end of the year, both in Europe and the UK, which is what he said previously, and he's standing by that. They have this lower efficacy rate, which still comes above the FDA's benchmark of 50%. They have the 62%, so they believe they can get approval on that basis. In terms of the US, they had acknowledged that things will probably be slower, which was always actually a question mark because they didn't know how much the US would need US trials to be completed for them to get approval. This has added an additional question mark to that, so that probably will be slower. However, he doesn't think it's going to lag too much, he said today.
Susie, nice work. Great interview. Thank you very much indeed. The European close is next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Seconds ago until the end of regular trading here in Europe. A quiet session, understandably, with the United States celebrating Thanksgiving. We are seeing light volume. But let me talk to you about what we have seen. A fairly flat session at a headline level. This is the Stock 600, as you can see. Absolutely flat as a pancake versus where we started this morning. Pushed higher first thing this morning, faded, and then basically a track sideways with very light volume. In terms of the individual markets around Europe, again, very little action here. And we're seeing similar things over in the United States. I appreciate the market's closed, but futures are giving us a good indication. The FTSE 100 down a little bit more than most, and we are seeing a little bit of a rotation away from some of the winners that we've seen of late at an index level. For instance, Madrid down by 0.6%. The DAX, which has been a relative recent underperformer, outperforming today versus Madrid, which has been obviously hammered hard this year, bouncing back over the last few days on the vaccine news. Today getting faded a little bit. In terms of other asset classes, pay attention to what is happening with the euro-dollar right now. Philip Lane, the chief economist of the ECB, highlighting a tightening of financial conditions, a suggestion maybe that the ECB will step on any steepening of the yield curve. Keep an eye on further commentary over the next few days. We're trading 119. Remember, 120 was a line in the sand where Lane started to get very animated before, suggesting that that currency appreciation was a problem. We are seeing a bit in the bond market today. Again, the commentary coming through in the accounts of the ECB suggesting potential further action, and that certainly seems to be benefiting the European bond market today, as you can see. So yields moving lower, prices moving higher, and Brent crude retreating a little bit after a very strong recent run, 47.78. The narrative in terms of the sectors, we're rotating back into technology, the more safe end of the market, certainly benefiting on the bid today. We are seeing banks under a little bit of pressure, energy stocks as well. Repsol, actually, the Spanish company, down for different reasons today, cutting its dividend, but nevertheless, Repsol becoming one of the first major oil companies basically to signal that it's done with oil in certain respects. It's going to boost its renewables footprint by 5-fold. It's going to cut its dividend, I say, for 2021. But the Spanish energy producer really looking for a green future, and green hydrogen, certainly an area that it wants to focus on. Montepaschi, we are back talking about the world's oldest bank, the Italian lawmakers, putting a bit of sand in the cogs, aiming to delay the government's sale of the bank. That stock limited a little earlier on to the downside, halted, now trading down by 3%. And Flutter is the Irish-listed betting company. It's going to move into the Euro Stoxx 50. This is Unilever moves out. The reason for Unilever moving out is that it's moving out of the Netherlands and therefore, in some ways, no longer eligible. And I want to finish up with the stock that we've been talking about so much throughout the show, AstraZeneca. Pascal Soriot speaking to Bloomberg's Susie Ring over the last hour, suggesting that we are going to see a new global trial for its Oxford vaccine. This on the new dosing, the lower dosing regime, which is half dose, full dose. and maybe a delay, therefore, in terms of FDA approval. But AstraZeneca bouncing towards the back end of the day, as you can see on the back of that interview, finishing down by just 0.2%. Vaccine news will remain front and centre, it seems. BNP Paribas chairman Jean Lemierre says that news of a vaccine is, quote, light at the end of the tunnel, but the market shouldn't get too exuberant. He spoke to Bloomberg's Francine Lacqua a little earlier.
There are many questions about production, about distribution, about the impact, and we should not expect a quick, immediate impact. It will take some time, but at least there is a light, and that's what is very important. I think this is well understood by the market.
Joining us now to continue the conversation from Brussels, Vincent Juvens, JP Morgan Asset Management Global Markets Strategist. Vincent, the chair of BNP Paribas, saying there is light at the end of the tunnel, but be careful. Would you agree with that sentiment? What do you make of this rotation that we've seen that really started back on the 9th with the Pfizer news, but has gripped markets ever since?
Yeah, I guess it's still time to be prudent. And obviously, for the chairman of BNP speaking from France, where obviously restrictions remain in place for the foreseeable future and also well into the holiday season, it is clear that in Europe, contrary to our US friends, we are looking to a holiday period which will still remain depressed in many ways, even if indeed the vaccine offers some light at the end of the tunnel. In this context, I believe it's too early to call for the start of the great rotation. And if anything, the movement on the market today give a bit an idea of what to expect in the coming month. We had a cyclical rebound of that value stock over the last couple of weeks. We find it relevant from a cyclical perspective, but we should not forget that there are obviously structural headwinds for a big pocket of the value segment. I'm thinking about the energy sector. You just mentioned Repsol, which is moving away from fossil oil to renewable, but clearly the energy sector, traditional energy sector, is going to struggle in the coming month and year due to this decarbonization, due to the fact that the economy will take time to recover its 2019 level. That's one thing. The other big heavyweight within the value indices is obviously the banking sector. And you mentioned it in your introduction, Guy, as well. Obviously, each time that you see any steepening of the yield curve, you will have an intervention of the central bank to ensure that financial conditions remain attractive for everyone needing to finance itself on financial market. States, obviously, but corporate need those easy financial conditions as the environment remains quite challenging at the moment.
What about the energy sector? It was interesting, I was talking as well about Repsol, the Spanish energy company, making a huge bet in terms of a move into green and green hydrogen. It's cutting its dividend to help finance that, but nevertheless a significant step away from its traditional business. How big a headwind is, though, the carbon story going to be for this rotation? We've seen during this crisis, government after government make it clear that one of the ways that they are going to invest is in a green revolution.
It doesn't need to be a headwind. Actually, we made a lot of research on this at JP Morgan this year in the context of a long-term capital market assumption, also in the context of several of some solution launch that we have made recently. So really this transition to a lower carbon economy obviously obliged corporate companies like Repsol to really rethink the nature of their business. But it's an opportunity. And thinking about this rotation value growth, clearly, as we see more and more policymakers moving with a tougher climate strategy entering into 2021. This is especially the case in Europe, but could be soon the case also in the US. It will benefit some sectors in Europe, some value sector as well. I'm thinking about renewables, for instance, which is really an area where Europe has some leadership in it. So clearly this carbon transition, in our view, could be a major opportunity for investors. The thing we need to do as investors is to look everywhere where we invest at the carbon intensity of our holding. Clearly, going forward, we would expect those companies which have a higher carbon intensity to manufacture goods and services the same than their competitors, but with a higher carbon intensity, we'll see a lower margin, will be less profitable on financial markets. So clearly, this is a parameter which is more and more important in our investment decision today. carbon intensity. And indeed, 2021 could well be the year of a grand climate accord. We know finally have the US supporting those international efforts, supported by Europe so far, but also China. Many countries have committed to a carbon neutral by 2050. Let's hope that the US join, obviously, this movement in January, and then we would be all set for a possible more ambitious accord in Glasgow for the COP26, more ambitious than we had in Paris, for instance.
Vincent, if I've got a time frame of more than 6 months, which many investors obviously will have, why would I want to sell innovative companies, technology companies, companies that are going to change the world going forward? Why would I want to spend time trying to figure out which value companies, which the market can't really figure out how to value because it doesn't understand what some of these legacy businesses are going to do in the future? Why would I want to spend time focusing there, even if we are going to see a short-term bounce back? Why would I want to sell my technology stocks?
Our message is definitely don't sell your technology stock. Keep this sector. This is one of the structural themes which we have identified, that everybody is following, that we capture at JP Morgan, which play out not only in listed equity market, but across the board in our private equity business, in our infrastructure business, in our real estate business. So clearly, the tech theme is there to stay, and we remain confident in it. This said, as investor, we need to diversify, obviously, our bet. And we believe that as we enter a new decade, obviously, a new economic cycle and possibly a new market cycle, we need to also look at what could be the next tech in financial market. And green could well be the new tech from that perspective. And that's a theme that you should try to capture along your tech theme in your portfolio.
Am I going to get the biggest bang for my buck in terms of making these investments in Asia? In many ways, China has been able to scale many of these technologies in a way that nobody else has. And I'm wondering if that is going to apply to the green revolution as it applies to the silicon revolution.
Definitely, China has been very successful at it. More than 50% of batteries, of wind turbine, of solar panel are manufactured in China. So clearly, China has understood that it needed to lead this decarbonization. China will, as of the start of 2021, have the biggest emission trading scheme in place. So really, China is doing a lot of effort in this space and needs to do it because they're by far the biggest greenhouse gas emitter. But China is clearly to be a leader in this decarbonization, in its transition to a low-carbon economy, which is one additional reason to consider China and Asia for long-term investors. We've discussed that together already over the past few months. Obviously, at JP Morgan, we like Asia, we like China. We have made several recommendations to be long this market, obviously for its intrinsic characteristic, but also the ability to be exposed to this tech theme, but also to this new green energy theme, which is more and more present within China.
Always a pleasure. Nice to see you. Thank you very much indeed for your time. Vincent Youvens of JP Morgan Asset Management. European stocks have now finished. Very quiet session, delivered with very little volume as a result of the Thanksgiving holiday in the United States. But these are the final numbers. As you can see, a little bit of underperformance coming through from the London markets. A little tick higher during the auction process, but not really that much to talk about. The biggest losers coming through from Persimmons. We've seen Imperials coming down in terms of points. It was National Grid, BP and CRH plus Astra that actually did the damage on the downside for the FTSE 100. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I'm certain that we will be able to bring our debt levels down and avoid what you could call a debt crisis because we are focused and we've been open enough by telling the nation that we have too much debt.
Hi from London, I'm Guy Johnson. This is the European Close on Bloomberg Markets. So the UK faces its worst economic slump since 1709. That's the worst in 300 years. 1709, significant. That was the year of the Great Frost. Well, that was certainly the headline from Chancellor Rishi Sunak's spending review delivered yesterday. He expects the economy to contract to more than 11% this year and unemployment to reach 7.5%. Those figures are calculated by the OBR, the Office for Budget Responsibility. Budget Responsibility Committee member Sir Charlie Bean joins us now to discuss the numbers. So, Charlie, thanks for your time. Look, the Chancellor announced a great deal of spending yesterday. It was a spending review, and he announced certainly a great deal of it. Do you think, though, that we may end up actually, given the trajectory we're on at the moment, having to spend even more than the Chancellor confirmed yesterday?
Well, of course, what he talked about yesterday includes the spending that's projected over the rest of this financial year. So it includes the extension of the furlough scheme. It includes provision for the rollout of vaccines and so forth. And given we've had good news on the vaccine front, I think it is reasonable to think that we might be on the home straight here and that the economy will be recovering next year. So I would certainly expect the public finances to be improving as we go through next year. We're expecting for this financial year a deficit of a little bit under 20% of GDP, 400 billion. But it should come down pretty smartly as the furlough scheme ends, as COVID-related health spending comes to an end, and so forth. The key unknown, though, is whether we regain the pre-virus trajectory that the economy was on, or whether we come back to a level somewhat below that. And in our central forecast, I stress there's a lot of uncertainty, and that's why we provided three scenarios, an optimistic, a central, and a rather more pessimistic one. But in our central view, we have a 3% hit to the level of activity, which persists as a result of the pandemic, the hit to investment, possible restructuring in the economy, and so forth. And in that case, there would be a deficit that would need to be dealt with in the medium term. Our report discusses the sort of adjustment that might be required, and you'd be talking about 20 to 30 billion if that forecast were to come to pass.
OK. Just sticking with that central forecast, can I ask you the timeline you went through putting this together? Clearly, over the last few days, actually the last 3 weeks, really since the 9th, there's been a lot of very good vaccine news. And I'm wondering how much of that is factored in to that central forecast. OK, our forecasts take quite a long time to compile because the primary reason that we do them is to produce forecasts of the public finances. And there's a lot of interaction with government departments and so forth. The news about the Pfizer and Moderna vaccines came through towards the tail end of when we were finalising numbers. And we'd essentially finalised the text, and it was all ready to go to the printers when the good news about the Oxford AstraZeneca vaccine came through. So in that sense, they're not formally in the figures.
But one thing I would stress is that although the news on the vaccine front is undoubtedly good news, there's still quite a way to go yet. So first of all, we have to get through the winter without hopefully a resurgence in cases after lockdown ends. Then there's the whole logistics of rolling out vaccines, which is certainly more demanding for the Pfizer vaccine and the Moderna vaccine. The good news for the Oxford AstraZeneca vaccine is that that's less demanding on a logistical, from a logistical perspective, because it doesn't have to be kept at such cold temperatures. But there's always the possibility that as they're rolled out more widely, we may discover there's problems with them, they're less effective. We don't know how effective any of them are at preventing asymptomatic transmission. And there is always the possibility that the virus itself mutates. And we only have to look at the mutation in mink farms in Denmark to realise that's a risk. And that may render the vaccines less effective or ineffective. So our downside scenario is certainly a possibility, but certainly I think the balance of risks has shifted in a favourable direction as a result of the news over the past week or two in respect to vaccines.
The OBR and the Institute of Fiscal Studies and a lot of other people have been trying to figure out ultimately how the deficit gets filled. The government clearly doesn't want to deliver austerity again, and certainly has resisted that as a possibility, though there is looking like there's going to be a public sector wage freeze. My question is, though, regarding taxation. Is it simply too early at this stage, Sir Charlie, to be talking, even hinting, about the possibility of raising taxes, in as much as that will have a behavioural impact and that potentially could have a negative effect on the way people spend and invest? And I'm wondering, therefore, is it simply too early to be even thinking about raising taxes at this stage?
Well, it's certainly a mistake to be doing it. There is no need to start any consolidation process until the emergency is behind us, the pandemic is behind us. However, what is important is that the government maintains its commitment to sustainable public finances in the longer run. And of course, the Chancellor in his speech said he was still committed to that, and he's committed to bringing forward some new fiscal rules that embody that in the coming months, probably at the next budget. Now, I have heard this argument that you shouldn't even talk about what you might do to close any deficit going forward, any unsustainable deficit going forward. Of course, if you don't do that, if you don't start at least making some general indications, there is a risk people expect you to do things which you won't be doing.
Yeah,
so I'm not sure I entirely buy the argument we shouldn't even talk about it. I think it makes sense for the Treasury to be thinking about the options, what are realistic. A lot depends on how much longer-term scarring there is in terms of how much consolidation you need to do. If we regain the pre-virus trajectory, the answer is probably not very much. It's only if there's quite a lot of long-term adverse effects from the pandemic on the economy, and we're on a permanently lower trajectory, then you would need a bigger adjustment. But it does seem to me sensible for the Treasury and other relevant departments to be at least considering what the options are.
One final quick question. In the financial markets, we've seen a huge kind of rotation towards the most beaten up areas that have suffered the most during the financial crisis that we've just witnessed as a result of the pandemic. Airlines, the energy sector. Do you think we can put the UK economy in that bucket as well, in as much as, for structural reasons, we rely on hospitality and the service sector a great deal more than most? The UK economy has been badly beaten up. Do you think it will be one of the bounce-back candidates once a vaccine arrives?
Well, we will certainly get a strong bounce simply because we fell a long way. And indeed, our growth in the third quarter was relatively strong because we'd fallen so much in the second quarter of this year. I think it's easy for people to overdo this business about, well, you know, we're a services economy and we have a big hospitality sector and so forth. Yeah, it's a bit bigger than some of our European counterparts, but not that much bigger. I mean, Germany is the one that looks more obviously different because of the more significant manufacturing sector there. But if you compare us with Spain or France and so forth, the structure doesn't really look that different. I mean, we did have a pretty deep downturn if you look at the international comparisons, as well as suffering a relatively high number of cases per head of the population. So we come out quite badly on both of those two dimensions.
So, Charlie, we're going to leave it there. Thanks for your input. Greatly appreciated. Sir Charlie Bean, Budget Responsibility Committee member at the OBR. Within the last couple of minutes, RTE, the Irish news agency, suggesting that Michel Barnier, the chief Brexit negotiator for the EU, has called, quote, an urgent meeting of EU fisheries ministers for tomorrow, one of the key areas that we're looking for progress on in the Brexit negotiations. I hope you've enjoyed the show. Happy Thanksgiving if you're watching in the United States. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter, and this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements we can actually have the superb measurements that we expect of sea level rise, but also the waves, the significant wave height, which is the top 1/3 of the waves if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Chinese capital market, as you know, is Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is a difficulty, a challenge, which needs government response.
The Fed is really pleading for fiscal relief. I believe it's essential.
The American administration is about to change, but the clock will not simply be rewound.
How fast could we go to underserved communities and pull people into the middle class for the first time?
There's a period of, I think, great uncertainty and great risk.
Our city need to be ready for the convergence of the physical and digital worlds.
We need to use our recovery stimulus to invest in the clean and digital technologies of the future.
The question is, what direction are we pointing our economies? We're going to point towards sustainable growth.
It's the most important mindset to break, is that there's a trade-off between a green recovery and an economic prosperity.
Welcome. I'm Carol Masser. We're looking back at the 2020 Bloomberg New Economy Forum. Now in its third year, this annual summit brings together leaders in business, politics, and policy from around the world to discuss the most pressing issues facing the global economy. Now, due to one of those issues, the COVID-19 pandemic, the 2020 event was held as a virtual town hall, and it focused on the challenges of rebuilding a new economy in the wake of the virus crisis, one that's inclusive and sustainable for all. To lead us through the program, here's my Bloomberg colleague and forum co-host, Scarlett Fu.
Thanks, Carol. The coronavirus pandemic is the single biggest threat to the health of the global economy, and many believe it's exposed a deep sickness in society: inequality. Central banks have devised policies to keep capital markets liquid and prop up asset prices. But can these institutions use their tools to build a more equal society? Former Federal Reserve Chair Janet Yellen and former Bank of England Governor Mervyn King discussed the challenge.
Monetary policy has its limits, and the effective lower bound is a serious constraint. And the notion that the Fed can do all that is required at this point to support the economy is just wrong. And the Fed is really pleading for fiscal relief. I believe it's essential. I think the Fed has been less successful in lending to smaller businesses. That creates an impression of unfairness that the Fed is on the side of big companies and on Wall Street. This is something that's very difficult to accomplish. But, you know, as Chair Powell says, the Fed can't spend, it can't give grants, it can't direct aid to where it's needed to unemployed workers, and fiscal policy has a very important role to play now as well.
Lord King, I know you've echoed some of what Janet Yellen has said in repeatedly saying central banks can't do everything. Do you think they've played the expectations game well in responding to the crisis, or have they set them too high?
So I share much of what Janet has said, but I think to explain what's gone wrong, I don't think central banks have explained clearly why expanding the money supply is the right sort of response to a shutdown of the economy created by governments, different levels of governments, in order to prevent the spread of COVID-19. This isn't a conventional recession. And as Janet said, the most important thing for central banks to do now is to say that this is a difficulty, a challenge, which needs government response, not central bank response. And I don't think it's government response in the sense of general fiscal easing. I think it's a response that's required to support businesses until we get through this COVID-19 episode, at which point we can then let the market economy decide which businesses will thrive and which will fail, which I don't think we can do at present.
Private companies will also play a critical role in shaping a more equitable economy. IBM Executive Chair Ginny Rometty sized up the task ahead.
This is something we got involved in about a decade ago, and it was for the reason that you could begin to see the digital economy would not be inclusive. There would be far too many have-nots versus haves, and this would revolve around having the right skill to work in a new job and have it quick enough. And so, as you see with COVID, and then with all the issues around racism and systemic racism that have evolved, this has just escalated this issue that was, as the minister said, on a slow burn. So what we set out and coined a term new collar, so it would have a positive connotation. We said we had to offer a new pathway for people into our company, not just a traditional four-year degree. And so new collar was meant to be, you could start, it wasn't white collar, it wasn't blue collar, and those connotations with it. It would be about a new collar job so that you could start without a four-year degree. And there are many new jobs that live at this intersection with technology, cloud computing, cyber skills, that you could get started. And what you'd have to believe as an employer is in three different paradigms. And I think in some ways, Jason, this would be my definition of a new social contract. One would be, I would have to hire based on skills first versus degrees only, meaning I'd hire you because you had some skills that you had built in some way. The second paradigm is I'd have to offer a new pathway. The minister used that word as well. So in other words, perhaps you've come from a 6-year high school, which is what hopefully we'll talk about. We got very involved around the world in this. And then the third paradigm would be as an employer, I offer you employability. While I may not guarantee you employment, I can offer you employability, meaning the ability to constantly build the skills that you can have a very good job. Because the issue here is going to become quality jobs, not just any type of job. So that led us down a path of what is a public-private partnership with high schools and community colleges around the world to build and say, how fast could we go to underserved communities and pull people into the middle class for the first time? And we now have a pipeline of almost 200,000 students coming through.
COVID-19 has forced nations to physically isolate. It's also exacerbated geopolitical rivalries. U.S.-China relations are as strained as they've been in decades, even as the two sides signed a Phase 1 trade deal at the start of the year. With a new U.S. president set to take charge in January, prominent voices in business and politics shared their views on the path forward for the superpowers.
The American administration is about to change, but the clock will not simply be rewound.
But unless there is some basis for some cooperative action, the world will slide into a catastrophe.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach.
I hope that he will be able to focus his mind on developing a framework for an overall constructive relationship with China, because the last 4 years have been quite a tumultuous ride.
We should build an open world economy that works for all. We must firmly safeguard the multilateral trading system under the WTO and unequivocally reject unilateralism and protectionism.
When your economy becomes, so big and your interests are all over the world, you have to protect your own interests.
I don't think we're going into a world of deep protectionism going forward. I see more regionalism.
I don't think there's a big bang win here for either side.
Coming up, we continue our review of the Bloomberg New Economy Forum. Ray Dalio says investing will look very different in a post-crisis world.
There are worlds that will be orderly and will prosper in this kind of an environment, and you could see it
And ECB President Christine Lagarde warns policymakers about financial spillover.
We need to really stay clear of that because that would be an aggravating factor.
This is Bloomberg.
일상이 추억이 되는 곳, 이곳을 담은 에피그램.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Welcome back to our review of the 2020 Bloomberg New Economy Forum. I'm Carol Masser. The global economy will undoubtedly be different when the world emerges from the COVID-19 pandemic. How it changes will largely depend on how leaders in government, business, and finance work together to rebuild it. Those leaders had plenty to say at the forum. Scarlett Fu has more from our program.
Thanks, Carol. Even before the coronavirus pandemic struck, regime change was underway in the world of investing and finance. Now it's happening even faster. Ray Dalio has been preparing to navigate these choppy waters for a long time. He explained how his firm, Bridgewater, is adapting its portfolio strategy.
There's a period of, I think, great uncertainty and great risk. And so I think there are three words: diversification, liquidity, and then differentiation. We want to make sure that our investors are not just concentrated in some of the traditional markets. So diversification of how to do that well can reduce risk without reducing opportunity. And that means currency diversification, including the reserve currencies, how much exposure is to the reserve currencies, but it means currency diversification, asset class diversification, country diversification, and that should be the starting point of portfolios. In terms of liquidity, it allows you the flexibility to change as circumstances change. And differentiation is the most important consideration now. There are two different worlds. There are worlds that will be orderly and will prosper in this kind of an environment, and you could see it. And that differentiation versus other worlds and markets related to that, that will be bankrupt and disorderly. That kind of differentiation is important.
As president of the European Central Bank, Christine Lagarde will play a critical role in the EU's recovery post-crisis. She discussed the potential for a COVID-19 vaccine by early next year and a key challenge facing policymakers.
I think that the second wave that we saw presents risks. The first risk that I would think of is the fact that consumers, investors, employers do not regard the the pandemic as a one-off, this V-shape that we all aspired to, but as something that will recur over the course of time, and as a result would lead them to completely change their behavior. In other words, how about if they start saving again for precautionary purposes? How about if they continue to freeze and hold their investment plans because of the uncertainty generated by this situation? And the second risk that I see is the potential real/financial spillover, which we have managed to avoid so far. So in other words, we have not had the financial sector amplifying the downside that has weighed on the real economy, and we need to really stay clear of that because that would be an aggravating factor.
A portion of the New Economy Forum was devoted to the challenges facing cities. Urban economies have been hit hard during the pandemic, but civic leaders are responding with creativity and tenacity, reinventing the modern metropolis. India's Prime Minister Narendra Modi shared his views on the future of cities.
We are looking at a future where a major chunk of education, healthcare, shopping, food experiences may happen online. Our cities need to be ready for the convergence of the physical and digital worlds.
Of course, cities have had to confront public health threats for centuries. Here's a look at how lessons learned from previous pandemics may help with the global recovery from COVID-19.
Humanity has faced the challenge of deadly disease for thousands of years. And whenever a new pandemic takes hold, civilizations adapt in response. In the 19th century, cholera epidemics in Europe set off an outcry for investment in modern sanitation and urban renewal. The movement sparked Baron Haussmann's transformation of Paris into the City of Light, trading crowded slums for wide, tree-lined boulevards and monuments lit by gas lamps. Haussmann's modernization prompted cities all over the world to follow suit. London added sewage systems, and New York built Central Park, adding a reservoir and green space for city dwellers to take in fresh air. At the turn of the 20th century, tuberculosis swept through the US, creating a greater need for urban parks and bringing light and air into building designs. The 1918 flu pandemic led to the invention of the radiator, with steam heating systems designed to allow windows to be left open, even during winter months, for improved ventilation. COVID-19 has already intensified a push by cities around the world to reduce pollution by adding bike lanes, pedestrian walkways, and implementing building design changes. Paris is pioneering the idea of a 15-minute city, creating walkable communities of shops, schools, and clinics, reducing the necessity of cars or public transport. In the distant past, it took decades for pandemics to leave their mark on our city's urban design and architectural landscape. Well, the changes sparked by this COVID-19 are already taking shape.
Coming up, more from the Bloomberg New Economy Forum. BlackRock's Larry Fink sees momentum building to combat the climate crisis.
We were beginning to see this tsunami of change already from the private sector.
And with vaccines on the horizon, Bill Gates discusses how COVID can be conquered. This is Bloomberg.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to our review of the 2020 Bloomberg New Economy Forum. I'm Carol Masser. Climate change poses risks to the global economy that could ultimately cause deeper and more permanent damage than COVID-19. For more on the discussion of climate change and the green economy at the forum, here's Scarlett Fu.
Thanks, Carol. Leaders in business, finance, and government at the New Economy Forum made the case for a green recovery to repair the economic damage from the pandemic, and they expressed optimism that it can be done.
This is about capitalizing on existing market forces, not fighting them. We need to use our recovery stimulus to invest in the clean and digital technologies of the future, to make our economies more resilient and our societies and job markets fairer.
This is an opportunity to both address the problems that will come out of this crisis, to restart growth, to put the global economy not just on a higher growth trajectory, but also on a much more sustainable growth trajectory. So going forward, and we do hear countries announcing plans to step up action on the climate front. And so I am hopeful that much more will be done. But 2021 is the year when this should happen.
It is Unilever's profound belief that purpose and sustainability are a pathway to better financial performance. There is no trade-off. And we're already seeing that money that gets invested in green stimulus seems to generate a better ROI than the more broad stimulus packages. So it's the most important mindset to break, is that there's a trade-off between a green recovery and an economic prosperity.
In 2020, we saw at BlackRock more than a doubling of investments towards climate change. And the inquiry we're having from U.S. companies, U.S. foundations, globally, we're seeing a change. So we were beginning to see the tsunami of change already from the private sector. And now with the potential of having a Biden administration, I think we're going to need the government to come along and help us on this journey.
Former Bank of England Governor Mark Carney has shifted his focus from monetary policy to climate policy. He's working with the UK government and the United Nations on climate action and finance. Carney told Bloomberg's Alex Steele there's no time to waste in this effort.
We need to invest now. I mean, we're touch wood, we're going to be coming out of the health and economic crisis. The question is, what direction are we pointing our economies? We're going to point towards sustainable growth. Huge investment. You rightly started with that, Alex. Huge numbers for investment that's capital intensive. It's job heavy. Having that information now so companies and investors can put money to work is critical.
So what role then does policy play in that? We just had an election, obviously, here in the U.S. What's the role of public policy?
Yeah, so I think there's a couple roles. One, and I wouldn't understate this first bit, is set the direction. So one of the planks of President-elect Biden's platform was the U.S. is going to move to 100% clean energy and net zero by 2050. So you set the direction. Secondly, you put in place the frameworks that are necessary, that information for investors to make the decision. And you also have credible regulatory policy. So you're showing the direction of the economy. More hydrogen, zero emission vehicles, moving towards electrifying more of the economy and moving the electricity sector and generation towards renewables. All of those things send signals to investors, provide the information as well, and gets money moving. So that's what government has to start with, the objective, fill in with the framing, and then candidly get out of the way so the private sector figures out where to go.
Investors around the world are demanding green investments. But what exactly does green mean? Guggenheim's Scott Minerd addressed this issue from an investor's perspective.
Very little time is being spent on trying to set economic incentives. Until the private sector has economic incentives to get there, the reality is that everybody will continue to act in what they think is their best interest. And right now, a great organization like HSBC, who's made a huge commitment and is way ahead of the curve, can be negatively impacted if they move too aggressively when other people decide they're going to take advantage of the fact that HSBC has changed their policies.
So do you think that this is something that needs harmonization, like in a way that we bring more groups together to sort of set targets? Is this a policymaker's question? Like, what's the who's going to be the prime mover on making this come together in a way that's beneficial for everyone?
Well, I think it's all of the above. I think the policymakers need to look at this and understand that there are incentives that can be put in place which basically don't cost anything for the governments. But two, I think the investment community in the broad sense should be getting together and discussing this issue to try to be develop a uniform standard about a baseline for what the objectives are, what the definitions are, and what the rules of the road are.
The Bloomberg New Economy Forum also featured sessions on infectious disease research, public health, and the progress of COVID-19 vaccines and treatments. A conversation with Bill Gates touched on several of these critical issues, including the prospects for eliminating, not just controlling, the coronavirus.
We don't know enough yet to say, can we do the elimination of this? That would be the best, because then zero is magical, because it just doesn't spread at all. It doesn't come back. I think there's a good chance we can do that, but we'll have to look at the vaccines, how good they are at blocking transmission. Because this is a super spreader disease, it is likely we can do that. Otherwise, we'll have to maintain immunity on an indefinite basis, which probably means booster shots. And a little bit, as people come into the country, do they have a digital certificate that says whether they've been vaccinated or not, which that's fairly complex and will need for a period of time, like we've tried to do with yellow fever. But as the U.S. rejoins the WHO, this idea of what does the vaccine certificate look like, hopefully that dialogue will begin.
Visit Bloomberg.com to see much more from the 2020 New Economy Forum. Bloomberg subscribers can access NEF Go on the terminal for complete coverage. I'm Scarlett Fu. Carol, back to you.
Thanks, Scarlett. And thanks to all the participants who made the Bloomberg New Economy Forum a success. As the world continues to battle the pandemic, we hope it will help inspire the practical solutions and innovative actions needed for an inclusive, sustainable economic recovery. I'm Carol Masser. Stay safe, everyone. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
What is at the moment what we see as scaled up worldwide, globally, beyond CureVac even, there will be enough capacity to really vaccinate the world, well, let's say until the end of next year.
Yelp is the go-to site for raves, rants, and recommendations.
Since its launch in 2004, chances are, if it's a business down the street from you, it's got a Yelp page. But the coronavirus pandemic dealt a devastating blow as thousands of businesses across the country were forced to shut down. Yelp laid off 1,000 of its own employees. Now, with a vaccine in sight, but virus uncertainty still ahead, Yelp serves as a sort of mirror to the health of American business. Still, it's not COVID that CEO Jeremy Stoppelman is most worried about. It's the growing shadow of Google. In this edition of Bloomberg Studio 1.0, Yelp co-founder and CEO Jeremy Stoppelman.
Take me back to March 2020. The pandemic hits and the lights go out literally at thousands of small businesses across the United States. As the person who runs the most prominent platform for small businesses in the country, what was that moment like for you?
Probably the best word is terror. It was a scary moment, I think, obviously for America, for small businesses, and especially for Yelp, because we're a way to find great local businesses. And, the first thing crossing my mind is, are people going to still buy advertising? Like, are all businesses going to be affected or just a portion? We had gone through, I was CEO in 2008 when we had that major recession. And so I knew that Yelp as a company should be resilient, but I had never faced anything remotely like a pandemic where every business is potentially affected by shutdowns. So it was a very scary moment for me and for the company.
Did reviews come to a standstill? Did advertising stop?
We certainly took a pretty big hit in advertising dollars as people paused their campaigns. Fortunately, we had functionality that allowed them to set a future date. And so we encouraged people to, set a resume date for their advertising months later, perhaps as the pandemic had passed, or at least when the panic would have subsided. Our focus at Yelp was really getting employees ready to work from home, getting people out of offices. This is all, kind of late February. It hit our radar as, hey, this is coming. We need to get, salespeople at home. All of our salespeople have desktop computers in an office. Like, how do we get them equipped to try and work out of their home and, keep the company running? And so there was a lot of operational challenges transitioning people to work from home and getting ready to try and adapt to this extreme crisis.
So fast forward to fall, Yelp shares spike 20% on news of the early success of the Pfizer vaccine. And if everything works out, that could mean the economy opens faster. That's good for small businesses. That's good for Yelp. How optimistic are you?
None of us have been through a pandemic before, so we can't know everything. But, I can't say that in the last quarter, things really had come back. Economic activity had picked up. We were seeing people starting to dine at restaurants. Obviously, with the better weather, we weren't quite into winter yet. People were returning to restaurants. Home and local services, as people spent more time at home, really has held up throughout the pandemic. We've really come back in a big way, faster than even we were hoping for. And with the vaccine potentially arriving and starting to get out there, I think we can finally say, hey, there is light at the end of this tunnel. That's been the scariest thing about the whole crisis is we had hoped that a vaccine would arrive, but actually knowing that one is there and that it's actually 90% effective, I think is very exciting. Certainly for us at Yelp, hopefully for lots of in the minds of small business owners, and the rest of the world is very happy, I think, to hear that news.
So what are you expecting to see over the holidays, given that we're going into winter, cold and flu season, a potential spike in COVID cases? We're already seeing hospitalization surge, and we know that people aren't going to be traveling and out there shopping and eating out like they normally would.
I mean, it's hard. I'm not currently contemplating national shutdowns where everyone is frozen in place like they were, kind of the March, April timeframe. I think people will have to be cautious, in restaurant dining will probably be curtailed or very limited depending on the situation in that particular region. But I think again for Yelp's business, a lot of it is buoyed by the home and local sector, which has done really well. As people are home, things happen. Your roof leaks, you got to get that fixed. Your toilet clogs, well, your whole family is, your kids are possibly doing the remote schooling there. You got to get that thing fixed. And so those service providers will continue to do well and will continue to spend to acquire leads from sites like Yelp.
Now, you regularly release these economic impact reports, and from what I can tell, by the end of summer, you found that 160,000 businesses had closed on Yelp. Where does that number stand now? What are businesses telling you about how they're doing region to region?
We have seen, lots of businesses reopen that were temporarily closed. I think the number is around 220,000 of the temporarily closed businesses have opened back up again, which is a great sign. And also from a new business standpoint, especially in the restaurant and food sector, we're seeing new business openings at levels that are in line with 2019. So, that's one really inspiring thing showing kind of the resilience of American entrepreneurship is that businesses are, new entrepreneurs are still being born in this environment, which is incredible. I think it just shows incredible tenacity and bodes well for the economy as we start thinking about 2021 and beyond.
Now, early on in the pandemic, Yelp laid off 1,000 people. You furloughed a bit more than that. Where does staffing stand now?
At the start of the pandemic, obviously, we saw advertising revenue dropping very rapidly. We had to make some very tough calls around our people, people that were incredible employees for us, and it was a very difficult moment. We had to lay off 1,000 people, as you mentioned. We also furloughed about 1,000 people as well. And that set us into that put us into a stable position to ride out sort of the immediate impact of the pandemic and whatever economic damage would result. And 4 months later, we were actually in a position to be able to bring back extend offers back to almost all of the furloughed employees. And so that was a great feeling. Obviously, it's very tough, to let anybody go. But we had made a commitment to these furloughed employees, and so it was great to see so many of them back working at Yelp, and many of which are here today.
Now, the pandemic, as you alluded to, has become very, very political, and I'm wondering what your take is on Joe Biden's election. Are you at all concerned that his safety-first approach could, mean the economy opens more slowly?
I think we have to be guided by science. We have to take a dispassionate look. We have to take politics out of it and say, we can't really have a great economy if everyone's cowering, from impacts of the pandemic or hospitals are getting overloaded with cases. So we just have to take a sensible approach. We have to listen to the scientists. If they're telling us that, wearing masks is going to, diminish the impact of the pandemic, then we should all be wearing masks. It's very straightforward. It shouldn't be a political issue. It's very frustrating that it has been. And I think that costs us valuable time and even more importantly, costs us health and even lives.
It seems like the next stimulus package might be more scaled back. Are you concerned about a divided government, meaning that small businesses aren't going to get the help they need?
I think the Fed chair has been pretty clear that, businesses need support, especially small businesses need support. And I think the initial stimulus package was a positive. And, we've been all waiting and hoping for another one. And I think, we shouldn't just have socialism for big companies where they can borrow endlessly with cheap debt from the, powered by the Fed. We should extend the helping hand to all these great small business owners that are just trying to get by. An assistant of mine, broke into a meeting and tapped me on the shoulder and literally slipped me a Post-it note that said Steve Jobs is on the line.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
We could spend a lot of time talking about old stories. You've been in Silicon Valley a long time. You were part of the early PayPal team. But there's one old story that I really do want to ask you about, which is that Google tried to buy Yelp back in 2009 for over $500 million, and you turned them down. Explain how that played out.
Well, I think that Yelp was doing something really positive, which was, growing quickly, gathering all this useful information about local businesses that, frankly, no other site had. And I think Google saw that Maps was of growing importance to them and was interested in Yelp. And we initially had a partnership. But ultimately, I think, Google wasn't satisfied with that partnership and wanted to get into the business themselves. And so then, there was a back and forth where they had some interest in Yelp. But ultimately, it didn't work out. I think we saw things differently. And I think that was good. It allowed Yelp to stay independent and to grow on its own. And frankly, I think I've been able to develop as a CEO quite a bit as well. So I think it's been good for me personally.
Now, as the story goes, Steve Jobs, who was obviously running Apple at the time, Google's biggest competitor, called you to convince you to turn it down. Did that really happen?
It did. Yeah, it was a bit of a surreal moment. I'd call it probably a career highlight, still a peak highlight for me. When an assistant of mine, broke into a meeting and tapped me on the shoulder and literally slipped me a Post-it note that said Steve Jobs is on the line. And so I ran out of the meeting and then, picked up the phone. And of course, it wasn't Steve Jobs. It was Steve Jobs' assistant was on the line. And so then I was waiting for Steve Jobs, who did ultimately get on the phone. And he had some not so nice things to say about Google and some nice things to say about Yelp, and said, he loved Yelp and that we should keep going. And if it was a money thing, then we should be talking to Apple, not Google, but we should just keep doing what we're doing. And, I thought that was good advice.
So fast forward to today, Yelp is now a $2 billion public company, but also Google is now your biggest competitor. Did you make the right call?
Well, I think I did. I think Yelp continues to serve on its mission, which is connecting people with great local businesses. And it's been a really rewarding journey. And I think lots of people find Yelp still incredibly valuable. I think, over 100 million people come to Yelp every single month and steer themselves to a great local business. So I think it's going well.
So the Department of Justice has recently sued Google over antitrust. Taking on Google, competing against Google is no joke for any business. What was your reaction to the suit?
We've been working on this topic for a very long time, so there was a good feeling, I would say, in the Yelp office, because we've been kind of shouting from the rooftops for a very long time that there is a monopoly problem in this country, and in particular, there is a Google problem in this country, and Google has behaved illegally, and has leveraged its monopoly in ways that are destructive to innovation and competition, and bad. It's bad for consumers, bad for small business owners, and so it was great to see some early validation of that from the DOJ.
Now we've all seen the increasing number of Google reviews, and Yelp's main complaint that Google favors its own reviews over yours isn't actually the core of the case. Are you at all concerned that your concerns might get passed over?
I mean, it's hard to say where the case goes right now because the state AGs will be, sort of bringing their own cases, and presumably it gets consolidated. So it's hard to know the exact scope of the case. I think, the early signs that, from our perspective are positive. And, again, there's bipartisan support for really scrutinizing Google and taking a look at their behavior over the last decade. You look at like television over the last 40, 50 years, it was a highly regulated industry. You look at radio, highly regulated. Even going back to movies, there were antitrust cases that made a big difference in the distribution of films. And so why is it that technology should be completely immune to that, especially these new, sort of the Google generation of technology companies? Why shouldn't, Congress exercise its power? Why shouldn't the DOJ investigate? Why shouldn't the FTC investigate?
You told 60 Minutes back in 2018, if I were starting out today, I would have no shot of building Yelp. That opportunity has been closed off by Google and their approach. If you provide great content in one of these categories that's lucrative to Google and seen as potentially threatening, they will snuff you out. They will make you disappear. They will bury you. Has Google continued to try to bury Yelp since that time?
I mean, it's an easy thing to test for yourself. You could just, do essentially any search with local intent and then see how far down the page you have to go to get to any kind of organic result, especially in, a category that's particularly lucrative from a SMB advertising standpoint. I mean, they've really tried to maximize the revenue, and in doing so have put the consumer in the back seat. And I think that's a real problem. But then also it stifles innovation, because if it's basically there's no organic content anymore, there isn't really that incentive for creators to try and create new and interesting websites, collect information from users. I think it's quite sad. And I think if you talk to the venture capital community, you'll hear that as well. There just isn't as much interest in ideas that are powered by search engine optimization, where you create really wonderful content and then Google or other search engines drive you traffic. Like, it's just Google now, and if it's a lucrative vertical, they're going to try and suck up all the revenue.
Now, President-elect Biden hasn't detailed his thoughts on antitrust yet, but we know that the Obama administration was fairly close to Silicon Valley, and Google in particular. How would you like Biden to weigh in on antitrust? What do you want lawmakers to do? Should Google be broken up?
Yeah, I think all we can ask for is independent thought. And so you're absolutely right that unfortunately the Obama administration has a very bad record when it comes to antitrust enforcement and especially Google scrutiny. I think Google's lobbyist was the #1 lobbyist in the White House by visits. And so that's been widely reported. And even as the FTC was purportedly investigating, there was seemingly back-channel communication with Google, which is very sad to learn of. And so I would hope, and I think there's some indication that Biden is going to take a more independent view of this. And I think we'll have to see, who's involved in the administration, who's in the cabinet, who are the people around Biden. My personal thought is somehow we have to get Elizabeth Warren in there, because she's been particularly strong on, hammering home the point that monopolies are not good for the economy. They're not good for innovation. They're not good for consumers. And so we need someone like that with a really strong message and a strong independence streak as well.
Now, all of that said, some businesses have complained that Yelp reviews skew more negative. How do you respond to, this complaint from businesses who, might prefer Google because they see that they have more positive reviews there?
We try to be, the most independent, create a level playing field for businesses. And, that frustrates businesses that, frankly, on other platforms are used to getting what they want, which is, being able to ask their friends to write reviews for them, being 5 stars. And in fact, the data supports that. So the FTC, an economist there, recently put out a paper that talked about the review distribution on the various platforms. And Yelp actually has the most balanced review system, which is very validating. That feels great to me, because that's what we're trying to achieve, is just a mirror of the real world.
If you are a woman or a person of color in Silicon Valley these days, what's your advice?
These are talented people. They do have a lot of options, so make sure you choose an option that supports you and makes you feel valued.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
You're an engineer, you worked at X.com, back in the day, the online bank that was started by Elon Musk, which merged with PayPal. What are some of the biggest lessons you've taken from that time in your life and those people who I imagine are still in your life today?
One of the big takeaways from PayPal was just how much you could do even if you had no experience. And so I joined X.com, which eventually merged with PayPal when I was 22, I think. And very quickly, I became an engineering manager, maybe a year and a half later, 2 years later, and then ultimately rose into the executive ranks there on the engineering side. And thinking about it, it was kind of preposterous that those folks would give me so much responsibility so early in my career. But the fact that we somehow pulled it off and created a successful consumer brand and payment site that ended up being really critical to eBay, and then ultimately now as a payment service that so many of us use, I think validates that it's not all about experience. A lot of it is grit, determination, creativity, innovation, all of those good things. And so I've tried to bring that with me to Yelp, frankly. And we try to make sure that people have fantastic careers. We have a lot of growth from within when it comes to promotions. And we have a lot of homegrown, now senior employees. And so it's really validating to see people step up and take on more responsibility over time.
Where do you fall on the importance of culture? Because it seems like there's a group of CEOs in Silicon Valley who seem to think it's important and others who seem to think it's all about growth.
Well, I think you want both. I think it's hard to be a company and not have robust growth. It just fundamentally is difficult, especially in the technology industry where things change so fast. So if you're not growing, then you're probably not keeping up, and then eventually you fall over. But I think we also see that culture is important, especially in recruiting the top talent that you need to succeed here in Silicon Valley. Is you need to have a great culture. You need to be on top of things, what's going on in your organization. Because if you don't, somebody else will be good at that, and then people will flock to that company that is also high growth. There's always other shiny new objects out there, and so you want to deliver, I think, on both dimensions as a CEO. There's
been some reporting in Business Insider that Yelp has an aggressive sales culture. What's been your response to that?
I mean, we're one of the most highly scrutinized sales teams, I think, in the history of local sales teams. I mean, for many, many years, business owners, for instance, would accuse us of extortion because they claimed that you could take down Yelp reviews if you paid us. That was never true. And so any individual anecdotal accusation, I think you have to take with a grain of salt. We do have thousands of salespeople, and so is every conversation going to be perfect? Absolutely not. But we have systems in place to ensure that the conversations are the ones that we expect, are empathetic, are thoughtful, and the vast, vast majority of those conversations are great.
Now, I've interviewed many folks in the PayPal mafia over the years, and they all seem to agree that, very smart, but also very lucky to have each other. If you are a woman or a person of color in Silicon Valley these days. What's your advice? How do you break through if you don't have that kind of a network?
I mean, I think Silicon Valley has gotten better on this dimension. I think there's a growing awareness of the need to create opportunities for people of color, for women. And so I would make sure that you're aligned with a company that does care about these things. I think Yelp is a company that does care about these things, that cares a great deal about diversity. And a lot of these companies are now publishing, annually their numbers on how are things improving. Are they making progress? Do they have something to show? And I think Yelp has consistently made progress on that dimension, and it's all public. It's published annually in our reports. And so that's probably my best advice is these are talented people. They do have a lot of options, so make sure you choose an option that supports you and makes you feel valued. Because there's so many great companies in Silicon Valley. Like, don't waste your time on someone that doesn't value you.
When you look ahead, let's say 5 years from now, and the pandemic is hopefully in the rearview mirror, what is going to be the biggest source of growth?
Well, I think we have a lot of opportunity to better monetize Yelp. We talked about how only about 20% of our leads are monetized right now. And so we'd love to see that percentage drift up because there's just so much incredible value flowing through Yelp, accruing to business owners. And we want to give a boost to the people that are paying us. We want to help our advertisers get more leads. And so that's a big focus for the company. And also, we just want to build out our presence in home and local in some of these areas that people may not be as aware of. Like, I think across the country, everyone knows Yelp is a restaurant site, but how do we shift that perception and really, drive home the message that Yelp is for anything that you need locally, any service provider, any local business, you should be turning to Yelp because it has, as we talked about, the most balanced rating system, the most useful and trustworthy information. And so skip that whole Google box and just come to the Yelp app.
That's a great place to end it. Jeremy Stoppelman, thank you so much for joining us today on Studio 1.0. It's been great to have you.
Thanks for having me.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
일상이 추억이 되는 곳, 이곳을 담은 에피그램.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
There's a lot of concern in Hong Kong, and you can see the way actions, reactions, and further anxieties arise. I hope we can settle down to a new normal.
Riggs in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, Salesforce considers buying Slack, a deal that could be announced as soon as next week. Slack shares surge on the news. We have the latest. Plus, COVID company, cloud company, come on, Taylor, VMware, it beats estimates. We'll talk strategy both now and in a post-pandemic world, and we do it with VMware CEO Pat Gelsinger. And as millions of Americans continue to stay home amid the coronavirus, we run down some of the hottest holiday tech products out there, all as people swarmed online sites for gifts. And speaking of staying home, what streaming companies are doing to keep you tuned in? And we'll get to all of those stories in a moment. First, let's get a check on U.S. markets, where we've been really talking about the rotation out of tech shares on promising vaccine news on Tuesday. All of that reversed course Wednesday amid new data showing a possible slowdown in economic growth. Bloomberg's Ed Ludlow joins me now with more. Ed, what are you seeing?
Yeah, I'm calling it the unwinding of the rotation trade, Taylor. Clearly a move into cyclicals away from value. The S&P 500 coming off its record highs, the Dow coming off 30,000 points that we saw yesterday. And then those gains are coming back for technology stocks. You can see there the NASDAQ 100 index up 0.6%. As you said, data-wise, this was the first back-to-back rise in weekly U.S. jobless claims we've had since July. So investors reassessing what's going on with the economic recovery as it relates to COVID-19. You know, the story, as you say, has been a move into value, a move into small cap stocks, those kinds of companies that would recover if there was a successful rollout of the vaccine. But, you know, that kind of sentiment is a little bit on pause right now. In terms of the names that are doing well, it's really the stay-at-home stocks that we're talking about, the likes of Apple, the likes of Microsoft, all up on the day, including Amazon and Zoom, which we talk about so much, one of the big beneficiaries of the pandemic. But we did get this big data deluge, as well as Fed minutes that didn't really move the needle. We saw some softness in gold, some Bitcoin softness as well. We might have expected to get to that magic number of 19,511, a record for Bitcoin, but we didn't. The cryptocurrency fell away in the later hours of trading, and then also the Treasury yield on the US 10-year largely unchanged, Taylor.
I'm going to try to lure you from Bitcoin on over into Tesla, because the rally continues despite some of the stalling that we've been talking about within the rest of the EV space.
Yeah, it is relentless, and Tesla continues to lead the way up on the day. There is a little bit of a reassessment for some of those newer stocks, some of them the newer names to have listed recently. Perhaps they're pre-revenue. Perhaps investors are thinking this rally's been very hot, but it's time to look off. Perhaps a suggestion as well of profit taking ahead of Thanksgiving. Some traders certainly telling us here at Bloomberg that those stocks that go up must also come down at some point, and that factors into it. But as I said, the undercurrent that is pushing EV stocks is one of policy. We're inching ever closer to a Joe Biden presidency. He has a very clear policy of reinstating a full tax credit, and the optimism, the hope, is that that will push consumers to take EV adoption more seriously, because it will put those vehicles on a more affordable footing against their combustion engine equivalents.
And Ed, I mean, it's incredible. You think the Wednesday before Thanksgiving, everyone's gone home at noon, but no. I mean, the corporate world continuing to make some big announcements. IBM, Salesforce, what are you noticing?
Yeah, relentless corporate news flow. In IBM's case, sources telling Bloomberg that job cuts planned, particularly in Europe. A little softness in the stock today, not a huge negative reaction. We had a report out that Salesforce in talks with Slack over potentially acquiring. You can see how investors responded to that. Slack up almost 38%, Salesforce down 5.3%. We're waiting to hear more. Raymond James expressing some doubt that that kind of deal could take place, but that is certainly one to watch for the coming weeks.
Thank you, as always, to Bloomberg's Ed Ludlow for the latest on all of those markets. And he mentioned Salesforce, and I do want to talk about that story next. Salesforce considering acquiring workplace chat tool Slack, all according to a person familiar with the matter. Slack shares surging as much as 34% Wednesday, while the news weighed on Salesforce, which fell as much as 5%. To discuss, we're now joined by Wedbush analyst Dan Ives. And Dan, the analysts are sort of coming out and thinking that this looks positive. What is your early take on this?
Look, the early take, it would be an aggressive move by Benioff and Salesforce. But take a step back. I mean, we're going into a golden age of cloud, and they're looking to just further expand the footprint. A Slack deal would make strategic sense And it would also be a major shot across the bow to Microsoft, Google, and others in terms of where Salesforce views the coming years, in terms of where they are positioned, in terms of what I believe is $1 trillion that could be spent in the cloud over the next decade.
Dan, some of our analysts were also noting that in order to do this, the best way is via stock, given the lofty valuations. If there were to be an M&A, do you prefer stock as the acquisition mode?
Well, I think just given the size of the deal of Slack, first off, this would be the biggest deal Salesforce has ever done, and there clearly be a significant equity component. That's why the stock sold off. But I think investors view this as forest of the trees, what this could do to Salesforce in terms of penetration on the cloud, as well as they would continue to expand Tableau and now potentially Slack. And then there's some that view it if Salesforce does not acquire Slack, do they get acquired by another vendor? So right now, this continues to be, I think, just the start of a surge of M&A across software.
Who could be that other vendor?
Look, right now, if you look, I mean, the biggest competitor, of course, is Microsoft. And you look at who would want to go up against Microsoft. And, you know, when you look at Google and Amazon and, you know, some of the traditional names, I mean, there's antitrust issues. And I think that's part of the issue when you think about who could do a deal like this. Maybe Adobe would be one, but Salesforce continues to kind of be the core front and center. And that's why if Salesforce walks away or the deal does not happen, and I think there could be just more, you know, headwinds in terms of the stock to Slack.
How nervous, then, should Microsoft be if indeed this deal goes through?
Well, I think for Microsoft, it's definitely a competitive threat in terms of where Teams is. No, Teams in the scheme of things is not generating significant revenue, but I think it just shows where Salesforce is viewing itself in terms of this cloud race. It's really been a two-horse race, of course, between AWS and Microsoft, but now with Salesforce, more and more competing against Microsoft on Dynamics versus CRM, and it just speaks to this cloud pie. This is something in the work-from-home environment. It's just accelerated the cloud stories by 1 to 2 years. And Salesforce and Benioff recognize there's a time to seize on this in terms of going to fifth gear of growth, and that's what they're trying to do through M&A.
Dan, we love getting you on this program because you really can talk about most of the interesting technology companies, and we have to turn to Tesla. An incredible price target on your end at $1,000. What gets Tesla to $1,000?
It's all about China. I mean, we are at an early inflection of demand in terms of what we're seeing in the China opportunity. It's 4% penetrated today, could be going to 10% in the next 2 to 3 years. And Tesla, in terms of where they're positioned with Giga 3 and what you're seeing with adoption, and it's not just in China, but in Europe, and Ed talked about, and the Biden administration is just more and more bullish for EVs, we could be looking at 1 million units for Tesla in 2022. That's why in the EV market right now, it's Tesla's world, and everyone else is paying rent.
What about competition, though? Ford, GM, Rivian, Fisker.
Look, this is going to be a transformational opportunity for many players. When I look at GM in particular, I think that's one that has a big opportunity to be successful. You look at Fisker, and then, of course, in China with NIO and BYD and some of these others, I think that's why when you look at the overall EV market, it's not just going to be one winner in terms of Tesla. Competitively, they're going to start to narrow the gap. Right now, Musk and Fremont continue to be 18 to 24 months ahead of any other competitor. Although you look what GM's doing, I think that's probably the most interesting thing domestically in terms of competition-wise.
Dan, you also cover VMware. You've been outperformed a $175 price target. We're going to be speaking with the CEO next, Mr. Gelsinger. What would be the one question you would want to ask?
Look, I think Pat and the team, they're doing a great job in terms of building out the product portfolio. I think the biggest question is around cybersecurity, in terms of where that fits in the product portfolio in the cloud. They're in pole position to gain more and more share going through a SaaS transition, but I think it's looking really at that opportunity and how they can expand that with the rest of the virtualization suite.
Dan Ives of Wedbush, thank you as always for joining us on a host of topics there. And stay with us because coming up, we will have more with VMware CEO Pat Gelsinger talking about the recent earnings report and why software as a service, it is taking center stage. That is next. This is Bloomberg.
일상이 추억이 되는 곳, 이곳을 담은 에피그램.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
VMware out with earnings today. Top third quarter estimates saw SaaS revenue soar 44%. However, some analysts still gave some cautious praise to the cloud company. Traders also remaining a little bit skeptical of the company's bottom line. Here to go over all the details, let's bring in VMware CEO Pat Gelsinger. Pat, always great to have you on the program. Talk to us about that outlook for the full year 2022. That seemed to be in part where analysts were perhaps maybe needing some more answers.
Yeah, and clearly as we looked into next year, we said, hey, one is we still see that the economy has a lot of choppiness yet. And, thus the first half probably a bit more conservative, more recovery in the second half. Second issue being we're leaning hard into our subscription and SaaS transformation. And with that, when you move to a subscription model, you get less upfront, but the lifetime value of the customer is better. So that's depressing near-term earnings and revenue growth rates. Those would be the two big factors. And overall, hey, we're excited. As I say, it's faster to the future. And we're taking this COVID pandemic crisis and we're saying we're going to go faster to drive that transformation because we see that's overall where the market is going. And we're going to transform our business to be a unique provider of on-premise and cloud-delivered services, a real hybrid offering that we're uniquely positioned to do.
You talk about that SaaS smile. When can we expect sort of the uptrend of that smile?
Yeah, we do see it sort of as a 3-year cycle. And as we're pressing to go into that smile more aggressively next year, the second and third years look better when you're sort of coming on the other side and the businesses that you've built this year are accelerating. The SaaS is more at scale, so the margins improve. So it really is this 3-year picture. And next year, we say against a still choppy economy, we're taking the opportunity to go faster into the smile.
With that margin outlook, how much of that, in terms of the mix of the margins, comes from investments in marketing or perhaps maybe hiring?
Well, so we've continued to invest this year. We're planning to continue to do so next year as we build our team. A SaaS model does have more also customer success requirements, right? Because you have a little order, you get them on the product, then you have to grow it over time. So you're much more in partnership with the customer to drive their success, and that does drive up the upfront costs of a SaaS business, so we're making those investments as well. So overall, yeah, it is a bit investment heavy on the front end, but the lifetime value, as we're seeing from the customers who are coming on our offerings, and again, with 44% growth rate this last quarter, building on very strong growth all year long, we're quite optimistic we're where our customers and where the puck is going.
RBC analysts, in noting, we're saying that the guidance is conservative, and I do wonder, why the conservative guidance?
Well, I think everybody looks and says, boy, VMware, when they say something, we are confident in our guidance. We've been a better predictor of the future, where the markets are going. And overall, I think against that, they're saying, boy, in that high single digits range, they were expecting a little bit higher. But as we look at it, I think everybody is maybe a little bit too euphoric as well on the economic outlooks. And we still believe we have a long way to go until there's a broadly deployed vaccine. So all of that taken together, we're comfortable with the guidance that we've given, and we have a great track record of being able to deliver against what we say.
We talk a lot about Amazon Web Services as well on this program. I am curious about how you think about relationships with some of these more hyper cloud providers.
Well, VMware's come a long way in our hyperscale relationship, and in particular, we're just thrilled with the AWS team. Andy and I and our teams meet very regularly, and as we've started to see them really lean behind the VMware offering, that business for us, again, 100% year-on-year growth rate. They're a preferred partner. We're getting big customers who are just betting on the VMware Amazon relationship at scale, so quite excited about that. But one of the really powerful things of this last quarter is we now have all the other hyperscalers transacting now their VMware offering. Azure, Google, Oracle, Alibaba, IBM, they're all on board delivering a complete VMware solution. And this is what we say is our multi-cloud capacity. Bet on VMware, we can help you take advantage of these hyperscalers and your on-premise environment as well. And that's a unique position that we have of a multi-cloud hybrid offering against a common VMware footprint, gaining more interest and momentum in the marketplace.
You mentioned that on-premise business. Do you get concerned at all if it doesn't come back as quickly as we thought?
Well, it is one of the factors that was somewhat negative on this quarter. It's what we expected, and what we guided to. And we do expect some recovery as we're looking to our pipeline in Q4. And as the economy comes back, we expect it to come back as well, largely aligned with the economy next year. Now, we do, and I've called it the 3 laws of the on-premise cloud, right? Laws of economics, laws of physics, and laws of the land. There's lots of areas that they need it on-premise for regulatory reasons. Laws of economics. It's cheaper for an at-scale private cloud than moving to the public cloud. And finally, the laws of physics. And this is where edge computing and 5G will have more things on premise because you need that very low latency for robotics and smart cities and 5G and edge environments. So overall, we're quite confident that the foundational reasons people will build on premise remain the same, even as we've seen an acceleration of the cloud and SaaS offerings in the near term.
You also have unique insight into how customers are thinking about spending or not. How do you generally look at IT spend in this moment and amid some of the uncertainty that we experience?
Well, overall, I've been on record that we're in a decade good cycle for tech spend. Digital transformation is more important than ever. And if there's a moment in history where that's been the case, the pandemic period has been at work from anywhere, telehealth, educate from anywhere. So overall, it is a good cycle for tech. And we don't expect that to end for several years into the future. So I look at it as GDP and IT spend will be better than GDP. And software spend and cloud spend will be better than IT spend. So overall, that order, and while they may come down in an economic cycle, they're also going to come up in that order as things come back as well. So we're overall, tech spend strong, software and cloud spend even stronger, and that's our outlook for next year and for the years beyond.
Wonderful. Pat Gelsinger, VMware CEO, always great to have you on the program. Apple, PlayStation, and Peloton, we have a review of some of the most popular consumer tech devices that many will be looking to buy this Black Friday and Cyber Monday. Are they worth the hype? This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Black Friday and Cyber Monday are upon us, and there are 4 hot tech devices competing for consumer dollars and attention. Bloomberg reporter Mark Gurman gives Emily Chang the rundown in a segment we like to call Power Up.
All right, Mark, thank you so much for joining us, and welcome to our inaugural segment of Power Up with Mark Gurman. I want to start talking about the new iPhones. There are 4 new iPhone 12s out this year. I know you've been using the iPhone 12 Pro Max, which is the biggest one, but you've also tried out 4 of them. Which is the one to buy? How are they working? Does 5G work? And who should be upgrading this year?
I've been using the 12 Pro Max, and it's a big phone. I've seen some people call it a lot of iPhone, and I really love that big, larger screen, the better camera. But I do wish that Apple would take better advantage of that screen real estate. It would be really nice to be able to do 2 apps side by side. So I think if you're having an iPhone 11 or coming from an iPhone 11 right now, you really don't need to update, because 5G is still in its infancy. The speeds I've seen are not as fast as one would immediately expect, or what Apple is really marketing. But if you're on an iPhone 10 or older, I think that now's the time to upgrade because of that new camera, the screen improvements and such. The carriers have all sorts of deals. So if you're going to AT&T and trading in a phone, you can practically get the phone, if you get the iPhone 12 mini, for $0 a month, or $10 a month for the 12 Pro, or around $15 for the Pro Max. So there are some good deals out there, and I would take a look depending on your carrier to see what's up.
Talk to us about the wireless charging situation, because this is the first time that Apple didn't include the charging brick in the box.
Yeah, I mean, the situation is a little complicated because they still have the charging port at the bottom of the phone, but they have now is this new MagSafe charging cable. Now, the problem is the cable is $40. The phone doesn't come with the brick. So really, to use wireless charging, you need to buy that $40 cable plus the $20 brick. And now they have this 2-device charger, the MagSafe Duo, where you have to buy a different brick to get the full charging speed. So it's basically $180 to get the full wireless charging experience, and there's probably much better third-party options on the market.
You've also been trying out the HomePod Mini. How does it stack up to other models from Amazon, Google, etc.?
Yeah, I mean, the HomePod, when it first launched a few years ago for $350, I was really optimistic about the quality and the technology, but the price was way too high. There were lots of issues related to Siri and HomeKit integration and stuff like that. Those really haven't been solved, but now at $99 with pretty decent sound quality, they took out the biggest barrier to entry. So I think it's a good purchase if you're in that Apple ecosystem.
You've also been trying out the new Sony PS5, and all the talk online is about just how hard it is to get. Is it worth the wait? And what are your big takeaways?
Yeah, you're right. The wait is intense. I've seen people paying well over $1,100, $1,200 to not want to wait for it to ship. The graphics on the PS5, they can go up to 8K if you have a TV. I don't know who has one yet that supports it, but it'll be there for you, are just amazing. I've been playing NBA 2K, and you can really see the sweat dripping off the players' faces. Everything looks super realistic. So if you want the latest and greatest in gaming technology, and you've already bought a ton of PS4 games, that's probably the better option for you versus the new Xbox.
And speaking of wait times, the wait time for new Peloton bikes has also been a talker. What's coming down the road for Peloton, especially over the holiday seasons? I imagine this is going to be a popular gift item. Have they managed to bring down the wait times?
Yeah, Emily, unfortunately, really have not managed to bring down the wait times. I actually spoke to Peloton CEO John Foley a few days ago, and he told me his aim is to get back into a supply-demand balance around Q3, which is around April, May for Peloton. But the important thing to note is their new cheaper treadmill, which is almost $2,000 cheaper than the original model, that's not shipping in the U.S. until end of March, so that's going to miss the key holiday season.
That was Bloomberg's Mark Gurman and Emily Chang. And coming up, we just heard about Peloton bikes potentially not making it to their destinations because of supply chains and shipping. What other shipping delays are anticipated as the holiday shopping season gets into full swing? We'll find out, and we do it next. This is Bloomberg.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Technology. I'm Taylor Riggs in New York. In a normal year, Black Friday kicks off the holiday shopping frenzy, where retailers can make about a fourth of their annual sales. But it's a 2020. It's a pandemic year. So in this new normal, holiday peg shopping, well, it began a little bit earlier, all in part because of online shopping. But now more than ever, delivery times are in question. Amazon merchants around the U.S. say that deliveries of some products are being delayed. To discuss, we're joined by Melissa Burdick, PackView co-founder and president. Melissa, I think it was the first portion of that really stood out to me, in that I felt like my Black Friday sales came a month ago. Am I right?
Absolutely. Actually, really it kind of kicked off with Amazon pushing their Prime Day from July to kind of the middle of October as a way to pull forward demand into the holidays. And that really did kind of kick off the holiday season. So instead of the 5 days of Cyber Friday, Black Friday, Cyber Monday, we're really having like a month of Black Friday deals all month long.
And is this permanent? Is this structural? Am I ever going to walk into a mall again?
I had my Thanksgiving meal delivered to me for the very first time. I avoided, going to Costco and to Whole Foods where I normally shop, and I got it delivered through Instacart and grocery pickup through Whole Foods, and the experience was magical, and I don't know if I'm going back. So I think that a lot of the shopping behavior will stick. Actually, Instacart released some data around their customer information, and they said that 86% of their users are likely to keep using Instacart in the future, and that 89% see Instacart as an essential service. So I wouldn't say that this is, permanent, for any means, but it's definitely a behavior that's going to stick. Certainly around, very busy holiday timeframes, and especially when people have such great experiences like I did, they're likely to do it again.
And my producers are some of those who love the convenience of it, and pointing out that DoorDash, for example, also doing deliveries for the traditional brick and mortar stores. I'm wondering if you think that that's a great way for them to also look to the future, to pivot, to partner with some of these companies, because otherwise they might be left struggling.
Absolutely. And we saw a very interesting partnership last week announced with Instacart and Best Buy. Instacart's traditionally a, grocery kind of marketplace and platform. And, a lot of stores are closed tomorrow for Thanksgiving. And so the last mile delivery, opportunity is hard. So, having this ability to partner with last mile delivery like DoorDash, like Instacart, and like others is definitely a smart way to help what we're calling Shipageddon this year, and probably, kind of going forward, kind of different models that people are trying out to be able to get products to people faster.
You mentioned Shipageddon, and it seemed like, I'm using Amazon, for example, really tried to transform to be a logistics company. And yet no one had predicted this massive surge in online shipping, really that has been the story of 2020. How many delays are we expected to see this year?
It's going to be significant. I mean, Amazon has been predicting this. That is why they started early and they moved their Prime Day into October as a pull forward mechanism. And then we see a lot of messaging across a lot of retailer sites and direct to consumer sites saying, shop early, shop now, with shipping cutoffs as early as December 5th. So that I've seen, at least. So it's a true thing that's going to happen. I think that, Amazon's poised to be a big winner because they're just amazing executors, and they have the logistics built out a lot better than others do. So we are going to see it. That's why I think we're going to have a huge Cyber 5 weekend coming up, because people are going to be buying now because they know that, they're going to expect delays in their orders.
Yeah, on those delays, is there any backlash? I remember in the peak of the pandemic, March, April, May, a 2-day delivery easily was a week or two. People do get frustrated because they are used to and they pay for that convenience. What would be the backlash?
I think that I think people are trying to really message on their websites, expect delays. So the difference is people weren't expecting delays back then, and so they were upset that they weren't getting their orders on time. But there's a lot of proactive messaging and also email, messages once things are delayed, that people are getting notifications and things like that, that your order is delayed. So I think that there's mitigation tactics that these retailers are putting in place to soften that blow versus just, where's my order? I ordered it. I expected it.
What are some of the trends that you're noticing?
Just in general, I think one of the interesting things is just around social commerce. We saw that a lot on Amazon during Prime Day. They started integrating a lot of live streaming with video. We saw a rise of TikTok this year, especially as people were in lockdown, and they were, is the only thing that brought joy was by kind of doing TikToks together. And so I think that we're seeing a lot more micro influencers and social commerce kind of coming into play to kind of discover and buy products, especially when you can't go into a store and discover them. So there's more reliance on, video that shows you what the product looks like and how it works and things like that.
I learn new things every day. Micro-fluencers. Thank you, as always, Melissa Burdick, PactView co-founder and president. And coming up, a coin-sized COVID-19 detector attached to your skin. It tracks you constantly. Yes, 24/7. Could this surveillance prove effective or excessive? We hear from the founder of BioBet next. This is Bloomberg.
Sony's PlayStation 5 went on sale Thursday, and the company hopes it'll become a long-term cash cow. It's a key test for the Japanese company amid the pandemic's gaming boom, and it goes head-to-head with Microsoft's new Xbox. Both consoles have seen solid pre-order sales. The previous console sold 113 million units.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with interactive brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
I'm certain that we will be able to bring our debt levels down and avoid what you could call a debt crisis because we're focused and we've been open enough by telling the nation that we have too much debt.
COVID-19 cases continue to surge around the world. In the U.S., California reporting another daily record of new infections Tuesday, while New York saw the most new cases since April. One company that's working to help curb the spread of the disease, BioIntelliSense. It has a creator and a wearable sensor. It's called BioButton. It measures body temperature and other vitals to detect COVID-19 symptoms. Joining us now for more, Dr. James Malv, CEO and founder of BioIntelliSense. Doctor, just break this down. How does this work?
Well, this is a medical grade wearable that we developed actually before COVID to be able to monitor patients after they leave the hospital. And one of the most important things you're concerned about after someone leaves the hospital is developing an infection. So whether it's a cancer patient or someone that's had surgery, we developed this technology for what's called remote patient monitoring. And, it was cleared by the FDA just at the end of last year. We were launching it into large hospital programs, and then along came COVID. And this is a device that was built to monitor continuously your body temperature, your respiratory rate, your heart rate. All of those things are changed during an infection. And so with that, hospitals started using this to monitor COVID patients, very broadly.
I think one of the things that stood out to me is it says it's scalable and cost effective. How scalable and how cost effective?
Well, when you look at the cost of keeping somebody in the hospital to monitor them, you're talking about $2,000 a night. And now you can send somebody home with a sticker a day or two earlier and just keep monitoring. And what we've seen is, obviously, we're doing this via a virtual interview. Virtual care for taking care of patients has also exploded over the past 8 months. And so being able to monitor somebody without having to have them hospitalized has changed everything. But you need to be able to have some kind of technology. And we're used to wearables in our daily lives for the past decade with Fitbits and Apple Watches. But those aren't medical grade devices. And so doctors and hospitals need something that's going to measure those vital signs as accurately as what we have in the hospital.
But does it track you where you go? And has anyone expressed concern about that?
So these devices do not do what we call location tracking, and we understand and appreciate those concerns. So for that very reason, this is monitoring your vital signs. It's transmitting that data via Bluetooth, just like we're used to, again, with our consumer wearables. But in this case, it's a little sticker that's on your chest, where it's more reliable to measure your body temperature and your respiratory rate and your heart rate. And when we go to a restaurant, they're doing their best to try to assess whether or not you might be sick. But the problem is that's a single snapshot of your temperature. And what this is actually doing is it's quietly monitoring your temperature 1,440 times per day. In other words, every minute. And then also your heart rate and your respiratory rate and other things that actually make it quite reliable to identify if someone is starting to develop an infection. And as you can imagine, we have a lot of people getting COVID tests just to be able to go to work, or the Screen Actors Guild every other day, football players and so forth. And unfortunately, and you've done this well in the lay press, explain the fact that a negative COVID test yesterday doesn't tell you whether or not this person might have COVID today.
Right. That is a very good point, and one that I face is we take weekly tests to come into the office, but it's just a snapshot, right, of that one moment. I am curious.
Now we have a 4K movie of someone every day. So our technology actually does a look back over the last 24 hours and says, is there anything about their vital signs that might be a concern for a new infection? So it's almost like a daily COVID test.
What if I'm asymptomatic?
Well, isn't that interesting? It turns out that asymptomatic is a bit of a unicorn. What you're finding is that asymptomatic is being reported as high as 80% of COVID patients are asymptomatic, all the way down to less than 10%. And what that tells you is two things. One is the definition of asymptomatic is all over the map. Asymptomatic could mean that this person just never had a fever greater than 38 centigrade or 100 degrees Fahrenheit. Or it could mean, I don't think I had any symptoms, so it's kind of subjective. The reality is it is very difficult to have an infectious process without your body responding to it in some fashion. So this comes down to what is the resolution of your instrument for measuring symptomatology. In other words, if you're just taking one temperature per day, you're probably not going to see it. But if you're taking 1,440 temperatures per day, you're actually having what are called microfevers, and you're just not aware of it. So it really is, we've got kind of the Hubble telescope to be able to see things that you just wouldn't see in somebody that's not wearing one of our bio buttons.
Fascinating. I mean, Dr. James Malt, great to have you, founder and CEO of BioIntelliSense. A very interesting conversation. And as President-elect Joe Biden begins his formal transition, many sectors, including, well, the cannabis industry, now prepare for potential regulations under that new administration. We have an exclusive interview earlier. Bloomberg's Caroline Hyde and I spoke with Miguel Martin, CEO of Aurora Cannabis, to get perspective on the road ahead for the company.
Aurora is a global player and one of the largest, medical cannabis companies in the world. As the U.S., regulatory, framework starts to evolve, Aurora's in a really good place. Today, we announced a large-scale medical deal, with Israel. And so the capabilities and compliance, everything from manufacturing to production to labeling to sales and marketing that we've had to do to be successful as the largest medical provider of cannabis in Canada and in key markets around the world really bodes well for the U.S. And while it's hard to predict exactly what a federal framework looks like, we were very pleased to see that 4 states, including New Jersey, passed comprehensive cannabis legislation. And so there's definitely movement afoot, and companies like Aurora will be well positioned when it happens.
It's interesting. We spoke with one of your peers a few weeks ago, and he said his biggest competition is the black market. Do you agree, and how do you compete with the black market?
Yeah, I think that's right in Canada. But the fact of the matter is the rec market is growing. We've seen month over month considerable sales increases. We're seeing a lot more retail stores opening up across the provinces in Canada. And so while the illicit market, as we so deem it in Canada, is probably our largest competitor, the movement's afoot, and the consumers are finding that in those new categories such as vapor and pre-rolls and ingestibles and concentrates, the legal market or our market, has a lot of advantages over the illicit market. So it's moving in the right direction, and we're bullish on the opportunities for ourselves.
Talk to us about that bullishness, because analysts aren't always kind, and that you got 1 buy, 13 holds, 4 sells. And Stifel, for example, was saying, we do not believe the company has demonstrated an enduring right to win for new market opportunities. How can you tell them, no, we've got the right to win and we're winning?
Well, listen, our business and our industry is in massive transition. If you look at where everyone was a year and a half ago and how we built up this industry and how the money was coming forward, there just was a different approach to it. I come from over 25 years of regulated CPG background, spending most of my career at Altria, but also in the CBD business, the electronic cigarette business. Now that these companies are being run by professional managers with a CPG background, we can take advantage of the core economic dynamics we have. Margins are very strong. The category is growing. We see a global evolution, as you mentioned, in the U.S. And so I don't think there's any reason, over the next 6 to 12 months that you're going to see companies like Aurora not only be working towards EBITDA positive, but also be free cash flow positive.
It's interesting. You conducted a share sale as well, $125 million. How do you use that money?
Well, as we looked at the capital raise, we felt we were opportunistic. Right now, we don't really need that, cash for CapEx. But what we saw as investors and analysts were looking at our industry, they wanted to see not only execution, but also a runway from a cash standpoint. Mm-hmm. So we thought it was the right thing to do. We're now focused on the execution that we have, growing market share, particularly amongst our premium brands. We're really blessed to have brands like Whistler on the super premium side, Aurora and San Raf. And so we think the combination of our market execution, our global expansion, as well as the cash on the balance sheet makes us a compelling investment.
There has been a lot of talk about market share, and you have talked a lot about the premium side that many people do like the sound of going in on that and not just the flower industry. Talk to us a bit about M&A as to whether that's a way of gaining and keeping market share, because in the past you've had to have some goodwill impairments on previous deals. Do you see it all about organic or inorganic?
Yeah, I don't think we need in the Canadian market. If you look at our four pieces of business, we're number one in medical. I don't see M&A being an opportunity or need for us in the Canadian market or internationally. When we look at the US CBD business with the acquisition of Reliva, the number one Nielsen ranked company, don't feel like we have to do anything there. When we look at other parts of the REC international business, nothing there. And for the Canadian business, we have made significant investments. And you talked about goodwill impairment and right-sizing the company, whether it's production, sales and marketing, branding. We feel like we have everything we need.
That was Miguel Martin, CEO of Aurora Cannabis. And still ahead, looking for something to watch over the holiday? I am. Netflix's latest limited series. Well, it's also its most popular. We take a look at the 1960s chess drama, Why It's Stealing the Limelight. All of that next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Netflix scored big with the debut of their latest limited series, The Queen's Gambit. The show has gone on to be the streaming service most popular scripted limited series ever. It's attracting 62 million households. That's according to the company's figures. Peter Friedlander, Netflix VP of the original series, says, quote, "I don't think any of us could have predicted that The Queen's Gambit and the extraordinary Anya Taylor-Joy would become the global phenomenon they are today, or our biggest limited scripted series ever." Joining us for more is our media and entertainment reporter, Lucas Shaw in LA. Lucas, I admit I haven't had time quite yet to dive into it, but what makes it so popular?
Well, it has a great performance and just a great narrative. It's based on a book that just told this very compelling story of kind of a young chess master who learns how to play from her janitor at this orphanage that she is being raised in, and from an early age is able to challenge the best players, which was unusual not just for her age but also for her gender, because there were not a lot of prominent female chess players at the time. And it speaks to kind of Netflix's continued ability to sort of take stories and blow them up globally. Netflix in that post that you referenced talked about it being, I think, one of the top 10 shows in more than 60 different countries. It was the number one show in countries on almost every continent. And it really came at a crucial time for the service, because it's actually been a little while since they had a huge scripted hit. They've had big movies, big unscripted shows, but not a lot of kind of that bread and butter scripted shows that they started with House of Cards and many more.
And I love that you brought that up, Lucas, because I remember in the Disney earnings, the Disney Plus numbers continue to blow it out of the water. And Netflix has sort of responded and raising prices every 18 months or so and making sure that they're keeping the revenue and the profitability up. But of course, so reliant on these sort of big hits, but the costs, of course, that go into that. Does this sort of cement again their dominance, their lead, and of course that ever reliance on some of those big scripted shows?
Yeah, it's interesting. Netflix and Disney are playing such a different game right now. Disney is growing at that clip almost exclusively just on they're trading on that Disney brand. They have one show. They have the Mandalorian. They have the Hamilton movie, which was big, but from a scripted series show, they have the Mandalorian, and that's about it. But it well overperformed when Disney Plus launched, and obviously I'd imagine the numbers for the second season, based on some of the third-party data I've seen, are quite good. Disney will eventually scale up, but they're not playing at the same level at Netflix in terms of the volume of new shows that they're releasing. So far, it seems that they don't need to. They may need to at some point if they want to keep people and retain them. But the strength that Netflix has always had on everybody else, or the advantage, is that they're producing at such a volume and there's so much to watch that even if you're not watching Netflix right now, you're not going to think about canceling it because you know that there's always something there for you.
Lucas, we just have about 30 seconds left. I'm curious if Netflix benefits from the fact that movies are sort of going direct to consumer. We're bypassing the theaters more and more frequently.
It's been a huge benefit, and they have a number of big titles coming up just between now and the end of the year, what is typically the kind of the Oscar season and family season. And this year seems like Netflix's best shot at winning a Best Picture Oscar. Look out for Mank, which is David Fincher's new movie, which comes out in about a week and a half. 10 seconds. What are you baking for Thanksgiving? Pecan pie. Love it. Family
Lucas
tradition.
Shaw, Bloomberg News, entertainment and media reporter, and excellent baker, I hear. Here's the good news as it does it for this edition of Bloomberg Technology. But make sure to stay with us because Bloomberg Daybreak Asia is still ahead. Happy Thanksgiving. This is Bloomberg.
Once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonizes it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
Chinese capital market, as you know, is nascent, is just developing. And so we think there's an opportunity to build out that. But that's not all. We're also focused on continuing to build our presence in the Greater Bay Area. It's been a good business for us.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is my kitchen table and also my filing system. Over much of the past 3 decades, I've been an investor. The highest calling of mankind, I've often thought, was private equity. And then I started interviewing.
While I watch your interviews, I know how to do some interviewing.
I've learned in doing my interviews how leaders make it to the top.
I asked him how much he wanted. He said $250. I said, fine. I didn't negotiate with him, and I did no due diligence.
I have something I'd like to sell.
And how they stay there.
You don't feel inadequate now because being only the second wealthiest man in the world, is that right?
Many of the world's largest pharmaceutical and vaccine manufacturers are racing to find a cure for COVID-19. One of those companies is GlaxoSmithKline, based in England and also now the largest vaccine manufacturer in the world. Its CEO is Emma Walmsley. She was trained in classics at Oxford, but now has an incredible task, producing a vaccine that will help cure COVID-19. So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, governments, media, or my mother. So very frequently. And obviously, we've all been delighted to see the very recent news of some of the first results that's coming through on vaccines. Yesterday, I was just on a call last night with 10 of the global pharma CEOs who are all very heavily involved in bringing solutions to COVID. And we're really excited and optimistic to see some of the first data coming through and looking forward to seeing a lot more in the next 6 months or so. We have 3 vaccines in the clinic and 2 therapeutic treatments. Everyone is understandably very impatient because I think the IMF said it's every month we wipe off the pandemic is 500 billion of value for the world. But I think right now we can be increasingly optimistic that science will win and our industry that's mobilized so fast will start to bring some scale solutions. And we're going to need more than one, that's for sure.
Now, normally to have a vaccine, it takes 4 to 7 years. The polio vaccine was 7 years. I think mumps and Ebola was 4 years. So this is being done in basically a year or so. So is it because you have so many people working on it that you're able to do it so quickly? Or is it less complicated than people originally thought?
Well, it certainly remains a very complicated effort, but when you're facing into a global crisis of this scale and this impact, there are many reasons that we have been able, as an industry, to mobilise behind getting to some faster solutions. But the ways you get to go faster are an incredible mobilisation and partnership with regulators and governments. The fact that we have all been parallel pathing work that you might normally do sequentially, and that has been through putting capital at risk. But we've always, and that's why many of us signed a commitment around the quality of the work, the scale of the trials, and the commitment to safety. And wherever the pressure might have understandably come from to go faster, we're all very committed to make sure that trust in vaccination is maintained, because the world will pay a very big price, not just for COVID, but beyond that, if we break trust in the quality of vaccination. And it has, frankly, been the biggest contribution to human health since clean water, and we need to make sure that that's maintained for the future.
So some people are not willing to take a vaccination. Some people have said in surveys in the United States, only 25% or less of people say they want to take this vaccine because they think it's either been politicized and not sure it's safe, or some people just don't like vaccines anyway. Are you worried that people won't take the vaccine?
Well, yes, of course. I do think, and we remain concerned about vaccine hesitancy, but we also have to be incredibly respectful about why people have these questions. You know, have we been able to move fast? Have the companies put in the right kind of processes and scales of trials? What transparency are we going to bring to these processes? And why do you hear about things being stopped and started again? What does all of this mean? So I think our job is to make the commitments we have, and we have very publicly about that alongside other manufacturers, but also make sure we share data transparently and partner with governments who ultimately are those that guide in different countries around policies and distributions to reassure people. And again, because, you know, we don't worry about our children dying of measles anymore. There are smallpox has been eradicated, polio nearly so. And this is because of this incredible contribution to protecting people, and protecting life is always better than intervening at a later stage.
Now, you have teamed up for the coronavirus vaccine with Sanofi, which is another large pharmaceutical company. I'm just curious, why did you team up with someone else? You're the biggest manufacturer of vaccines. Could you not have done this yourself?
Well, I think it's one of the great things that we've all seen in many industries through this pandemic is this incredible collaboration against a common competitor or enemy. And when we announced our approaches to vaccines development in the beginning of February, we said our best chance of contributing GSK science, technology and know-how was to offer our adjuvant technology, it's called, which helps make other vaccines more effective, and an adjuvant technology that has been proven in pandemics to any credible partners. So we have 3 vaccines partnered in the clinic with others, including Sanofi, because that adjuvant technology is proven in pandemic to work on older people and is a more effective way to get to scale manufacturing, which is the other real challenge here. We need to probably provide up to 14 billion doses if we're in 2-dose vaccines to really protect the world. And so, as well as getting to a safe and effective vaccine, we need to get to scale as fast as possible. And our route to that was partnership.
Okay, there are 2 questions that people often ask as well about whether vaccines are not only going to be available, but to whom are they going to be available first? Let's suppose you come up with one. Who gets them first? Private equity professionals? Do they get them first, or not first in line? And secondly, what's it going to cost?
Well, firstly, these are 2 fundamental questions. And again, right from the beginning, we said at GSK that our principles were around global access, which is why scale of manufacturing, getting to billions of doses and having multiple vaccine solutions, not just the first one off the block, matters. Some of the new technologies that are being distributed have to be distributed at minus 70 degrees, I think, which is not suitable for going into some of the developing world. So we need access and we need responsible pricing, which is why we declared that we would not expect to profit from any COVID vaccine during the pandemic phase. We would reinvest any short-term profits in pandemic preparedness, donations to the developing world. In terms of who gets it, we are contracted to governments in the US, Europe, the UK, Canada and others. But we also just recently with Sanofi committed to 200 million doses for COVAX as a starting point, which is particularly about supplying to the developing world where you have many vulnerable populations. The first principle should be the people who get it first are the people who need it most.
Now, you are the largest vaccine manufacturer in the world, as I understand it. Some people say that vaccines are not the most profitable part of the pharmaceutical industry because, as I understand it, with a regular drug that one might manufacture, people might take it once a week, once a month, or so forth. With vaccines, you take it once or twice and you're done. So some people say that the pharmaceutical industry doesn't really care about vaccines as much as maybe they should. Is that fair? And is it that profitable a business to be in the vaccine business?
Well, first of all, I think everyone in the world, every family, community, company and country cares a lot more about vaccines and is looking at it a lot more now than perhaps we did 2 years ago or a year ago. We are the largest manufacturer. We have more than 30 vaccines. We ship 2 million vaccines a day. I think we vaccinate about 40% of the world's children. And it is a profitable business. But it's a business that comes with responsibility around access too.
So why do you think it is that pharmaceutical companies, and you're one of the largest pharmaceutical companies in the world, generally the public says maybe they are making too much money and maybe your image is not as good as you would like it to be? Why do you think that's happened? And do you think there's anything the industry can do to improve its image with the public?
I think this is a really fundamental question for our industry because, you just need to look this year at how mobilized we've been, what a difference we can make, and how much for healthcare resilience globally, our contribution is required. And I'm really proud of my company, but our industry for the way we've tried to collaborate for that. But the fact remains that we're still turning up in movies as the industry that people have criticisms of. And fundamentally, you can understand why there is this, when people, not just in developing countries, but in the most powerful countries in the world are still fighting for access to healthcare for themselves or the people they love. And there is this tension, as you say, between the human right to access to healthcare and profits in big corporates, a perceived tension. And frankly, I think the industry hasn't always historically helped itself, either because of a small number of egregious acts on pricing or not enough transparency about why we do how we do what we do and why it matters. And I think that what we can do about that is to do a better job of fulfilling our purpose to protect health, find new solutions to fight new diseases responsibly. So partnering with governments to help address out-of-pocket challenges, to bring more transparency and stability to how people can engage with healthcare, to champion access across the world, to be responsible always in our pricing, to bring transparency to the way we work, but also do a better job of showing why it matters to everybody that we do that profitably. Because 1 in 2 of us gets cancer. 1 in 3 of us, maybe it's 1 in 2 too. It doesn't matter how successful all the people are that you interview. We don't have treatments for dementia and Alzheimer's, and we need to keep fighting and investing to be able to solve these problems for the future.
So is it cheaper and easier for a company like GSK to go buy somebody that has already made a product and put it into your system rather than try to develop it yourself? Because I realize that it takes 10 years or more to develop a product. So is it easier sometimes and better to go buy something? And how do you see the trade-offs between the two?
What we're all working hard to do is get to a better quality pipeline. And it would be incredibly arrogant to think, all the world's best scientists sit inside your company, which is why business development and M&A is so common in our industry. The other thing to remember is that because of the patent cliff model in pharma, you are having to and it's another reason why, as well as delivering on our purpose responsibly, we have to do it profitably. You are having to reinvent your portfolio, on a rolling decade basis, because we invest in the innovation, we build that drug, and then rightly it comes off patent, can be genericized, and the sales are lost, very aggressively and quickly.
Now, you're a member of the Microsoft board. So I assume you have a fair degree of background now in technology and IT and other things like that. How have you been able to apply that to what you're doing at GSK?
Well, I would never describe myself as having a background in technology and IT, and I'm absolutely sure that was not why I was brought onto the Microsoft board. But it's an extraordinary company doing extraordinary things in an incredibly responsible way at a time when technology is changing the world and industries, and I believe can be an incredible force for good. It'll be interesting to see what we look back on the 2020s as standing for and meaning and what evolved. No doubt 2020, loads of people will be writing books about how to lead through a COVID crisis. But I think most of us believe that there will be other, huge global issues that we'll have to address, like climate change and inclusive economic recovery, etc. But I also believe health resilience will be on the agenda. And the advances that the world has seen in biology, all of the genetics and genomics data that's coming through, at the same time as the advances the world has seen in AI and machine learning, combined together, have a real shot over the next decade to improve the productivity of R&D and science in my industry incredibly. It is really hard to discover new drugs and vaccines. 90% of them fail. It takes a long time. Obviously, the world is mobilized right now to get to faster solutions. And I hope we learn lessons in our way we partner with regulators and use new technologies to permanently accelerate some of these processes. But the opportunity to use technology to identify and the enormous amounts of data to identify better quality targets, so we have a biological target, so we have a higher probability of success of developing better medicines faster for these enormous unmet needs in the world, I think will be defining for the next decade.
When you were in Oxford, did you say you wanted to do what you're now doing, or what was your career ambition?
Yeah, I think it would be fair to say that I spent most of my time in my master's looking at Latin poetry, which was not an obvious path towards this destiny so far.
What moves the human spirit, what transcends time, comes from true craft, the artistry of Japanese craftsmanship. Presage, Seiko.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When you grew up, you went to Oxford and you majored in modern languages and classics. And as a general rule of thumb, most people running pharmaceutical companies are not majors in classics or Romance languages. So when you were in Oxford, did you say you wanted to do what you're now doing, or what was your career ambition?
Yeah, I think it would be fair to say that I spent most of my time in my master's looking at Latin poetry, which was not an obvious path towards this destiny so far. And honestly, I am probably the person you've interviewed who had the least strategic career plan ever. My entire work experience, up until I left all studies, was waitressing. I never had, any kind of internship or anything like that. I went into consultancy for a few years because I needed to pay off my debts. And then, because I spoke French, I was in charge of benchmarking L'Oreal. And I just got super curious about that industry, and then took a pay cut to go and be the assistant product manager on a home hair color. And then spent 17 years going all around the world, just tremendous opportunities, living and working in Paris, in New York for 5 years, and then in China, and never thought I'd leave. And then had one of those kind of accidental meetings at the time in Shanghai with the then CEO of GSK, who explained and convinced me that I should move into the consumer business at GSK. I couldn't resist the chance to pursue, I thought, of a business with an incredibly important and impactful purpose, which is health, and also have the chance to run a global division. I had no idea that would then lead to this, but it's been exciting so far.
So what did your family say when you said, I'm going to be in the pharmaceutical or healthcare business?
Well, my family... the prospects at the time, but they, and then, obviously, I grew up, my father was in the Navy his whole career. I grew up in a military family where there was a tremendous sense of work ethic and duty and responsibility, and I think, they were incredibly proud when we eventually came back to the UK after being out for 10 years, and excited to see the work that we've been doing since.
So you're a consumer healthcare specialist in addition to being a classics person and a modern language person. But then you, in effect, sold off, or you've joint ventured your consumer healthcare business. Did you ever expect when you came to GSK that you would actually not be doing consumer healthcare and you'd be doing the traditional pharmaceutical healthcare? Well,
the short answer to that is no. But I'm incredibly excited to see, frankly, the creation of two world-leading businesses. And in consumer health, we built the joint venture with Pfizer and declared at the time of doing that deal that we would, by around mid-22, separate that company out to be an independent company, because it's the only standalone, dedicated to consumer healthcare, consumer products company in the world. It's got leading positions in leading markets. It's in leading categories. And frankly, having it inside as a slightly invisible division, a much bigger company whose number one priority is to invest in the biopharma pipeline, in innovation, around the science of immunology and genetics, and really prioritize that, we decided that the right thing to do was to create shareholder value, reset the capital structure for both companies, and free them both to have long-term, sustainable, appealing growth and returns.
So when you are in the pharmaceutical industry, like many other large industries, they are not run as much by women as maybe they should be. So do you get asked every day, what's it feel like to be a woman running a major pharmaceutical company? I'm not sure there's any other women running major pharmaceutical companies right now. And how tired do you get of that question?
Well, I think probably like many of the women leaders that you meet, I try not to define my work by my gender, but I recognize the responsibility I have, just visibly and for others, to show what's possible. I've spent pretty much all of my career being a minority in the room, mainly for my gender. I do believe that the question of diversity and inclusion that, let's face it, we have all rightly woken up to in a very humbling and shocking way, particularly on the question of race and ethnicity this year, is something that all responsible companies need to take really seriously, because the data just shows that more diverse leadership delivers better results.
If a young woman is watching now and she's saying, I want to be Emma Walmsley, I want to be the CEO of a major company, and I want to overcome all the prejudices and so forth, what would you say to her? What are the leadership traits that you think enabled you to get to the top?
First of all, don't aspire to be Emma Walmsley. Aspire to be the most exciting version of yourself, and never think of it as some end state. It's a constantly evolving learning journey. You want, in my experience, but my experience won't be the same as whatever the best experience is for you, is what drove me was doing work that I thought mattered, that I loved, working admittedly incredibly hard, because I think I had a strong influence of that growing up, that sense of responsibility and duty. Probably a good dose of fear of failure kept me going along the way, and wanting to have some kind of impact, and then taking on loads of jobs that along the way that weren't perhaps obvious at the time, but make a lot of sense looking back. Whether they might have been moving from New York to Shanghai at a time people thought that was very odd, or taking a pay cut to go and work on hair colour. But as long as you're doing things that you can be curious about and learn and keep and you love, then the success can follow.